Very good morning, everyone. Hope you all must be doing great. And I believe that I am perfectly audible to everybody. Good. Thank you so much, Naresh Aditya. Thank you so much, guys. And today we'll be doing, tomorrow is our examination. And today we would be revising. In fact, I would be try to cover all the concepts. So, but that too very, very quickly so that we have a very limited time. And chart book, I believe everybody has the chart book also with you. Even if you don't have right now, you can just look at the screen. And in case somebody doesn't have, they can just go to the app Rajat Muga classes and you can download this chart book. Most of you, I believe that you must be having the PDF. Okay, let us start with, I'll be starting with the very first chapter, basic concepts. Then I'll be touching the residential status, and same way we'll be doing salary, house property, PGBP, and so on. And we'll be completing all the chapters. And I'll try to cover it up in next 5 to 6 hours. If I'll be explaining some concepts in detail, it might take a little long, but my target is that I should finish it up everything in next 5 to 6 hours. We'll be taking a short break also in between if required. But yes, 1 or 2 break would be required. So let us start with the basic concepts first. See, in the basic concept, there are 3-4 things which you should understand. One is the slab rates. And I believe that most of you, everybody know how to calculate the slab rates. We should know what are the special rate which are applicable on a special income. We should know about rebate. We should know about rebate, both under default regime as well as optional regime. And we should also know about surcharge. These are the important things which you should know about basic concepts. Let me quickly revise it for you. See, under default tax regime, see, if the question is asking you to compute the tax, first of all, in your examination, guys, it's very important that you should, I always say that you should understand what the examiner is actually asking. If the examiner is asking just the total income or any other income, so please stop your answer by calculating the income only. But if the examiner is also asking to compute the tax liability, then only please compute the tax liability. Otherwise, no requirement to compute it. So how you will be computing the tax liability, you understand if you have to follow the default rate. Now, it is very important to know that when you would be following the default regime, see, there are 3 things. If the question is directly asking you, that follow the default regime, why? How they will be asking you? They will be giving you 115 BAC, or they will be giving you that you have to follow default regime, then follow default. If the question is silent about the regime, then also default regime should be followed. If the question is silent. Third very important point, this is a little tricky point. Sometimes examiner can also give you questions that the assessee has filed his ROI. The assessee has filed his ROI late, or he has not filed his ROI up to the due date. In this case also, default regime should be followed, because the option to choose the optional regime is only up to the due date. If the due date expires, then there is no such option. You have to follow default regime only. So this is a little tricky. Sometimes not in previous attempt, but previous to previous attempt, they have given like this also. So if the assessee has not filed his return of income on time, it means that 100% you have to follow default regime. I believe that everybody is okay with this. Now, if you follow default regime, you understand the slab rates. Up to 3 lakh nil, 3 to 7, 5%, 7 to 10, 10, 10 to 12, 15, 12 to 15, 20, and after 20, you straight away jump to 30, more than 15 lakh, 30%, everybody knows it. In default regime, age does not matter. Please don't make a mistake over there. So age does not matter while computing the tax rate under default regime, whether the assessee is senior citizen, super senior citizen, doesn't matter. This would be the slab rates applicable for everybody. But yes, on special income, there are special rates. And now you also know that what are the special incomes. See, now it also depends, because mostly the special income relates to capital gain. And we understand that during the year, the capital gain rate has been changed. So you should know when the capital gain is actually arising, whether it is pre-budget or whether it is post-budget. So please apply the capital gain rate accordingly. You understand the special income, no need to write it, just listen to this. If there is anything to write, then I'll ask you to write. Otherwise, most of the things today, you just have to hear it, right? Special income, one is 111A. We all know what is 111A. 111A is short-term capital gain on equity shares or equity-oriented units, which are sold on stock exchange, right? STT is given, either the word stock exchange is referred over there, or securities transaction tax STT is written over there. It means one and the same thing. They are sold on stock exchange. And if it is 111A, that is equity shares and equity oriented units, and mainly equity shares is most important, right? Mostly they ask you about equity shares. So 111A rate is 20%. But now it depends that when this capital gain is actually arising. If it is before 22nd of July 2024, on or before 22nd of July, that we call it pre-budget, because you understand, on the budget date, 23rd of July is the budget date. On that date or thereafter, the rate has been changed. So if it is pre-budget, then you have to apply 15% tax rate. And if it is post-budget, that is from 23rd July or onwards, 23rd July 2024 or onwards, it is 20%, right? In case the question does not mention when the capital gain is arising, then you will always assume that it is post-budget. Everybody is clear on this? So if the question is silent, that when the capital gain is arising, please always follow post-budget. Please don't follow pre-budget, because pre-budget, this is only 3 months or something. Otherwise, most of the part of the year is post-budget only. So please follow post-budget. But if the question is specifically telling you when the capital gain is arising, apply it accordingly. Then long-term capital gain, we have 112 and 112A. 112A is, first let me talk about 112A. 112A is long-term equity shares or equity-oriented units which are sold on stock exchange. Mostly equity shares sold on stock exchange, or STT is given. Means if they have anywhere in the question they have mentioned STT provision is there. So please follow 112A, and you understand, if it is more than 1 year, then it is 112A. It is exactly 1 year or less, this is 111A, right? On 112A, the tax rate is 12.5%. But earlier the tax rate was 10%. And please don't forget that whenever you have to calculate on 112A, on first 1,25,000, I believe everybody remember this amount, 1,25,000. On first 1,25,000, you don't have to apply any tax. In excess of 125, you have to apply tax. It means, let's say if 112A is coming as 2 lakh, so first 1.25 should be ignored. On 75,000, please apply this rate. And 125 will remain the same, whether it is pre-budget or post-budget. Please don't change this 125. 125 will remain the same. If anybody has this confusion, let me clear it out. 125 will remain same, whether it is pre or post. Got it? Now, 112, it is normal long-term. Any other long-term, it is 12.5%. Earlier, it was 20%. Got it? So these are the special rates. And on casual income, you understand 30% is the rate. Pre and post doesn't matter. They will not ask you about unexplained income, but by chance, if there is any unexplained income or unexplained investment or unexplained expenditure is there, then on unexplained income, what is the tax rate, please, guys? Can you please explain me what is the tax on unexplained income? 60%. 60%. Pre or post. Very good. 60%. Chances are very low. But in case, we never know if they ask about unexplained income. So please remember, don't make this mistake also. Please apply 60% rate. And these rates are same whether you are following default regime, whether you are following optional regime. So please. Kala Selvi, you are not able to hear me. Is it for everybody? You're not able to hear me? Kala, I'm audible to everyone. You can just leave the meeting and then rejoin. Please leave the meeting and then rejoin. Okay. Coming back. Now, so please remember, these special rates are same under default as well as an optional regime. Coming back. So everybody know what are the slab rates, special rates we all know. And if you are following optional regime, you understand the slab rates are 0 to 2.5 lakhs. So I'll not be spending more time over there because everybody know. 0 to 2.5 lakh nil, 2.5 to 5 lakh 5%, 10% and 30% and so on. Take 5, 20% and 30% and so on. In case if you are following optional regime, then please do remember, then age does matter. If the assessee is an individual resident, but this person should be resident and senior citizen or super senior citizen, please change this basic exemption limit accordingly, 3 lakh or 5 lakh. We all know it. Now, you should also know about rebate. Rebate. See, if you are following optional regime, rebate is only and only applicable to resident individual. Only resident individual, nobody else, not even to HUF. It is only for resident individual. Under optional regime, it is fixed that total income is up to 5 lakh, then only rebate is applicable. If the total income is little bit above 5 lakh, please do not apply a rebate concept in optional regime. And how much is the rebate? The amount of rebate is A and B, whichever is lower. A and B, whichever is lower. A is tax on income or rupees 12,500, whichever is lower. Right? We all know this. Now, tax on income. Whenever you will be computing tax on income, one more thing which examiner, can you please all mute yourself? Okay. Now, tax on income, whenever you will be computing tax on income, please do remember that it is excluding 112A tax. Because if you are having 112A, what is 112A? Long-term capital gain on equity shares or equity-oriented units, on that rebate is not applicable. So if case, the question in case of MCQ, they can ask you, so if there is any 112A income also, so whatever the tax on that income, please exclude that, because on that you don't have to give rebate. I believe everybody is okay with this. Second thing is, if you are following default regime, then you should know that the total income should be up to 7 lakh rupees. If it is exceeding 7 lakh, generally we will not give rebate. I've used the word generally, because you understand, if the income is little bit going above 7 lakh, let's say if it is 7 lakh 10,000, 7 lakh 20,000, 7 lakh 22,000, and you just get an idea, around 7 lakh 23,000. If it is more than 723, then rebate would not be available. But at 722 something, rebate can come. So you have to check. So in that case, if the income is marginally increasing over and above 7 lakh, little bit, up to 7 lakh 23,000 and so on, then only please check whether the rebate should be there or not. And how much is the amount of rebate? Same, tax on income excluding 112A, and B is rupees 25,000. Please do remember, here it is 25,000. So you all should know what are the amount of rebate available, and only give rebate to resident individual. Now the examiner can give you a trick that this income is 5 lakh or 7 lakh, as the case may be. But if the assessee is a non-resident, please don't give a rebate. I believe everybody is okay with the rebate concept also. Now, there is one more concept, unexhausted basic exemption limit. Unexhausted basic exemption limit is only applicable to resident individual or HUF. Resident individual or HUF. If my normal income, you understand, where whenever we have a total income, there is, we segregated 111A, 112A, 112, etc. So if a normal income is less than the basic exemption limit, please give that benefit also of unexhausted basic exemption limit. So that is also the concept. Now the last concept in basic concepts is surcharge. Surcharge would be applicable if the total income is exceeding rupees 50 lakh. If the total income is exceeding rupees 50 lakh, then only surcharge would be applicable. Under default regime, you understand that if the income is above 50 lakh to 1 crore, so you can also look from the chart book, rate of surcharge under default regime. So if the total income is more than 50 lakh, but up till 1 crore, the rate of surcharge is 10%. From 1 crore to 2 crore, 15%. And more than 2 crore, it is 25%. But as soon as you are going above 15%, if you are going to 25%, you understand that if you are having income from dividend income 112A, 112, 112A and 111A, then on that the surcharge can now not be more than 15%. I give you an example on it. No need to write it, but I'm quickly giving you an example. So let's say the total income is rupees, for example, 2.8 crores, 280 lakh of the assessee. For example, it is 280 lakh, which contains some special income. Special income in the sense it contains some 111A, 112A, or 112 or dividend income, right? And if our other income, remaining income, let's say it is 2.1 crore, it is 210 lakh, let's say it is 70 lakh and it is 210 lakh. First of all, you have to compute the tax. First of all, I believe everybody will be able to compute the tax accordingly. Then when you would be considering the surcharge, so whatever is the tax on this, let's say I'm tax on this and tax on this, whatever is the tax on this amount, you apply 25% on this amount, on this tax. And whatever is the tax on this 70 lakh, please apply not more than 15%. So you should remember that if we have others income also like 111A, 112A, 112 or dividend income, the surcharge can never go above 15%, right? But in case if I give you other thing, let's say if my total income is 280 lakh and my 111A, 112, 112A, etc., it is coming as 180 lakh. And my normal income is coming as 100 lakh. Correct? So this person is not falling under any of the levels. If you remember, this is what we have done in our classes. So this person is not falling under any of the level. In that case, whatever is the tax on these two, please apply 15% on the entire income. Everybody got this or not? Tell me yes or no. If you have not got that, I'll explain it again. Are you able to recall this provision, guys? So if you are falling, so you have to see, very nice, very good. So if you are going above 2 crores, so you have to think that excluding this income, if you are going above 2 crores, then apply 25% rate. Otherwise, if excluding these income, you are not going above 2 crores, then on entire thing, you have to apply 15%. Very good, guys. So this is what you should remember about surcharge. And the same slab rate for surcharge is there for optional regime also, but there is one more level. If you are going above 2 crores to 5 crores, it is 25%. But if you are going above 5 crores, then it will be 37%. Got it? I believe everybody remember these points also. And the same thing will happen if you are having income from 111A, 112A, 112, etc. Your surcharge rate should never go above 15%. So this was about surcharge. For LLP, for other companies, you don't have to remember these rates. That is not required. But still, if you would like to remember, for partnership firm, including LLP, the rate of tax is 30%. But it will not come. Generally, they will ask you only for individual. So this was about the basic concepts. The second thing you should know about residential status. Let us revise the second chapter, that is residential status. You understand, see, this chapter is very, very easy. First of all, mainly if I talk about the residential status of individual, status for individual. So there might be two types of question which can come in residential status. First type of question is to determine residential status. First, you need to determine the residential status. Only this type of question can come examination. This chapter is little important from examination point of view. It's easy also, but it's important also. So first type of question is to determine the residential status, mostly of individual. Sometimes they can give you of HUF also, but mostly 95% it would be individual only, but 5% it would be HUF also. So we should know to determine the residential status of HUF as well. Second type of question which generally come is to determine the residential status also plus then to calculate the income, calculate the total income also. This is the second type of question which we get. Also, third type of question is quite important, where they give you certain income, and they actually don't ask you that to determine the residential status, but they ask you to calculate the total income if the assessee is ordinary resident, not ordinary resident, or a non-resident. This is the third type of question. This is also quite important type of question. First of all, let me talk about this question. About this question, which is quite important, they will give you some 4 or 5 types of income. And if the question comes that if he is ordinary, not ordinary, or non-resident, how you should proceed it, we all know in that case, please try to make columns for that. So you can make as many columns which is required if they are asking about the person is ordinary resident, not ordinary resident, or non-resident. Please try to make these columns, correct? Then write here the particulars, the types of income A, B, C, D, and please don't waste time in writing the entire sentences. Please write in short. Please write in short. You have to actually move little bit fast from the very beginning. So please don't stop anywhere. See, whether the question paper will come easy or it comes difficult doesn't matter, guys. Doesn't matter. Your only task for those 3 hours is to attempt the paper. To just focus on attempting the paper. Whatever you can recall, please go and attempt it, and please maintain the speed from the very beginning. Correct? So please don't write full sentences. Only write some small words over here, some three or four words, so that examiner can determine that yes, what are you writing. And please write the same number. See, if you're in your question paper, they have given like this A, B, and C, and so on. So please, in your answer sheet also, it should be in the same fashion, A, B, and C. If they have given in Roman numbers 1, 2, 3, so please in your answer also, please also mention in the same way 1, 2, and 3, and so on. Please don't make these silly mistakes, right? Second thing, now we understand for ordinary resident, these are very easy question and very scoring question, guys. Please don't lose marks over there. We understand for ordinary resident, global income is taxable. Global income is taxable. Everything is taxable over here. Whether it is received, whether it is not received, doesn't matter. For not ordinary resident, that control thing is important, whether it is controlled from India or not. Because you understand that any income which is arising in India, or any income which is received in India, any income which is arising, deemed to arise, receive or deemed to receive, everybody is liable to pay tax. In that case, any income which is arising in India, everybody has to pay tax. Guys, please don't get confused if examiner will tell you that this income is arising in India but received anywhere else. Doesn't matter. If it is arising in India, 100% it will be taxable. Arise or deemed to arise. Any income which is received in India, 100% it would be taxable for everybody. So in these 2 types of income, you should never get confused. It should be taxable for everyone. Any income which is neither arising nor received in India. You understand for ordinary resident, global income is taxable. For ordinary resident, for this person, global income is taxable. Got it? So in this case, please don't make any mistake. For not ordinary resident, non-resident, generally, I would say that please don't make them taxable. Generally, I would say, see, for non-resident, always I would say, please don't make it taxable. For non-resident, straight away, I will say it is neither arising nor received. Straight away, don't make it taxable. But in case of not ordinary, this control word is important for you. Even they would be using the word controlled from India. They can also be use this word that this profession is set up in India. So if this profession is set up in India also, it means that it is controlled in India. So in that case, if it is controlled in India, then please make it taxable. Then make it taxable. Otherwise, generally don't make it taxable if it is not arising in India. But for non-resident guys, please, if they are using the word controlled also, that does not matter. It should not be taxable. Understood? 2 or 3 things more important here. If there is any past untaxed income, any past income which is coming in India, even if they are using this word that it is untaxed income, it means that it was not taxed in that year. Now it is being brought down into India. If there is any past income, please don't make it taxable for anyone. Please don't make it taxable for anyone, past untaxed income. Got it? Second thing, if there is any exempt income, like agriculture income from India, if there is any exempt income, please don't make it taxable. Some 2 or 3 exempt income which are favorite of examiner, which they ask you here. One is agriculture income from India. Second is share of profit from partnership firm. I'm using the word share of profit from the partnership firm. Please don't make it taxable. Got it? So exempt income, don't make it taxable even for anybody, even for this ordinary resident, please don't make it taxable. And they can also confuse you. Agriculture income from Australia, agriculture income from Nepal, agriculture income from outside India, that is not exempt. That should be taxable. For ordinary resident, that should be taxable. And now for these two people, it depends. If it is received in India, then only please make it taxable. Otherwise, don't make it taxable. Right? So please take care of these types of income also. So these types of questions are quite important from examination point of view. And here you can get maximum marks. Right? Okay. Second question is determination of residential status. Let me talk about, first of all, HUF. Very few chances, very less chances that they will ask you about HUF. But in case they are asking you about HUF, first of all, you understand for HUF, if it is 100% controlled from outside India, please don't make it non-resident. Please make it non-resident if it is 100% controlled outside India. Okay, Shivani has a question. Agriculture income from outside India is taxable only for Shivani. Agriculture income from outside India is taxable for ordinary resident, correct. But it can also be taxable for these two also if it is received in India. Got it? Because it is not arising in India because it is outside India. But in case it is received in India, then also it could be taxable for these two also. Good question. If you have any doubt, please keep on asking. I'll be answering that also. Okay. Guys, let me first concentrate on HUF. See, for HUF, if they ask you about HUF, which they can ask, if it is 100% controlled from outside India, it is managed and controlled from outside India, then please make it non-resident, full stop. HUF is a non-resident, full stop. But if it is partially, even 100% either controlled from India or partially controlled from India, even if it is partially controlled from India, even 1%, then we have to make it resident. First of all, how you should write. So if question comes regarding HUF, first of all, please write this. Just read the facts, what is the question is saying. And as per the question, please give your answer that whether the HUF is resident or whether it is non-resident. If it is non-resident, your question will stop right here. But if the HUF is a resident, then you have to determine whether it is ordinary, whether it is not ordinary. Correct? And how you determine? Please apply additional condition. Please apply additional conditions on Karta, on the manager of HUF. Please apply additional conditions. Because sometimes, most of the time, students make this mistake. If they say that Karta is a non-resident, HUF is also non-resident. No. HUF has a specific provisions for determining residential or non-resident. So first of all, if 100% outside India, non-resident, if it is little bit in India also, then resident, then apply additional conditions on Karta. What are the additional conditions? That old additional condition, first 730 days in the last 7 years. And second is out of last 10, at least in 2, he should be a resident. That's it. So it does not matter that whether the Karta is resident, not ordinary doesn't matter. Please for HUF apply these provisions only. First of all, apply resident or non-resident. If the HUF is resident, then ordinary, not ordinary, depends on additional conditions. If both the additional conditions are satisfied, 730 days is also satisfied in the last 7 years, 2 out of 10 years is also satisfied, make it ordinary. But if any of them is not satisfied, make that HUF not ordinary. I believe you will not make a mistake in HUF also. Then, for individual, guys, for individual, how you will be determining the residential status. Let's say the question comes to determine the residential status of individual, and subsequently they are asking about the total income also. So let us answer the first part, that whether this individual is resident or non-resident. Guys, please, first of all, in this case, see whether the income of the individual is also given or not. Whether the income is also given, the income information is also given or not. If the income information is also given, then always, if the income information is given, then please apply special provisions. If income information is given, because we understand that if his Indian source income is more than 15 lakh, then special provisions is applicable. In fact, I'm telling you, it's a thumb rule for individual. If the income information is given, then please always follow special provisions. Special provisions are in priority. You should give preference to the special provisions. So you have to follow special provisions. And in special provision, when you have to follow, if his Indian source income, is exceeding rupees 15 lakh. If his Indian source income is exceeding rupees 15 lakh, then please follow special provisions. Correct? Please don't follow that normal provisions. It's a thumb rule. If the income information is given, just see whether the Indian source income is more than 15 lakh. If it is more than 15 lakh, then special provisions need to be followed. Then please check whether this person is an Indian citizen, or a person of Indian origin, and his Indian source income is more than 15 lakh, then please apply the special provisions. What are the special provision, guys? The special provision is that if he is in India for 182 days or more, or second, if it is India for 120 days or more plus 365 in last 4 years. If any of them is satisfied, please make him resident, right? Please don't follow normal provision. It's a thumb rule. I'm again telling you, if the income information is given, see, if in your question there is no income information, then you can go for normal provisions. Then follow normal provisions. Otherwise, please stick on the special provisions only. Got it? Second thing, if any of them is satisfied, that person is a resident. And to determine if he is satisfied by this condition, that he is in India for 182 days or more, then he will become ordinary resident. But if he is not satisfying this condition, but he is satisfying this condition, he will become resident, but not ordinary resident. Everybody is clear on this? Tell me yes or no. Good. Correct. Second thing is, if his Indian source income is more than 15 lakh, and second special provision, if he is an Indian citizen, he should be an Indian citizen only. PIO will not be there in this second special provision. Only Indian citizen is required. So if this person, Indian source income is more than 15 lakh, and he is an Indian citizen, and it is given in the question that he resides in such a country or territory where there is no tax. If they're specifically telling you that he is staying in such a country or territory where there is no tax, even if he has stayed for the entire year, or even if he has stayed for part of the year, doesn't matter. If this point is given to you, then please apply the second special provision and say, if his Indian source income is more than 15 lakh, please tell him that he is a deemed resident. And then please mention that deemed resident is always a not ordinary resident. Got it? So if it is mentioned in the question, see, if it is just mentioned in the question that he is residing in Dubai, and just this point is mentioned that he is residing in Dubai, so please don't use your general knowledge that Dubai is a tax haven, so where there is no tax. No, don't apply your general knowledge. examiner should mention this, that Dubai, he is not paying any taxes, or they are mentioning like this, that he is residing in such a country where there is no taxes, then only please apply this special provision. Now, what is an Indian source income? Indian source income is which has some connection with India. So what is an Indian source income? Any income which arises in India is an Indian source income. Any income which is received in India, it is an Indian source income. Any income which is neither arise nor received, but it is controlled from India. So you have to sum up these three income: arising in India, received in India, controlled from India. And if it is more than 15 lakh, then please apply these special provisions. Now, if the question is silent about the income information is not given, or income information is given, but his Indian source income is not more than 15 lakh, then you have to apply normal provision. So please, I'm telling you, first give the priority to the special provision, then give to normal provision. Correct? So if income information is not given, then apply normal provision. What are the normal provision? You understand, first you will apply the basic conditions. First basic condition is 182 days or more. Second condition is 60 days or more in the previous year. And in last 4 years, 365 or more. Got it? But you understand, this second condition is not applicable for three type of person. If this person is a crew member of Indian ship, is a crew member of Indian ship. Second, if this person is leaving India for employment, he is leaving India for employment. What does this mean? That he is leaving India for employment? It means that he is going outside. Now he will be getting a salary from a foreign employer, or he is now setting up his business or profession outside India. That means he is leaving outside India for his employment. Let's say if you are working with an Indian company, let's say you are working with EY Chennai, and EY Chennai is sending you for few days or few months or few years to work outside, but still you are getting your salary from EY Chennai, then you are not under this exception. You don't went outside India for employment purpose. But if EY Chennai has transferred you to their another branch, let's say EY Chennai has transferred you to another branch to EY New York. Now just ask that who will be giving you salary now? EY New York will be giving you salary. It means that you are going outside for employment. Got it? So if you are the crew member of Indian ship, if the assessee is leaving in India for employment purpose, and when he is leaving during this year he left India for employment during the previous year 24-25. Or the third point is that if he is coming to visit India, generally he stays outside India, but he is coming to visit India. In these three cases, please only apply 182 days condition. 182 days is satisfied resident, 182 days not satisfied non-resident. But please remember, these special exceptions are only for Indian citizen. This third one is also for person of Indian origin, but these two are only for Indian citizen. Third one is for Indian citizen or for PIO. Now, last point over here. Let's say in your question, it is said to you that there is a person, Mr. Ram, and he is a US citizen. He comes to visit India. See, some students make this mistake that he is coming to visit India. But guys, please understand that he is a US citizen. He is Mr. Ram, a US citizen. Whether he will come under this exception? No, because he is not an Indian citizen, not even a person of Indian origin. So in that case, you can apply both these basic conditions. Please apply both these basic conditions. Got it? So you have to make sure that whether you have to apply these two or any one. So you have to make sure that whether this person is falling under the exceptions or not. Second thing is, if he is a non-resident, your question will stop right there. But if this person is a resident, then you have to determine whether ordinary or not ordinary resident, whether ordinary resident or not ordinary resident. And how you determine? Please apply additional conditions. And you all know 730 days in the last 7 years. 730 days. If it is exactly 730 days, then first condition is satisfied. If it is 729, no. Then simply not ordinary resident. Correct? So first is 730 days condition in last 7 years. And second is again, out of last 10, in 2 years, he should be just resident. I'm not saying ordinary, not ordinary, just a resident. He should be just a resident. If both the conditions are satisfied, ordinary, otherwise not ordinary. Got it? Rajalakshmi's question, foreign income transferred to Indian bank account then. See, foreign income is transferred to Indian bank. It is not received in India, Rajalakshmi, it is remittance. So if it is, you have already received the foreign income outside and then you are transferring it, so it is not received in India, it is remittance. Or for remittance, we don't charge anything. Correct? And if it is past income, please don't make it taxable. Okay. Residential status for AOP, BOI company not required, guys. But otherwise, it's very easy. If 100% is controlled from outside India, then non-resident, otherwise resident. This type of thing we have discussed already. Interest, royalty, fees for technical services. Let me quickly discuss this also. See, same provisions are there for interest also, royalty also, fees for technical services also. I'm discussing only for interest income. See, if a non-resident is earning an interest income, if a non-resident is earning an interest income, so it depends that to whom he has given this loan. So if this loan is given to Indian government is paying the interest, Indian government is paying the interest to this non-resident, then 100% always it is taxable. Always this person is liable to pay the taxes. Understood? So I am just talking about that when this person is liable to pay the taxes. So if Indian government is paying him interest, this person is liable to pay the taxes. Now, Indian government is not that important, but these two are a little bit important. Let's say this is a non-resident. I used to give this example. Let's say this is Paul. He lives in New York. He lives in New York and he has given the money to us. We are resident. Let's say we are a resident. I am a resident and he has given this money to me. So he has given this money to me, Rajat. And if I am using this money in my Indian business, if I am using this money in my Indian business, this is called direct investment, then 100% whenever I'll be paying this interest to this person, this interest income he is deemed to arise in India, this person has to pay tax in India. So if he has given this money to a resident and this resident is using in Indian business, but if I am using this money in US business, UK business, Australia business, then it is not liable. Correct? So I'm using this money in my Indian business, or indirectly I have invested in India. Indirectly, I have made an indirect investment in India. But yes, it is in India. What does it mean? That I have purchased some shares of Indian company, I have purchased some debentures of Indian company. Then also, whenever I'll be paying him interest, this interest is deemed to arise in India. It will be false income. I believe everybody is clear on this point also. Are you all okay with this? Resident? So resident, whether he's using this money directly in India or he's using this money indirectly in India, then also this interest is taxable. If a non-resident is using this money, if a non-resident, this Paul has given this money to Alex. Paul has given this money to Alex. Alex is a non-resident. And if this Alex, only if he is directly using in an Indian business, whose Indian business? Alex Indian business. Then only whenever Alex would be paying interest, to Paul, in that case, Paul would be liable to pay tax in India. That income is deemed to arise in India. But if Alex is using this money in indirect investment in India, whether he has purchased some Reliance shares or Tata shares, no, in that case, this income would not be taxable in his hands. So please understand that where the money is being used. Same is for royalty. If we are paying royalty to this person, let's say we are paying royalty to Paul. So you should understand that where this copyright, where this patent is being used, if it is used in India, then he is liable to pay tax in India. His income is deemed to arise in India. But if I am using that royalty, patent, copyright outside India, then this income, he would not be liable to pay tax. So this also you should remember. This was in residential status. Everybody okay with this residential status? I'll be pausing here for 10-20 seconds. If anybody has any question regarding residential status, please ask. Let me quickly run through you. Residential status of individual. These are the normal conditions. But first of all, please try to implement the special provision. So if the Indian source income is exceeding 15 lakh, excluding foreign sources, means Indian source income. And if this person is an Indian citizen, PIO coming to visit India, 182 days, 120 days in this year, plus 365 days in the last 4 years. If anyone is satisfied, then resident. If this is satisfied, ordinary. If this is satisfied, then not ordinary resident. If he is not even coming to India, but he's residing in such a country or territory where he is not liable to pay any taxes, then he's always a deemed resident, and such deemed resident is always not ordinary. If his income information is not given, or if the Indian source income is not exceeding 15 lakh, then please apply these normal provisions. Got it? Normal provision, and the 60 days condition would not be applicable for these three type of people. You all know what are the exceptions. If any of this condition is satisfied, this will become a resident person. And for resident, then you have to check the additional condition, 730 days in last 7 years. Out of 10, at least in 2 years, he should be a resident. Got it? Now, Harish, correct. For deemed resident, number of days does not matter. For deemed resident, if in your question somewhere it is mentioned, that he is residing in such a country or territory where there is no tax, whether he is residing for the entire year, whether he is residing in part of the year, and his total income is more than 15 lakh, simply follow this provision. Correct? Okay. Let us start with salary. Should I start with salary or PGBP? Okay. mix, but still most of the people are saying salary. So let us do with salary. No problem. Let us do with salary. I would be spending around, let's say 50-55 minutes on salary, right? Then we'll come to house. House property will not take that much time. Then we'll come to PGBP. After salary and house property, we'll take a short break for 15 minutes. Then we'll do PGBP after the break, right? So you will be even refresh after the break. So then we'll start with PGBP. So let us start with salary first. See, whenever the question will, there are not 100% chances that salary question will come. But if salary question comes, guys, always, whenever the salary question comes, always please try to make a list of all the things which we are getting from our employer. So whether it is taxable or not taxable doesn't matter. Whether it is taxable, not taxable doesn't matter. Please always make the list. First of all, it is basic salary. Let's say basic salary is there. Some allowances are there. Some perquisites are there. Some retirement benefits are there. Please make the list of all these things. Whether they are allowances, whether they are perquisites, whether they are taxable or not, doesn't matter. First, make the list of all these things. Now, once you have made the list, then you need to determine whether it is taxable, whether it is exempt or not. So whatever is taxable, please write it over here. Whatever is taxable, you understand basic salary, DA, etc. These are fully taxable. So whatever is taxable, please write in this column. Write in this column. No need to make the columns also, but write on this right hand side whatever is the taxable amount. Let's say if there is any allowances which is exempt, then please write it dash over there. But if it is taxable, then write whatever amount is taxable. So once you have done this, Sum it up, you will get gross salary. You will get gross salary. From gross salary, one deduction will always be there. That is called standard deduction. So from gross salary, standard deduction you have to give. And we all know that in optional regime, it is 50,000, but in default regime, it is 75,000. So please don't make a mistake over here. In default regime, it is 75,000. In optional regime, it is 50,000. This deduction you have to always give. Always give. Sometimes question comes that is not of salary. It could be a question of, let's say, set off, or it could be a total income question, where directly they give you that this is the salary income. This is the salary income. In that case, if they give you that this is the direct salary income, let's say they are telling us that 7 lakh is the salary income. Now, whether we have to give standard deduction from this 7 lakh rupees or not. So generally it depends that how the question is written. So if it is directly written that this is a salary income, 7 lakh rupees. So always assume that it is a computed income. Always assume that it is a computed income. Guys, this point I'm not telling for the chapter of salary. I'm telling you for total income question or mainly set off and carry forward of question. So whenever they give you this is a salary income, so you should always assume that it is computed. Computed means that already standard deduction, other deductions has already been given. Correct? But if they will tell you, that this is salary per month, let's say it is another question. It is not of salary question. Let's say it is PGBP or house property or total income question, but 1 or 2 points are given for salary also. And if they give you that this is the salary received, rupees 7 lakh, salary received 7 lakh, or they are telling you that salary per month is, let's say, 70,000 per month. Please tell me what you will do over here. Please, you tell me what you will do here. If they are giving you these words, salary received 7 lakh or salary per month is 70,000 per month, then please, whether you will give standard deduction, yes or no. Whether you will give standard deduction or not, the answer is yes. Very good. Because it is the salary received. So this is not computed. This is the salary which we have received, 7 lakh. Or salary per month, this is again that we have received. So it means that here you have to give the standard deduction. Correct? But if they are directly giving you that this is the salary income is always signifying that it is a computed income. Please don't give standard deduction. So if somebody has a doubt over here, Ganesh, salary earned is also good here. Salary earned is also in received only. If it is salary earned, it means that salary received. Correct? If they are using this word salary income, then always assume computed. And guys, also it would be good practice that please write over there, it is assumed as if it is computed. Here, it is assumed, just write in bracket, assumed as if it is a computed income after standard deduction. Correct? Okay. Now, let us come to the main question of salary. So I was telling you that whatever the income which you are getting from an employer, make the list of it. Whatever is taxable, write it over here. If it is exempt, write dash or exempt. Sum it up, gross salary. From gross salary, standard deduction should be given. If you are following default regime, then only one deduction, that is standard deduction, is given. If you are following optional regime, so there could be other deductions also under section 16, that is tax on employment or entertainment allowance, that I'll be discussing after a few minutes. So let us discuss about each type of things one by one. First of all, there are certain components of salary. Now I am discussing that what amount is taxable, right? So for next 30 minutes, I will be discussing about these things, that how much you should make it taxable. Basic salary is always fully taxable. Basic salary, there are few components. Basic salary, you can write it somewhere. Basic salary, DNS allowance, bonus, commission or fees. whenever you will come across these points, basic salary, DNS allowance, bonus, commission, please make it fully taxable. Please make it fully taxable. Sometimes, or most of the times, you get this, that this is the DA, 70% forming part, 80% forming part, 50% forming part. Right now, that forming part is not relevant for me. Right now, that forming part is not relevant for me. Whatever is the DA, please make it fully taxable. Whatever is the DA, please make it fully taxable. Got it? So whatever is it, that forming part will play a role in computing certain allowances, in computing certain perquisites, in computing certain retirement benefits. So that forming part will not play any role right here. So when you are making DA taxable, so whatever is your DA, please make it taxable. Got it? Also, please don't make this mistake, because this is a silly mistake which some students make. Also, when you read your question, and mostly when the entire question is dedicated to salary, so mostly it is seen that they give like this, that this person has worked for 10 months, he has resigned or he has retired after that. So let's say this person has worked for 10 months, 9 months, 8 months, 11 months. Please take all these components only for that period. So some students make this mistake that they just keep on multiplying everything by 12. So don't make this mistake. Please read your question carefully when the assessee has joined the company, when the assessee has left the company. So if in your question there is such information, please proceed accordingly. Got it? Basic salary, DNS allowance, bonus, commission, and fees, these are fully taxable. Whether it is fixed commission per month, whether it is commission based on turnover, based on any other thing, doesn't matter. Right now, please make commission fully taxable. Whatever is the kind of commission, please make it taxable. Got it? Now, let me talk about allowances. Guys, allowances are part of salary. And generally they are taxable. Allowances are part of salary and generally they are taxable. In default regime, if I talk about allowances, what is the difference in default regime and optional regime? Guys, in default regime and optional regime, if these are personal allowances, then they are fully taxable. If they are personal allowances, then they are fully taxable. If anybody is unmute, please mute yourself, guys. Okay. If they are personal allowances, these are fully taxable. But there are few personal allowances which are sometimes can be exempt in optional regime. Only few allowances like HRA, children education allowance, hostel allowances, and so on. Only few allowances are there which could be little bit exempt. Otherwise, personal allowances are fully taxable. Now, how you will determine that what are personal allowances, what are official allowances? See, the thumb rule is that whatever the money which you can take home, which is your money, which is employee's money, whatever the money which that employee can take home, it is their money, that is a personal allowances. Understood? That is a personal allowance. Let's say it is a servant allowance. So servant allowance we can take home. It is overtime allowance. Although we have worked extra, but that money we can take home. That is called personal allowances. So all personal allowances should be taxable. In optional regime also, they are taxable, but only few personal allowances are exempt that I'll be discussing after 2-3 minutes. If it is official allowances, in optional regime, they are exempt. Correct? Because why? Because they are for official purpose. In default regime also, mostly they are exempt. Question will not come on this, but yes, mostly they are exempt. See, what are the official allowances? Let's say traveling allowances. You are going outside for official purpose. Or it is conveyance allowances. You are going for official purpose. So this is exempt allowances. These are not taxable allowances. These are exempt allowances, but personal allowances are something which are fully taxable. So let me, traveling allowance, conveyance allowance, daily allowance. These are something which is official purpose. These are exempt allowances, but personal allowances, cash, lunch, medical, overtime, etc. These all are medical allowance. I'm not talking about medical facilities. These are medical allowances. These are part of your salary. They're coming up with your salary. So these are fully taxable. These are fully taxable. But yes, there are some personal allowances which are exempt up to a certain limit in optional regime. HRA, children education allowance, hostel allowance, transport allowance. Let me talk about transport allowance. What is transport allowance? Transport allowance is when a person travels from his home to office and then he comes back. So transport allowance is a personal allowance because the assessee is going to the office and then he's coming back to his home. So this is something the personal obligation of the person. Correct. So this is a transport allowance, personal allowances. Generally, they are taxable under both the regime. See, for transport allowance, the treatment is same under both the regimes. Both the regimes, the treatment is same. Transport allowance generally make it taxable. Optional regime make it taxable. Default regime make it taxable. But if the assessee is physically handicapped, deaf, blind or dumb, then up till 3,200 per month can be exempt. Up to 3,200 per month. So please, this also, you should remember this thing. It is same under both the regimes. Children education allowance, hostel allowances, up to 2 child, they are exempt. So children education allowances is exempt 100 per month per child, up to 2 child. So please, in this case, please remember, see, if it is default regime, they are fully taxable. But in optional regime, it is exempt up to 100 rupees per month per child. In that case, if the question is telling you that there are 3 children, so please try to make a little bit rough working. Say if there are 3 children, for 1 children, how much we are getting, for second children, how much we are getting, for third children, how much we are getting. Only for first child or second child, it could be any 2 although, but just for maximum 2 children, make it exempt up to 100 rupees. For third one, make it fully taxable. So I believe everybody will be able to do this also. Children education allowance is 100 rupees per month. Hostel allowance is 300 rupees per month. Now about house rent allowance. Guys, house rent allowance, if it is default regime, please make it fully taxable. If it is optional regime, then it is whatever is the house rent allowance which you are getting. First of all, write that. So let's say this assessee is getting house rent allowance, for example, 10,000 per month. Correct. So 10,000 into 12. For example, in your question, it is given that this person has resigned in last month. So in that case, let's say we have to calculate for 11 months. So if nothing is mentioned, then please calculate for 12 months. If it is mentioned that this person has resigned or he has joined late, so how much, whatever is the amount of months which we are getting, please multiply it accordingly. So first of all, whether it is 11 months, 12 months, doesn't matter. So first of all, please, I would like to mention is that, first of all, just understand that how much HRA is received. How much HRA is received. If it is default regime, make it fully taxable. If it is optional regime, then please exempt least of the following. Out of received, so let's say we are getting 1,10,000. Out of this received, A, B, C, whichever is lower, make it exempt. Whichever is lower, make it exempt. Let's say whichever is lower comes to rupees 1 lakh. Let's say whichever is lower comes to rupees 1 lakh. So it means that 1 lakh is exempt and 10,000 would be taxable. 110 minus 10, 10,000 would be taxable. That is only under optional regime. In default regime, please make it entire 1,10,000 taxable. Now you should remember that what are these limits? A, B, C, what are these limits? These limits are actual HRA. First A point is actual HRA, whatever the HRA you are getting. Second point is rent paid. This is B point. Rent paid minus 10% of salary. Third point is 40% of the salary, or in some cases, if the assessee is paying rent in Delhi, Mumbai, Kolkata or Chennai, then 50% of the salary in Delhi, Mumbai, Kolkata and Chennai. So 40% or 50% of salary. Here, what are the components of salary? Here the component of salary is basic salary, DA forming part, plus fixed percentage commission on turnover. I'm again telling you here the component of salary means RBS salary, that we call it RBS salary because it is used at many places. It is used at many places. It is used in gratuity also. It is used in provident fund also. It is used in leave salary also. So that is the reason I'm calling it RBS salary, retirement benefit salary. So RBS salary, how much is the RBS salary? Basic salary plus DA forming part plus fixed percentage commission on turnover. Now, guys, if let's say there is a change in HRA during the year, if let's say there is a change in HRA for let's say for first 5 months we are getting whatever is the HRA, for after 5 months, let's say for next 7 months we are getting a different HRA. So you have to compute these limit accordingly. So whenever you will be computing that how much HRA would be taxable, so first 5 months, let's say there is a change after 5 months. So first 5 months computed separately. For next 7 months, compute it separately. Whatever is the taxable amount, make it taxable. Don't do it in a cumulative way. Don't do it in for entire 12 months. If there is a change in HRA, if there is a change in any of the component, let's say there is a change in rent paid, there is a change in rent paid, there is a change in basic salary. If on any of the component there is a change, please split your calculations. Everybody understood that you have to split your calculations? Tell me yes or no, first of all over here. Everybody understood that you have to split your calculations if there is any change, right? HRA. Now, not very important from examination point of view, but yes, if it comes, do it accordingly. In default regime, make it fully taxable. Okay. Guys, deductions under section 16. What are the deduction when you will be calculating your total? Let me, in fact, before deduction, let me talk about perquisites. Some important perquisites. In fact, rent-free accommodation, motor car perquisite, interest on loan, or use of assets. These are some important perquisites. You should know about that. Let me talk about rent-free accommodation. These perquisites calculation is same under, generally perquisites are same under default and optional regime. So don't have to worry about it. If how you will be computing your rent-free accommodation. So let's say if it is given to you that accommodation is also provided to the assessee. See, very less chances, even 99% chances are there that they will be telling you about non-government employee. 1% chances are there they will be telling you about government employee, that this assessee is a government employee. So if this assessee is a government employee, then calculation becomes very easy. If they will be telling you that this assessee is a government employee, they will be also providing you with the license fees. So now my calculation will become very easy. So whatever is the license fees, that is the perquisite. So whatever is the license fees, so they will be mentioning it to you. So now, right now, I'm not explaining you what is license fees. And so in your question, they will be giving you this is the license fees. So whatever is the license fees, let's say the license fees is 1,000 rupees per month. So my perquisite will become, let's say it is for entire year, 1,000 into 12. I believe no issues on this license fees. So only 1% chances are there that they will say that this person is a government employee. 99% chances are there that they will say that this person is a non-government employee, that he's working with, let's say, Reliance, he's working with EY, he's working with PwC, any other company, ABC Private Limited or XYZ Limited. He's not a government employee. In that case, it is important that whether the house is owned by the employer or hired by the employer. Now, if he is a non-government employee, which is 99% of the chances, and if the question is silent, please always assume that this person is a non-government employee. Even if the question is silent, non-government employee. Guys, what I'm telling you about rent-free accommodation. Okay. Now, he's a non-government employee. So if this house is owned by the employer, whether it is owned by the employer or it is hired by the employer, correct? If it is hired by the employer, it becomes very easy. If it is hired by the employer, it becomes very easy. The perquisite value would be your actual hire charges, your actual rent, whatever is the employer is paying, actual hire charges, or B is 10% of salary. B is 10% of salary. whichever is lower. Guys, here population does not matter. Population is only the criteria which you have to see in case of owned by the employer. In case of hired, sometimes examiner will again test you. They will give you that this house is hired by the employer, and they will also give you the population also. Please don't get trapped over there. That population criteria does not matter in hired cases. If this is hired by the employer, then actual hire charges or 10% of the salary, whichever is lower, that's it. What is the meaning of salary? I'll be discussing it. Now, if it is owned by the employer, then it depends on the population, that how much is the population of that city where this accommodation is provided. So if the population of that city is up till 15 lakh, so this you should remember, if it is up till 15 lakh, it's a very small city where the accommodation is provided, then 5% of the salary. I have written RFA salary, but as of now, 5% of salary. If it is more than 15 lakh, up to 40. So please remember 15 and 40. 15 and 40 only you should remember. So if it is less than 15 lakh, 5%. If it is more than 15 lakh, up till 40 lakh, 7.5. There's a gap of 2.5, 2.5, 5, 7.5, 10. And if it is more than 40 lakh, then 10% of the salary. Now, if the question is silent about the population, they are saying that the house is owned by the employer, we need the population. And if the question is silent about the population, then please assume the population. In that case, you have to assume the population. I would recommend, please assume more than 40 lakh, right? Please assume more than 40 lakh. Generally, 99% of the cases, they will tell you that what is the population of that city. In that case, if it is not mentioning it, but you need the population, then please assume. And my recommendation is assume more than 40 lakh rupees. So sorry, the number of people, 40 lakh, more than 40 lakh. Okay. Now, what is salary over here? 10% of salary, 5%, 7.5%, 10% of salary. What is the meaning of salary over here? Guys, here, the meaning of salary is very, very easy. In rent-free accommodation, just exclude, I'm giving you a shortcut, just exclude perquisite, just exclude retirement benefits, and include everything. What is the meaning of salary over here? Basic salary. DA only which forms part. So one important point is only that DA which forms part of retirement benefit. DA, if it forms part of retirement benefits, then you have to add it. Otherwise, see, generally, DA does not form part of retirement benefit. Here also, this point is important. Please don't make a mistake over here. Guys, I have told you about, let's say, let me give you an example. See, let's say there is a question. It is given that basic salary of the assessee is 50,000 per month. DA is 20,000 per month. Let's say his other allowance, let's say servant allowance is 10,000 per month. And let's say he's getting a rent-free accommodation also, he is getting a motor car facility also. Correct? Now, how you should do this question? First of all, when you will be presenting it in your examination, I told you that you have to make the list of all the things. So first of all, make the list of all the things: basic salary, dearness allowance, servant allowance, right? Rent-free accommodation, motor car facility. Correct? Basic salary, you know, it is fully taxable. DA, you know, 20,000 rupees, it is fully taxable. Other allowances, you all know that mostly they are fully taxable. So this is also taxable. Now you are computing your RFA. I would suggest you to please compute your RFA at the last. At last, you should compute your RFA. So let's say you have computed your motor car facility also. So whatever is the amount of motor car facility, you have written it over here. Now you have to compute RFA. So let's say this RFA is owned by the employer and in a city where the population is more than 40 lakh. Correct? Let's say 42 lakh, 43 lakh. Now you have to compute 10% of salary. You have to compute 10% of salary. 10% of salary means RFA salary. So I have given you a shortcut. that generally, whenever you compute your 10% of salary, here salary does not include perquisite. So wherever you are seeing perquisite, please don't include it. So while computing this value, if there is any perquisite, so here you find that motor car is a perquisite. Please don't include this while calculating this 10%. Correct? Don't include your perquisites. If there is any retirement benefit, what kind of retirement benefit is there? There could be gratuity, there could be pension, there could be any other thing. So please don't include that here also. So please don't include in RFA salary, don't include your perquisites, do not include your retirement benefits. Got it? Important point is that DA, allowances should be included over here. Allowances should be included over here. What about DA? DA you have to include only if it forms part of retirement benefit, right? So while computing your RFA perquisite, only include that DA if it forms part of retirement benefit. I'm writing the word if. And if the question is silent that how much DA forms part, it means that DA does not form part of retirement benefit. So while computing your perquisite, what amount of DA you will take into consideration? No, please don't take it. Why? Because it is not mentioned in the question that how much DA forms part. It means that DA does not form part. DA is taxable there. I'm not talking about this. I'm not talking about this. DA is taxable over here, entire 20,000 into 12. I'm not talking about this. Guys, I'm talking about this RFA. When I'll be computing this RFA, please only take that DA which forms part of retirement benefit. If the question is silent about how much DA forms part of retirement benefit, please don't take it while computing your RFA. Have you understood this or not? I know that I'm a little quick today, but have you understood this or not? Good. Good. Okay. Now, see, RFA salary, basic salary, DA only if it forms part. Other allowances you can all take, all taxable portion of allowances you can take, bonus you can take, commission you can take, everything you can take, but please don't exclude perquisite, do not include perquisites, and also do not include retirement benefits. Do not include retirement benefits also. Correct. This is again very important. Let's say the assessee is working simultaneously with two employers, A Limited, B Limited, and he's getting RFA only from A Limited. So in that case, you have to take the salary of B Limited also for that particular period. So simultaneously, if he's working with more than two employers, please take the salary also of both the employers. See, again, I'm actually spending a little bit more time on this RFA because this is a little bit important. Let's say if there is an assessee who is working with A Limited from April to till March 25, and he's simultaneously working with B Limited from April till March 25. I'm using the word simultaneously. He's working here also. So if he is getting RFA from A Limited, when you will be taking 10% of salary, 5% of salary, 7.5% of the salary, as the case may be, please take 10% of salary of both the employer. Correct. But let's say if this person is working with A Limited from April till, let's say, July 25, he's working with July 25, and B Limited he has joined from August 25. So is he simultaneously getting salary from both the employers? No. First he was working with one company, then he left that company, he joined another company. Then in that case, RFA, you will be taking, first of all, he's getting RFA from A Limited, then only you have to take RFA for April, May, June, July. That is for 4 months only. In that case, only this would be included, not this. So I am telling you that if they are simultaneously working with both the employers, then please take both the employer salary while computing this perquisite. Now, commission, commission, Ritika, you have to take commission of all, whether it is fixed on percentage, whether it is fixed on per month, doesn't matter. Here the entire commission needs to be considered, entire commission. So here entire, only in RBS salary, retirement benefit salary, commission, if it is fixed in percentage on turnover, then only you have to take. But here in RFA, you have to take entire commission. Correct? Now, Guys, if it is hotel, you are staying in a hotel, then you have to take actual hotel charges or 24% of RFA salary. This can come in MCQ. Please remember this 24% also. Correct? Now, a important point. This can also come. I'm expecting that this can also come in exam tomorrow. It is just my expectation that this can also come. It is easy, guys. See, what happens is, let's say the employee, this is previous year, 23-24. Correct? And this is Mr. A. He's working with Tata Limited. He's working with Tata Limited. And Tata Limited has provided him RFA. In last year, his RFA value comes to rupees 1 lakh. His last year RFA value comes to rupees 1 lakh. Now, in this year also, in previous year 24-25, he is working with the same employer, same houses being continued this year also. Obviously, this person is continuing his job next year also. Same company, same houses being continued over there. But his salary has increased so much because his salary can increase. And now you are computing his RFA. And let's say because his salary is increased and 10% of salary, whatever you have taken, because of that, the RFA is coming to 1.4 lakh, let's say. Correct? Now, whether the RFA perquisite value is 1.4 lakh, the answer is here you need to check one more thing. Now, the provision is that if the same house where you are living in last year is being continued next year also, in that case, your RFA value should not exceed the indexed value of this. So what you need to do is, you have to take A, what is the RFA which you computed? 1.4 lakh. 1.4 lakh. And B, you have to take the indexed value, whichever is lower. And how you will be taking the index value, that is very, very easy. The same thing which you used to do in capital gain. CII of the year, of the current year, CII of the current year, this year, 360, let's say 363, they will give you the CII, 363, divided by CII of the year in which it is first provided. CII of the year in which it is first provided. Let's say it was provided last year. So let's say, for example, I don't know what is the last year CII. Let's say it was 330, I believe 348. 363 divided by 348 into the value of the last year. You have to index the value which is of the first year. So let's say it was, because this was the amendment which came last year. So maximum they can go to last year. So let's say last year value was 1 lakh. So 363 divided by 348. 363 divided by 348 into 1 lakh. So it is coming as 1,04,310. Right? So in this case, your computation was telling you 1,40,000 because his salary is increased. So your computation is telling you, let's say you have taken 10% of salary, 140. But they are saying, because this is the amendment which came last year, and it has an effect for this in this year. So this is quite an important thing. So I'm expecting that they can ask you this. So please take, if they have given you, so please apply this particular point only when they have given you the RFA. So I'm trying to say that you will easily be able to identify that whether you have to calculate by this way or not. How? They will be giving you some points. They will be giving you CII. In salary question, they will be giving you CII. Right? CII of this year, CII of last year. They will be also be giving you RFA value of the last year. So please take the indexed value also and compare A or B, whichever is lower. So this year RFA would be whichever is lower, 1,04,310. Have you all understood this or not?
That's right.
Very good. So Andrim, last year, same way. See, in capital gain also you do the same thing, na? CI of the year of transfer divided by CI of the year of acquisition into cost of the acquisition. It means the CI into 1 lakh. When you will be multiplying it by, so it should not be 1.4. You are indexing this value. Sundaram understood? You are indexing this value. So it would be 363, let's say divided by 348 into this value, 1 lakh, not this value. You are indexing this value. So I believe you got it. Very good. So this was important. Okay. Car perquisite is not that difficult. See if car is provided by the employer. So now, first of all, whenever you will be doing your car perquisite, first of all, understand that whose car it is. Is it provided by the employer or it is employee's car? Generally, 90% in your examination, they will tell you that it is employer car. If it is 100% used for personal purpose, so everything is perquisite. See, what is your income? Your income is, if it is being given to you for 100% personal purpose, then you have to take whatever the expenses which the employer is incurring for on this particular car. So his fuel expenses, maintenance expenses, driver salary, if he has provided the driver also, then take the entire driver salary also. Plus he is providing you the car also. So the car value should also be taken. And guys, again, important thing is that whenever the assets are given to you for use, generally, please remember this percentage. At least till tomorrow, remember this, that whenever the assets are given to you for use, and if they are owned by employer, then you have to take 10% per annum, 10% per annum of original cost. If they are owned by the employer. Well, let's say the employer has given to you, but it is not owned by the employer. They have taken it on hire and they are giving it to you, or you have to take actual hire charges. Whichever is lower, no, as the case may be. So if they are hired, then you have to take actual hire charges. If they are owned by the employer, then you have to take 10% per annum. What does per annum means? Let's say if it has been given to you for 10 months, then 10% divided by 12 into 10% into 10 by 12 you have to do. It is 10% per annum of original cost. Original cost, you understand. Guys, this thing will be same for car also. Whenever the car is provided to you, or any other asset is also provided to you. Any other asset is also provided to you. It is same. 10% per annum of the actual cost if it is owned by the employer. Even let's say furniture is also provided to you, any other thing is also provided to, except computers or laptops. See, if computer or laptop is provided to you, then it is tax-free perquisite. It is tax-free perquisite. But for any other assets, it is 10% per annum of actual cost or actual hire charges, as the case may be. Understood? So if the car is provided to you and you are using for 100% purpose, so whatever the employer is incurring the expenses, maintenance expenses, fuel expenses, driver salary, plus 10% of the original cost or higher charges, as the case may be, this will become your perquisite. So this is quite easy. Please do remember, if it is 100% personal, then everything which the employer is incurring will become your perquisite. And don't forget to add 10% of the actual cost of the car or higher charges, as the case may be. And if you are paying back some money, then you can subtract that. If you are paying back some money. This is important. Car is provided by the employer. And it is partly personal and partly official purpose. In that case, you have to see whether it is a big car or a small car. And how you will see 1.6 liter cc. Up to 1.6 liter cc is a small car. Then you should please remember these particular amount. If it is a small car, 1800 per month. And if it is a big car, 2400 per month. And it is fixed amount. Small car 1800 per month, big car 2400 per month. Guys, generally this comes in examination, but at a very easy level. So generally examiner gives a small car. So please take 1800 into, let's say it is 12 months, 1800 into 12. If it is 10 months, into 10 months. Correct? And if it is a part of the month, then you have to ignore. So if it is for 11 months, 10 days, 11 months, 20 days, so that part of the month, please ignore. Only completed months you have to take. Got it? Then one mistake which students does is over here is that if any, let's say if it's a small car, it is given by the employer partly for official, partly for personal purpose. We remember it is 1800 per month. But this mistake students make, that let's say examiner gives you that some amount is recovered from the employee. Let's say 300 rupees is recovered from the employee. Do not subtract this 300 rupees, 400, 500, whatever it is. Please do not subtract any recovery. This amount is fixed. This amount is fixed. Whether you are taking 1800, 2400 for the big car, this amount is fixed. Even any recovery should not be subtracted. Please remember this. Second, if it is partly used for personal, partly for official, it is employer car or employer has provided it, but the expenses are met by employee. The car is of the employer or he has arranged this car for us, but my running expenses, the employee is incurring. In that case, not so important. In that case, not so important, but please remember, here also it is a fixed perquisite. Small car 600, big car 900. Please just look at it for 5-10 seconds and please try to remember these amount also. Any doubt on these amounts? Anybody has? Let me know. Part of the month shall be ignored. And if driver is also provided, please add 900 per month here. Everywhere 900 per month will be added. Here also 900 per month will be added. Here also 900 per month will be added if the driver or chauffeur is also provided. Everybody understood it? This point is not that important. Let's say if 2 cars are provided to you, let's say 2 or 3 cars are provided to you, and they are saying all these cars are partly personal, partly official. See, we are an employee. For official purpose, we will be going in only 1 car, right? So if let's say 2 cars are provided or 3 cars are provided, partly personal, partly official, then only 1 car is considered as partly used. All other cars are used at 100% personal. Very, very rare chances they will not ask this. Very, very rare chances, right? So if they are saying this is also partly used, this is also partly used, we will say no. We will take only 1 car. Any car which has a lower perquisite, we will take it. This question is very rare. We will get this. We will not get this. Next is car owned by the employee. The next point is not so important, but still let us do this. So we never know if they ask you. So if this car is owned by the employee, it's our car. So if it's our car, and generally it should not be a perquisite. Why? Because it is our car. But if the employer is actually paying some expenses, the employer is paying us petrol expenses, fuel expenses. In that case, because the employer is paying us this money, it will become a perquisite. So it is our car. And if it is 100% use, it is 100% personal use. So whatever the money, let's say he is paying us. So please don't learn it. Understand with logic that let's say it is my car. I'm an employee and I'm using it for my personal purpose. But the employer is giving me 2000 rupees per month as a petrol. That Rajat, keep this money. It is for your petrol purpose. Use it for 100% personal purpose. So that is my perquisite. So because car is mine, but petrol expenses he is paying to me. So whatever the expenses he is paying to me, that will become the perquisite. And if I am paying something back to him, let's say he's paying me 2000 rupees per month as petrol or something, and he's recovering from me 500 rupees, 600 rupees. So whatever is recovered should be subtracted. Guys, whenever it's a thumb rule that anything which is recovered from the employee should be subtracted, exception is this. Here you will not subtract anything. But from every other perquisite, any other perquisite, if you ask me, anything which is recovered should be subtracted. Got it? Shivani, yes. 1800 would be the taxable perquisite. How you will get it? I'll tell you that how you will get it. Let me take the example of this one. Everybody look at this. Basic salary, DA, servant allowance, rent-free accommodation, motor car facility. So generally they will give you, Shivani and everybody, they will give you that a car is provided to you. So let's say they are telling you that a car of 1650 cc, 1615 cc liter is or 1.65, that is a big car. Up till 1.6, if it is exactly 1.6 liter or 1600 cc, whatever it is, 1.6 liter, it is a small car. Exceeding 1.6 is a big car. So it is, let's say 1.65 liter cc engine. It's a motor car. And they are saying it is provided by the employer. Now the question will become silent. It is provided by the employer. So you understand it's a big car. It is provided by the employer. So we'll assume that all the expenses are also met by the employer. So we will take 2400 into 12. So whatever is 2400 into 12, 28,800 will become your perquisite value. Shivani, clear? 2400 per month will be your taxable value. If they were saying that rupees 300 per month is recovered from the employee, please don't subtract this recovery. This is an exception. Generally, I'm telling you from all the perquisites, subtract the recovery. But from this, do not subtract the recovery. Got it? Now, the car is owned by the employee. It is for 100% personal purpose. All the expenses which the employer is incurring will become our perquisite. But if this car is partly used, so whatever the expenses which the company is incurring will become the perquisite. But we will subtract, there is a fixed amount, we'll subtract 1800 or 25,400, whatever is the type of car is. So whatever the expenses which the company is incurring will become the perquisite. But after reducing from there, it's a small car, please reduce 1800 for every month. Part of the month should be ignored, or 2400 if it's a big car. And you will hardly get this. You will hardly get this, but still if you will get this. So whatever, because it is your employee car. So whatever the employer is giving the money. See, please understand the logic. If it is your car, Shivani, let's say it is your car. So mostly you will be using it for your personal purpose. Very few times you will be using it for official. Correct now? So 99% I'm telling you that you will be using it for personal purpose, because you will say, no, boss, it is my car. So why I should use for official purpose? I'll use it for my personal purpose. So that is the reason. Please apply your logic. So whatever the company is giving us to us, let's say they are giving you 5,000, 4,000, 7,000 rupees per month as a petrol expenses. Mostly you will be using it for personal purpose because it is your car. So that will become your perquisite. So whatever the expenses which are met by the employer will become the perquisite, minus, because it is partly used. So the amount which the company is giving to us, why they might be giving it to us? Because they want you to use your car for official purpose also. So you will subtract 1800 per month. And if it is a driver also, so 1800 plus 900, you will subtract this 2700. Got it? If it is a big car, please subtract 2400. And if it's a driver also, 2400 plus 900, 3,300. Please subtract 3,300 per month. In that case, if there is no driver, only 2,400. Everybody understood this also? Can you subtract a higher amount also? If you say, let's say Shivani is saying, no, sir, although it is my car and the company is giving me 10,000 rupees per month, company is giving me 10,000 per month as petrol expenses, but company is so clever. Most of the time I'm using my car for official purpose. Most of the time I'm using my car for official purpose. I don't want to subtract 1800, sir. I actually want to subtract a higher amount. So if you are maintaining records, you can subtract higher amount also. But generally that will not come. Up to that level, it will not come. Understood? Everybody's okay with this? Guys, sweat equity shares. For sweat equity shares, you all know it is quite important. So what you sweat equity shares, whatever is the fair market value on the date of allotment of shares or exercise of the option. Please tell me which date you will take. Let's say you are being provided, let's say it is given that the assessee is provided with 100 shares. 100 shares of Tata Limited, Tata Motors Limited. So the day the offer date price is given, let's say 400. The exercise price is given, let's say 450. And let's say allotment price is given 480. Please take this price. Exercise date price should be taken. So whatever is the fair market value on the exercise date, that will become a perquisite. So exercise date value is 450 into 100, that will become the perquisite if it is given free of to you. But let's say the company is saying, okay, you can take the sweat equity shares, but we will take 100 rupees from you. So you can purchase our share for 100 rupees. Okay. So in that case, how much is the perquisite? 450 minus 100. 350 per share is the perquisite into number of shares. That will become your perquisite value. Sweat equity shares is an important perquisite. Interest-free or concessional loan is an important perquisite. See, if the loan is up till 20,000 rupees, this is an important thing. please remember, if the loan is, let's say, please don't make it taxable. If the loan is up till 20,000 rupees, even exactly 20,000, that is called petty loan. If it is a petty loan, please don't make it taxable. Got it? But if it is more than 20,000 rupees, then it will make, please make it taxable. Second thing is that two types of loan are exempt. Please don't make it a taxable perquisite. If it is a petty loan, not more than 20,000 rupees, exempt. If it is more than 20,000 rupees, but it is for medical purpose, if it is for medical treatment purpose, then also make it exempt. So if in your question they are mentioning you, if it is the amount of loan is up till 20,000, make the perquisite value as 0. If it is more than 20, but they are actually telling you that it is for medical treatment purpose, make it again perquisite value 0. Don't make it taxable. But if this type of thing is not mentioned in the question, then make it taxable. So how much is the taxable amount, guys, for loan amount? So whatever is the interest which you save, that will become the perquisite. What is the meaning of interest save? So here you will see that how much is the bank charge for the similar loan. So what is the bank rate? Generally we take SBI rate, but please, for examination purpose, just remember the bank rate. So whatever is the bank rate of that loan. So let's say the bank rate of the loan is 12% per annum, and your employer is charging from you, let's say 3% per annum. So how much you are saving? You are saving 9% per annum. So 9% per annum is the interest save. So please remember that whatever is the interest save, that will become the perquisite. Let's say the loan is for rupees 10 lakh. The loan is for rupees 10 lakh. So how much the benefit which you are getting? You are getting a benefit of 9%. How? Because the SBI rate would be 12%. Your company is charging 3% from you. So 9% you have saved. So 10 lakh into 9%. 10 lakh into 9%, I believe that would be 90,000 rupees. That will become your perquisite value. That is the interest save. Now, the point where you can make a mistake. Guys, whatever is the interest which is saved by you. Let's say in the question it is given that you have repaid this loan on 31st December 24. You have repaid this loan on 31st December 24. So 10 lakh into 9% will give you this 90,000 is the interest save for the entire year. Correct now? So, but if you have repaid the loan, it means that you have taken this facility only up till December. Correct? So in that case, 90,000. So if it is up till December, I believe it is 9 months. So this 90,000, it is for entire year. For 1 month, it is 1/12. For 9 months, it is this much amount. So please work it accordingly. So the perquisite value would be 90,000 divided by 12 into 9. So it would be 67,500. So it depends upon the point that how much is the loan outstanding. If there is no loan in January, February, March, so you have not saved anything, correct? Because there was no loan. Second, if the loan amount is getting changed during the year, let's say initially the loan was of 10 lakh, but after few months you have paid 7 lakh. Now the outstanding loan is 3 lakh only. So please understand that how much you are saving. So please don't roughly do like this, that 10% into 9%, this is the interest save. Please also remember that how much is the loan outstanding. Have you understood this word also? How much is the loan outstanding? Because you have to see that how much interest you are saving. Got it? So if you are using 10 lakh for the entire year, then obviously you have to pay interest for 12 months. If you are using 10 lakh rupees for 8 months, 9 months, 7 months, so please work accordingly that how much interest you are saving. Got it? Okay. Guys, education facility. Education facility is important perquisite. See, if the education is given here, again, you can make a mistake. This is quite an important perquisite. If the education is given to the employee, if you are an employee, education is given to the employee, you have to make it exempt. For employee, please make it exempt. Whether that education amount is anything. Let us say it is 5,000. Let us say it is 50,000. Let's say it is 50 lakh. Doesn't matter. For employee, education facility is exempt. But for others, if we are giving an education to spouse, to employees, brother and sister, to employees' children, then please make it taxable. Then please make it taxable. Now, the last point in education facility is that if the education facility is given to children, please make it taxable. But if the education facility is given to children in employer's school or college, in employer institution, and if the value of this amount is up till 1000, only for children, if this education facility is given only for children and only in employer's college or institution, then you can make it exempt up till 1000 rupees, make it exempt, right? So even if the education is outside India, those of doesn't matter, please make it taxable. If it is for employee, anywhere for employee, it is exempt. But for his family member, it is please make it taxable. Right? Generally, two things they generally ask. They will give you education for the employee, please make it exempt. They will give you education facility for other family members. Generally, you have to make it taxable. 99% you will get only this. Correct? Food and refreshment, not so important, but yes, refreshments, your tea, coffee, etc. are exempt perquisite, but your meals are taxable. In default regime, make it 100% taxable, but in optional regime, up to 50 rupees per meal is exempt. Now, let's say, see, regarding meal facility, let's say they are giving you lunch allowance. See, lunch allowance is an allowance. It's a personal allowance. Whether you are following default regime, whether you are following optional regime, please make it 100% taxable. This is allowance. But I'm not talking about allowance. I'm talking about lunch facility. Let's say lunch facility. This type of questions can come in examinations. Lunch facility. And it is given in your question that the employer is incurring, let's say 20,000 rupees in the year. 20,000 rupees he is incurring for the lunch facility. Guys, if it is default regime, then there is no problem. Entire 20,000, please make it taxable. Entire 20,000, make it taxable. But it is optional regime. In that case, 50 rupees per meal is exempt. So generally we will assume, see, we don't go to office 365 days. On Sundays, we don't go. Sometimes on Saturday also there is an off. So generally it is 5 days or 6 days working. So generally assumption should be that the number of working days is 300. So up till they are giving 20,000 rupees. Now I'm telling you about optional thing, right? So if they are giving you 20,000 rupees and in optional regime, 50 rupees per meal is exempt. So please take an assumption. Please write it over there that number of working days are taken as 300, right? Please don't take it 365 because we don't go on Sundays or other holidays. So make it 300. 300 into 50, that is 15,000. So please exempt 15,000 and only 5,000 will be your taxable perquisite. In default, entire 20,000. In your optional regime, please make it exempt up till 50 rupees per meal. Either it is lunch or either it is dinner. And generally, if the question is silent, please take the number of working days as 300. I believe everybody understood this also. Now, use of assets. Use of assets. Guys, it is use. What does the term use means? That they are giving you an asset just for a temporary use. Till the person is working with their company, they are giving this asset to them. Once the employee will resign, they will take it back. That is called use or temporary use. If it is computer or laptop, we already understood that perquisite value would be nil. Even if the question is telling you that this computer is being used by the family members for their personal purpose, they're playing games on that, doesn't matter. For computers and laptops, please make it 100% exempt. For other movable assets, we have already discussed. If it is owned by the employer, 10% per annum of the actual cost. If it is hired, then actual hire charges, any recovery shall be subtracted. Now, this perquisite, I would like to discuss transfer of movable asset. If they have transferred your... Yes, Ritika, you can provide a note that we are assuming 300 days as the number of working days, right? Now, what is transfer of movable assets? Transfer of movable assets means they have given the assets to you permanently. Permanently, they are giving you the assets. It's a computer laptop. Yes, it will become a perquisite. See, if computer laptop is just for temporary use, it will not become perquisite. That is use. Here it is transfer. They are actually giving you an asset. So how? So let's say they are giving you a car, they are giving you a computer, they are giving you other assets, furniture, etc. That please take it. Let's say I am an employee there and I'm working with Tata. So Tata is saying, Rajat, you can take this car. You can, even if you will leave the organization, you can keep this car with you. You can keep this computer with you. You can keep this furniture with you. That is called transfer of asset. That is called permanent transfer. But they are saying, Rajat, you can keep this, but please pay us some money. So whether it is a perquisite for me, the answer could be yes also. Why? Because I will see that what is the type of asset which I am receiving and what is the condition of that asset. What is the condition of that asset and how much I am paying. So let's say I'm getting any furniture, any car or any other thing. Let's say I'm getting a car. There is a car which my employer, this is my employer car. And they are telling me, Rajat, you are an employee, you can take this. And you have to pay me 1 lakh rupees. They are asking 1 lakh rupees. Okay. This car was of 15 lakh. Originally, it was 15 lakh, but it was a used car. So let's say it is used for 2 years. So whether my perquisite is because I'm getting a car of 15 lakh minus 1 lakh I am paying, whether my perquisite is 14 lakh, no. In that case, I have to calculate the depreciated value of this. So I will be telling, I will be saying to them, okay, so what is the value of the car right now? So I'll be calculating the depreciated value of the car. So let's say the depreciated value of the car comes to 10 lakh rupees. And I will say, okay, this car is worth rupees 10 lakh rupees right now. And I am paying 1 lakh rupees for this. So 9 lakh would be my facility. 9 lakh will become the perquisite value. So you have to compute the depreciated value of the asset. How you will be computing the depreciated value of the asset? So if it is computers, mobile phones, storage devices, then the depreciation rate is 50% for every year. If it is car, it is 20% for every year. If it is, again, I'm repeating, if it is computers, mobile, etc., it is 50%. Cars, it is 20%. For other assets, it is 10%. But guys, please remember, for other assets, it is 10% on straight line method. Please apply straight line method rate. For car and for computers, please apply written down value rates. And you have to take the number of period which you have to take. Let's say if it is 2 years, 11 months old, 2 years, 11 months old, please don't take part of the year, only take completed year. So only calculate the depreciation only for 2 years. Understood? So please calculate the depreciated value and then see how much you are paying. So if you are paying less, that value is, let's say you are paying 1 lakh rupees, the depreciated value is 10 lakh. So whatever is the benefit which you are getting, that is your perquisite. Have you understood this also? Medical facilities, generally in India, let me talk about India, medical facility. For car, it is 20%. For bike, Ganesh, for bike or motorcycle, it is 10% SLM. For car, it is 20% WDV. For bike, etc., it is 10% SLM. Guys, medical facilities. This is again the last perquisite which I am discussing with you. If the treatment is of employee or their family members, who are the family member? Family member here, you should remember that the family member will only include spouse, children, whether they are dependent, non-dependent does not matter, and parents, brother and sister, if they are dependent. These are the family members. That's it, full stop. So if the medical treatment is for the employee or for his family member, these are the family members. Spouse and children, dependent, non-dependent, doesn't matter. Parents, brother and sister, if they are dependent. So if the treatment is for these people, they can be exempt. Now it depends where the treatment is happening. Even for the employee, can be exempt, can be taxable also. So this can be exempt if the treatment is happening in government hospital, if the treatment is happening in employer hospital. So if it is government hospital, please make it exempt. Guys, if the person is not a part of the family member, let's say it is independent father, not a part of family member, make it taxable. Even in government hospital, even in employer hospital, make it taxable. I'm again repeating, my point over here is that only for family members, and these are the family members, or for employee himself or herself, only that amount would be exempt. Got it? Government hospital, employer hospital, and other hospital if it is for a specified disease. Generally, you will not get for other hospital. This is important. Guys, if the question is not mentioning that it is not a government hospital, if it is not an employer hospital, then please make it fully taxable. Let's say it is a doctor clinic or any other dispensary, etc. It's a doctor clinic, nursing home, etc. Please make it fully taxable. Whether it is for employee also, please make it fully taxable. Got it? Treatment outside India, not that important, but still, if it is treatment outside India, so as per the RBI limit, it is exempt. So for traveling and for stay, for the person who is going outside, the patient and one attendant, treatment and staying expenses can be exempt up to RBI limit. Traveling expenses, it depends upon the GTA of the assessee. If the GTA is up to 2 lakh, traveling expenses are exempt, otherwise it is taxable. But generally, I don't think that they will ask you. Generally, they don't ask you about outside India. But this one is important. Okay. I would like to discuss. I think we can we take a break for Kavya, total income questions? We have done so many in practice, so I don't think that we'll get time to do the total income questions today. In fact, if I get time, then I'll touch 1 or 2 total income questions also. So can we take a break for 10 minutes right now? And then we'll start with this. Okay. Please take a break for 10 minutes. Take a quick break of 10 minutes. So we'll meet at 12:10 p.m. Take a quick break of 10 minutes and then we'll resume.
సరే నాకెందుకు అనుకుంటుంది అంతే జగన్ సార్ బుక్ చేసి కంటిన్యూ చేసుకో జగన్ సార్ తీసిన కదా అది రాసుకున్నట్టు కాదు చదువుకో ఫోటో మంచిగా మంచి చెప్పలేదు అంటే కొంచెం ఇది రెండు పేపర్లు అదొక్కటి తీసుకుంటే పూర్తిగా ఏమలేదు తీసుకోమని అంటే ఈ మధ్య మాటలు అయిపోయిన ఆన్లైన్ కి మ్యూచువల్ ఫండ్ ఫండ్ అది నేను మోర్ దాన్ 2 అంతే సార్ అవసరం లేదు ఏం కాదు నా పేమెంట్ కాదు ఎప్పుడైతే నీకు నెక్స్ట్ ఈ నోట్స్
Okay. Sondram, you have a question. Everybody is here or not? Guys, are you here? Okay. Sondram has a question that if there is a reimbursement of medical expenses, see if it is given in the question that medical expenses reimbursed rupees, for example, 10,000, whatever the amount is, 10,000 rupees is the medical expenses reimbursed. So it is not mentioned anywhere that whether this treatment is in government hospital or employer hospital. So in that case, Sondram, please make it fully taxable. Medical expenses reimbursed, make it fully taxable. They were also asking that about telephone expenses reimbursed. See, telephone expenses or mobile expenses, these are exempt perquisite. These are exempt perquisite. So if telephone expenses are reimbursed, these are not taxable at all. Let me discuss that also. Fully exempt perquisite. Look at this point as well. Fully exempt perquisite. Telephone and computer facility. So computer facility we have already discussed, computer or laptop. Telephone also. So if telephone expenses are reimbursed by the employer, please make it fully exempt. Accommodation to High Court and Supreme Court judges, under optional regime it is exempt, under default regime it is taxable. Not so important. Foreign allowances on foreign perquisites to Government of India. An Indian citizen, not at all important, but if Indian citizen, you have done this in the classes also. So if Indian citizen is working abroad and he's being provided salary from the Indian government, then only basic salary is taxable. Allowances and perquisites are exempt. So if you remember, let's say there is Mr. X. So Mr. X, he is an Indian citizen and he is posted abroad. Let's say he's working with Australia and Indian government is paying him basic salary, whatever the amount is. They are paying him allowances. They are paying him perquisites. So allowances and perquisites are exempt. These are called foreign allowances. Foreign perquisites are exempt. only basic salary is taxable, and this income is deemed to arise in India. So please make only basic salary taxable. Got it? Transport facility between home and office. So transport facility between home and office. Guys, this is not transport allowance. This is transport facility. What is a transport facility? So you actually, you must have seen that there are some companies who provided a cab service, a cab facility. They actually send a cars or other motor cars or etc. to the employee home. And there are 4 or 5 employees who actually come together in a car. So this is a transport facility. We are providing a pick and drop facility. So pick and drop facility is not a taxable perquisite. Education facility to employee is not a taxable perquisite, that we all know. Health insurance premium. Please remember, life insurance premium is fully taxable. Health insurance premium, it is an exempt perquisite for employee and their family member. So whenever we are getting a health insurance also from our company, that health insurance premium which the company is paying, that is an exempt perquisite. Recreational facility, that is recreational facility, refreshment facility, entertainment facility, etc. These are also exempt perquisite. Accommodation provided a remote area, mining site, this will not come. You can leave that. Okay. Let us concentrate on the retirement benefits gratuity. First of all, let us concentrate on gratuity. See, if we are getting gratuity, please remember this thing. See, if gratuity is received at the time of retirement or resignation, termination. In other words, I can actually say that the employee is leaving the organization by any mode, retirement, resignation, termination, etc. It can be exempt. This gratuity can be exempt. But if this gratuity is being given to the employee, not on retirement, not on resignation, not on termination, but during the tenure of service. So please remember, let's say during the tenure of service, during his job only, every year we are giving him gratuity. So that is fully taxable, fully taxable. So how you will get this in your examination? So let's say in your examiner is giving you that the assessee is receiving gratuity of 10,000 per annum. Every year you are getting it. So it means that every year we are getting this gratuity, 10,000 per annum. And right now we are working over there. So please make it fully taxable. For all kinds of employees, it is fully taxable. Even for government employees, it is fully taxable. So any gratuity which you receive during the tenure of your job, that is fully taxable. But right now, I'll be talking about that gratuity which you receive at the time of which the employee received at the time of retirement, resignation, termination. That could be exempt. Now it depends. Guys, I'm not talking about this. That is fully taxable. I'm talking about this one, gratuity. So this gratuity can be exempt. Now it depends that who is getting this gratuity. So whether this person is a government employee or this person is a non-government employee. If the employee is a government employee, make this particular gratuity fully exempt. It is fully exempt for government employee, central government, state government, local authority employee, fully exempt. But it is non-government employee that it is not fully exempt. It is exempt up to a certain limit. Up to a certain limit only it is exempt. But here we have to see whether this non-government is covered under Gratuity Act or not covered under Gratuity Act. So this, your question will tell you that this person is working with ABC Limited. That means he's a non-government employee. And they will actually tell you, most likely they will be telling you, generally in all the examination paper we have seen, that question paper actually specifies that whether this person is covered under gratuity or not covered under gratuity. In case it is not mentioned, then you can make your assumption and you can proceed accordingly. So my recommendation is that please assume that he is covered under the Gratuity Act. Otherwise, 99.99% I'm telling you, they will be mentioning this, they will be specifying this, whether he is covered or not covered. So quickly see that how much gratuity is exempt. So if this gratuity is provided to a central government, state government, or a local authority employee, it is fully exempt. It is fully exempt in that case. But it is non-government employee, then we will see that whether this employee is covered under Gratuity Act or not covered under Gratuity Act. So whatever is the gratuity we are receiving, So let's say we, at the time of retirement, this person has received rupees, let's say 35 lakh rupees of gratuity. See, if this person is a government employee, then this 35 lakh entirely would be exempt. But if it is a non-government employee, and let's say he's covered under Gratuity Act, then 35 lakh, please write in inner column, this is the gratuity received. And out of this 35 lakh, the least of these A, B, C, the least of this A, B, and C would be exempt. What is A? Actual gratuity, 35 lakh. 20 lakh is the fixed limit, 20 lakh. So this is easy. Actual gratuity, fixed limit 20 lakh. Third limit is 15 by 26. Please guys, you have to remember this. You have to remember this. If it is covered under Gratuity Act, 15 by 26, we have already discussed why this 15 by 26, how it came. So right now, please remember this. 15 by 26 into last drawn salary. Now, what is the meaning of salary? Here, the meaning of salary means basic salary plus DA. DA forming part? No, it is not written over there. This is a little bit important. Please, basic salary plus DA. Whatever is your last salary is, take that salary into completed years or part of the year in excess of 6 months. That is to be rounded off. So if it is 25 years, 7 months, so please take it 26 years. So 15 by 26 into your last salary. So whatever is the last salary, where last salary means per month salary, whatever is the salary, basic salary plus DA, please take it, and then into number of years or part thereof in excess of 6 months. So you have to take this, whichever is least, you have to exempt. Similar, if this assessee is not covered under Gratuity Act, if he's a non-government employee, not covered under Gratuity Act, actual gratuity, let's say it is 35 lakh, 20 lakh is the fixed limit, 1 by 2 into average salary of the last 10 months. So whatever is the salary which he has drawn in the last 10 months, take the average of it. So whatever, first of all, sum up the last 10 months salary. And when you will sum up the last 10 months, only take these three components: basic salary, DA forming part, fixed percentage commission on turnover. That is RBS salary. Here the salary is RBS salary, 1 by 2 into average salary. And how you will be computing the average salary? Last 10 months. Then do the average. How you will do the average? Sum up the last 10 months, do the total of it, divide by 10. You will get the average. Correct? Into only completed year of service. Guys, I'm telling you, gratuity point is not that important also, but 50-50% chances that it can come, it can not come. So at least we should revise it just once, right? So this is how we will be computing it. And gratuity received, we have already given, discussed that. Gratuity received during the tenure of your job, please make it fully taxable. Even if for government employee, let's say there is a gratuity 20,000 rupees per month, or in a year you are getting 1 lakh rupees every year. Even if this person is a government employee, doesn't matter, please make it fully taxable. And this point is not that important. This 20 lakh limit is a lifetime limit. This 20 lakh limit over here, these are the lifetime limit. So if an assessee has already worked somewhere before and he has retired and he has already claimed, let's say 5 lakh rupees exemption earlier, so this limit will be reduced by that amount. That is not that important. But please remember these two. Just I'm giving you some 30 seconds. Try to read these two also. I'm just erasing these. Try to learn this. Guys, try to learn this. This is for non-government employee. I'm giving you 30 seconds. Try to learn this. Learn the meaning of salary also. Now, second is pension. See, if we are getting pension, again, this pension, whether it is a lump sum pension or it is a regular pension. So regarding pension, if it's a regular pension, regular, we also call it uncommuted pension. It is fully taxable. It is fully taxable. Doesn't matter what type of employee it is, a regular pension is fully taxable. Per month pension, per annum pension, generally per month pension, please make it taxable. But if it is a lump sum pension, second case, if it is a lump sum pension that on retirement, resignation, etc., the assessee is getting a lump sum pension, so it could be exempt. Again, it depends whether it is a government employee. In case of government employee, it is fully exempt. Lump sum pension is fully exempt. In case of non-government employee, it could be exempt up to a certain limit. So if he is a non-government employee, I'm again repeating, pension is, if it is regular per month pension, so you don't have to see anything, please make it fully taxable. Got it? Lump sum pension, government employee fully exempt. You will not get for government employee in examination, can get for this, for non-government employee. Now it is exempt up to a certain limit. Now it depends that whether you are receiving, whether the assessee is receiving gratuity also or not. So now we will ask that whether you are receiving gratuity also or not. So let's say the answer comes yes or the answer comes no. This person is receiving gratuity also, this person is not receiving gratuity. So if the answer comes yes, so he's getting a double benefit. He's getting a pension also commuted and he's getting a gratuity also. So we will give him exemption, but a lower exemption 1/3. But if he is not getting gratuity, then we will giving him a more exemption 1/2, because 1/2 is a higher percentage. 1/3 is a lower number. So if he is getting gratuity also, then we will be giving him exemption of 1/3. 1/3 of what? 1/3 of the commuted pension upon percentage of commutation. What is commuted pension? The amount which you are receiving. What is percentage of commutation? What is this denominator? How much percent of pension is commuted? So they will tell you 70% is commuted, 80% is commuted, 90% of it's commuted. So whatever is the commuted pension, let's say if it is, you are getting 7 lakh rupees and let's say 70% of it is commuted. So 7 lakh divided by 70%. Divided by 70%, you will get 7 lakh divided by 70%, you will get 10 lakh. So 1/3 of 10 lakh, that is exempt. So 3,33,333 would be exempt. So whatever is the gratuity received. So let's say, for example, I'll give you an example. Let's say there is a gratuity received. Let's say for rupees 9 lakh. Sorry, it's a pension received. Pension received 9 lakh rupees. It's a lump sum pension. It's a lump sum pension which we are receiving 9 lakh rupees. See, if this person is a government employee, how much taxable? 0. It is 0. But if it is a non-government employee, this person is a non-government employee. In that case, first of all, write that how much pension we are getting. So commuted pension which we are getting is 9 lakh. Less exempt. How much would be exempt? 1/2 or 1/3? So if he is getting gratuity, then write 1/3. If he is not getting gratuity, write 1/2. Got it? No issues. So let's say he is not getting gratuity, 1/2. Into commuted pension. How much is the commuted pension which he has received? 9 lakh. And your question will tell you that how much, what is the percentage of commutation? Let's say the percentage of commutation is, let's say 80%. 80%. So what you have to do? 9 lakh divided by 80%. 9 lakh divided by 80%. So you will get 11,25,000. 11,25,000 you are getting into 1/2. Just do this, 1/2 of this. So you will get 5,62,500. This is exempt. This portion is exempt. From what? From this 9 lakh. This is exempt. So just subtract 9 lakh minus 562. So this is your taxable amount, 337,500. This is your taxable amount. If he is also getting gratuity, then this 1/2 will become 1/3. That's it. So I believe it is easy. So for pension, if it is commuted pension, it can be exempt. If it is uncommuted means it's a regular pension, please make it fully taxable. I'll give you one more example on this. Let's say the assessee retired and he is getting a pension from 1st December 24. For example, 30,000 rupees per month. He's getting pension 30,000 rupees per month from 1st December 24. And after that, let's say after 2 months, for example, from 1st February 25, he got it commuted. He got it commuted, and now he didn't get it 100% commuted, but he gets some of the amount commuted. So let's say now he is getting 18,000 per month. He got it commuted, and initially he was getting 30, but now he's getting 18,000 per month. And since he got it commuted, so let's say he received rupees 12 lakh rupees as commuted pension. This is your question regarding pension. Correct? Now, generally, you will get for non-government employee. See, if it is government employee, let's say if it is government employee, you will write this. So I always say that please make the list of all the things. So you will write uncommuted pension, and commuted pension also. Uncommuted pension, no doubt everything is taxable. So how much uncommuted pension he is getting? From December, he is getting uncommuted pension 30,000 per month. So 30,000 in December he got. In January he got 30,000. So into 2 plus from February he got it 18,000 per month. So 18,000 February and 18,000 in March. So whatever is the total, please make it fully taxable, uncommuted. What type of employee it is? Government employee. Doesn't matter. Uncommuted pension is fully taxable. Commuted pension, if this person is a government employee, he received 12 lakh rupees, please exempt everything 12 lakh, please make it taxable 0. Everybody understood? Let's say, so commuted pension is 0. But let's say this person is a non-government employee. This person is a non-government employee, then what we will do, for uncommuted pension, regular pension, everything would be same. But for commuted pension, this person has received 12 lakh rupees. We'll exempt. We'll ask that whether you are getting gratuity or not. So he says that no sir, I am not getting gratuity. So I will write 1/2. 1/2 of commuted pension in numerator 12 lakh divided by percentage of commutation. Can you please tell me how much is the percentage of commutation here? Can you guys please tell me how much is the percentage of commutation over here? So what you will say, sir, initially he was getting 30,000. Now he is getting 18,000. It means that how much amount he is getting less? 12,000. So out of 30, he got 12,000 rupees as commuted into 100. So the percentage of commutation is 12 divided by 30%. 40% is the percentage of commutation. Everybody understood how I got this 40%? Should I repeat it once again? I'm repeating it once again. Initially, he was getting 30,000 per month. Now he is getting 18,000 per month. So what I can say, see, it is very simple. 30,000 he was getting initially. After that, he is from February onwards, he got it commuted. And still there is some portion which is uncommuted. Uncommuted means monthly pension. How much is the uncommuted amount? 18,000 rupees. 18,000 rupees is the uncommuted amount. So it means that commuted amount is 12,000 rupees. So please tell me in percentage form, out of 30, how much is commuted? So you will get 40% it is commuted. Everybody got it? So what you will do? 12 lakh divided by 40%. Divided by 40%. So 12 lakh divided by 40%. 30 lakh divided by 2. You will get 15 lakh over here. So this could be exempt. So we have to subtract it from 12 lakh. 12 minus 15. Obviously, we cannot write it negative. So in this case, it will become nil. I believe everybody is okay with this pension point also.
Sir, percentage of commutation will be given in the question or not, sir?
Mahendra, just give me a moment. Yes, ask me again. Mahendra, you were asking.
Sir, percentage of commutation will be given in the question or not, sir? Mostly.
Mostly it will be given in the question, but sometimes they will give you a little tricky thing. So there you have to actually calculate the percentage of commutation. This is how you have to calculate the percentage of commutation. Mostly it will be given. Got it? Okay. So this was about pension. Then for leave salary. See, leave salary, you understand what is a leave salary? Harish has a question. Harish is saying, sir, if the commission is rupees 10,000 per month or 10,000 per annum is given, and it is not mentioned that whether it is fixed percentage of commission. No, it is not a fixed percentage of commission, Harish. Commission is taxable, but whenever you will be taking for the purpose of calculation of any perquisite or any RBS, then you will not take that commission. Commission should, whenever that RBS salary should be computed, it should be as a percentage commission on turnover. So 10,000 per month is not fixed. Okay. Guys, leave salary. Leave salary, if it is a central government or a state government employee, it is fully exempt. But if it is for other employee, it is exempt up to a certain limit. If it is for other employee, and generally you will get for other employee only. So how much it is exempt? There are 4 limits to it, A, B, C, D. So first is actual leave encashment, whatever is the leave salary which we are getting, actual leave encashment. Second is 25 lakh. Third is 25 lakh is the fixed limit. Third limit is 10 into average salary. 10 into average salary. So first you have to compute the average salary. What is the average salary? Last 10 months period, you have to do the average of it. Last 10 months period. So what you will take in last 10 months? RBS. Basic salary, DA forming part, plus fixed percentage commission on turnover. So Harish, 10,000 per month, which you were telling me, that you will not take here. Here you will not take. Here you will take only that commission that is fixed a percentage of turnover. And most of the time I have observed that examiner does not give you this value. So in that case, you can ignore it. Generally basic salary plus DA if forming part. If DA does not form part, you know that then we will be taking only basic salary. So for last 10 months, compute this, take the average of it, then into, you will get this average into 10. So 10 into average salary. Fourth point is little bit important. Leaves at the credit into average salary. Leaves at the credit into average salary. What does leaves at the credit means? That how much number of days leaves you have. So let's say your question is saying that the assessee is getting leaves per year. He's getting 25 days of leaves per year. His company gives him leaves of 25 days per year. And he avails 10 days leaves. Every year he avails 10 days leaves. And he in cash, let's say 5 days leaves every year. Correct? So he is being provided with 25 days leaves, granted are 25. He availed 10 days leaves and he in cash 5 days leaves. So now how much is the leaves which gets remains? How much is the leaves which get unutilized? So that is called leaves at the credit. So you are getting 25 days of leaves every year. You are availing 10 days. So set 10 days you are availing it. That is exhausted. 5 days you are in cashing every year. So that is also exhausted. So now your number of days, which is leaves at credit, comes to 10 days every year. Let's say in this case, it will come to 10 days in each year. Now, let's say this person has worked here for 26 years and 11 months. And this was the case. Every year he is accumulating 10 days leaves. Part of the year will ignore, will only take completed years. So 10 into 260. 10 into 260. So, sorry, 26. So we'll get 260. So we'll get 260 days. Please don't make a mistake over here. We will get 260 days. 10 days into 26. We'll get 260 days. So this is called lease at the credit. And lease at the credit, you have to multiply it by average salary. See, this average salary is monthly salary. It's in per month. So these number of days should also be in month. So whenever you will get leaves at the credit and when you are getting in days, just divide it by 30. So what you should do, 260 days you are getting leaves the credit, divided by 30. So this will give you number of days in months, and then apply your average salary. Have you understood this also? So 260 days, whatever the days you have calculated it, please take it in number of months. So here leaves at the credit, when I say leaves at the credit, it should be in number of months. So you will get of days, please divide it by 30 and then average salary. Last important point over here is that if leaves at the leaves per year, the company grants you leaves per year 25 or 26, 27, 28 till 30 days. 30 days we are okay. But if you are getting more than 30 days, let's say there is a company which is giving you 35 days leaves at the credit, days leaves. They grant you 35 days leaves. So you know that maximum number of days should be taken as 30 only while computing this. So here, although the company is giving you 35 days, there the company is giving you 35 days, but here maximum leaves granted, you will not take 35, you will take maximum 30. So I believe that you are able to recall this provision as well. So 30 minus 10 minus 5, you will get 15 days. Got it? So this is also an important perquisite, leave salary. Voluntary retirement and retrenchment compensation is not that important perquisite, but please remember there is a fixed limit of 5 lakh. Only thing which you should remember is 5 lakh limit, not that important. Provident fund. Provident fund, mainly recognized provident fund, and everybody will be able to recall that let's say it is employer contribution to recognized provident fund. So whatever the employer is contributing, please make it your income. Whatever the employer is contributing, please make it your income. Then subtract 12% of salary. Subtract 12% of salary from there. And here again, the salary means RBS salary, basic salary, DA forming part, fixed percentage commission on turnover. So subtract that. Let's say the employer is contributing, let's say for example, 1 lakh, 12% of salary, basic salary, DA forming part, fixed percentage commission on turnover of 12%, let's say come to 92,000 rupees. So only make 8,000 taxable, only make 8,000 taxable employer contribution to RPF. If it is employer contribution to SPF, which you will not get, statutory provident fund, then it is fully exempt. Not even 12%, then it is fully exempt. So employer contribution to SPF, generally examiner doesn't ask about SPF, but yes, if they will ask, please make it fully exempt. But if it is RPF, then please make it exempt up till 12% of salary. Got it? If it is URPF, unrecognized provident fund, we don't tax unrecognized provident fund yearly. We don't tax unrecognized, because unrecognized provident fund, we don't know whether we will receive this money or not. So we don't tax URPF every year. So if it is employer contribution to URPF, then please don't tax anything. It is fully exempt. It will only be taxed when it is actually received at the time of retirement or resignation. So URPF, we don't make it taxable every year. We make it taxable only when it is received at the year, at the retirement, or whenever the employee is going outside from the organization. Okay, please, I'll talk about URPF also after a minute. But there is another contribution which you can get, employer contribution to pension scheme, new pension scheme, or employer contribution to Agniveer scheme. Please make it fully taxable in the salary chapter. Please, in salary chapter, whenever you are doing salary, please make it fully taxable right here, because there is a deduction available, but that deduction is under chapter 6A. See, if it is RPF, employer contribution to RPF, we get the deduction right here in the chapter of salary itself, 12% of salary. But if it is employer contribution to new pension scheme, that employer contribution deduction is available in 80 CCD2, CCD. Agniveer, it is CCH, we will be getting the deduction there, not here. Got it? So whatever is the employer contribution to pension scheme, make it fully taxable. Agniveer corpus fund, make it fully taxable. Correct? Okay, let me talk quickly about URPF, unrecognized provident fund. URPF. What is URPF? Let's say I am also an employee. My company was the employer. So every month, I'm also contributing to URPF. My company is also contributing to URPF. So every year it will not make it. Please don't make it taxable because it is URPF, unrecognized. And I don't know whenever I'll be retiring it from this organization, whether I'll be receiving this money or not. I am not aware of it. So I'll not make it taxable. But when this money is actually received, so let's say every year we were contributing some amount. So it's been number of years now. So whatever the amount which we'll receive, I'll divide this into 4 parts. So let's say I'm getting some good amount of money now. Let's say the assessee has joined this organization when he's 25 years of age, and right now he's 60 years of age, and he's getting retired. So for 35 years, these people are accumulating the money over here. So whenever you get the money, it has 4 parts. One is employee contribution. Other is employer contribution. And interest thereon. Interest on employee contribution, interest on employer contribution. So let's say this person is getting 70-80 lakh rupees, whatever is the amount, but this would be divided into 4 parts, whatever is the employee contribution. So let's say now URPF money, he's getting a URPF money at the time of retirement, let's say 70 lakh rupees. So examiner will give you that how much out of 70 lakh, what is the split of this? What is the split of this? So whatever the money which is related to employer contribution or interest thereon, related to employer contribution, let's say it is, for example, it is 20 lakh, that is 15 lakh. Correct? So total 70 lakh we are getting. So whatever is the employer contribution and interest thereon, this 35 lakh will become salary income. When it will become? When it is actually received, URPF. And this 20 lakh employee contribution is not an income because it is part of your salary only, which is you are actually investing it over here. That is not an income. But 15 lakh interest thereon, it will become IFOS. So I believe that you are able to recall this provision also. So URPF money, whenever, every year, please don't make it taxable. Please make it taxable only when it is actually received at the time of retirement, resignation, etc. Correct? Okay, so these are the important point about salary. So these are the things which we have to discuss about salary. Salary is a big chapter as far as discussion is concerned, although it's not a difficult chapter, but the thing is that there are so many limits to it. There are so many definitions to it. So that makes it a little bit comprehensive, a big chapter. Okay, let us come to house property, guys. Guys, next break, we'll take a lunch break around 2 o'clock, right? We'll take a 20-25 minutes break, but at 2 o'clock, we'll take a break. Now, so before that, we'll start PGBP also now. Okay, for house property. Oh, I forgot deductions from salary. Thank you, Rajalakshmi. Before house property, section 16. Section 16 is deductions from salary. Deductions from salary, from gross salary. See, if you are following, as I was discussed earlier also, if you are following optional regime or you are following default regime, there is one deduction that is called standard deduction, which it should be applicable in both the regimes. So one deduction is standard deduction, which you have to give. Here in optional 50,000, in default 75,000. Correct? Second deduction is called entertainment allowance deduction. And third is tax on employment, or some people call it professional tax also. So you understand, in default regime, you will not get this. You will not get these two deduction. In default regime, we get only standard deduction, that is 75,000 maximum, right? Gross salary of 75,000, whichever is lower, generally 75,000. And these two deduction you will not get in default. But in optional, you can get these two deduction. Entertainment allowance deduction. See, first of all, entertainment allowance, make it fully taxable. First of all, it is an allowance. So whenever you will be computing your gross salary first of all, entertainment allowance should become taxable above, right? Above means that whenever you are calculating basic salary, DA, other allowances, right? Entertainment allowance over there and make it fully taxable. Then entertainment allowance deduction is available only under optional regime, only and only to, this is very, very rare. I don't think that it will come in examination. It's very, very rare. It is only to central government and state government employee. and that too under optional regime. So there are so many points. First of all, in your question, there should be entertainment allowance. Second thing is that this person should be a central government or a state government employee only, not even local authority, central government or state government. Third point is optional regime. So there are so many things. Then only you can give this deduction. And all things should be, again, I'm repeating, it there should be in your question entertainment allowance. First make entertainment allowance taxable. Then you can give a deduction, provided it is a central government, state government employee. This person is following optional regime. In default regime, don't give any deduction. So how much is the entertainment allowance reduction is? A, B, C. So first is actual entertainment allowance. So whatever is the actual entertainment allowance you are getting. Second is rupees 5,000 rupees fixed limit, and C is 20% of basic salary. 20% of basic salary, whichever is lower, you will get this. 20% also you can say also 1/5 of basic salary, whichever is lower. So this is the entertainment allowance reduction, that too only and only to government employee. See, this is the entertainment allowance reduction. It would be only for government employee, and that too under optional regime. Actual entertainment allowance, 20% of the basic salary, that is 1/5 of basic salary, or 5,000 rupees. It is not 5,000 per month, it is a fixed limit, 5,000 rupees. Whichever is lower, you will get this option under optional regime. Tax on employment. Second is tax on employment. In default regime, you will not get this deduction, but in optional regime, you can get it. Only if it is paid during the previous year. If tax on employment is paid in previous year 24-25, so it should be paid on only on payment basis. If it is paid on 1/4/2024 or between 31st March 2025, then only it is allowed to be deducted. Whether the employee is paying, whether the employer is paying, doesn't matter. So anybody who is paying, you will get this deduction over here. But provided that it should be paid in this previous year. Let's say this tax on employment might belong to any other year also. So I can say that it is allowed only on payment basis. Payment basis. Let's say I have paid for this year, I have paid for next year, I have paid for last year also. But in this year, I have paid it. So it is allowed this year. Correct. Next important point is, in default regime, you will not get it. But if you are paying, employee is paying, then only take deduction. If employer is paying, then you can take deduction also. But if employer is paying, please make it salary income first, because this will become your perquisite. So please, whenever your employer is paying, so first of all, please make it salary income as a perquisite. Then you can give the deduction. But only if the employee is paying, then just give the deduction. No need to make the salary income. Got it, Rajalakshmi and everybody? Understood section 16? Okay. Now, let us come to house property. Guys, house property, again, I'm telling you, it's an easy chapter, but at the same time important. In fact, I will tell you the frequency of questions of house property is more than salary. See, salary is quite a big chapter, but house property is a very small chapter, and it is frequently repeated in examination. So guys, in house property, I will tell you that please try to score maximum. You can score full marks in house property. So please don't lose your marks in house property. See, house property. You should know, first of all, the computation, the format for computation. First, you need to compute your GAV. So whatever is the GAV, I'll be coming on this GAV after 2-3 minutes, minus municipal taxes paid by the owner. Guys, up to the due date of ROI is a concept of PGBP. I've told you many times in your classes also that up to the due date of ROI is a concept of PGBP. Here in house property, the municipal taxes should be paid by the owner. First of all, if they are paid by the tenant, you will not get it. It should be paid by the owner, and that too in the previous year, 24-25. This is in our year. Even if you have paid the municipal taxes of last year, last to last year, or any future year in this year, that is on cash basis, they are allowed. So whatever is the municipal taxes paid, can be subtracted. If they are not paid, if they are just due, it will not be subtracted. And it should be paid only by the owner. If the tenant has paid it, please don't subtract it. So once you subtract your municipal taxes paid, you will get your NAV. You will get your NAV, net annual value. Can you use the word NAV in examination? Yes, you can use. GAV NAV is quite universal. You can use that. Minus. And you, in fact, in your total, in your complete paper, you will have to use it only for once. So instead of writing just NAV, you can write net annual value, because only once, only one question would be there. Only once you have to write this. So it's better to play safe. So just write NAV, net annual value, correct? Now, from NAV, you will get deductions. You will get deductions. And there are only two deductions under section 24. Even guys don't need to mention section number. If you are 100% sure, then you can mention it. Otherwise, if you are not sure, you can leave it. Section number you don't have to mention. So deduction under section 24. First deduction is 24A, 30% of NAV, that we call a standard deduction or a statutory deduction. So whatever is the 30% of NAV, give this deduction. Second is interest on loan. Interest on loan. Subtract this also. And this will be your house property income. Just this is an overview for house property. First of all, it's an overview for house property. So first of all, compute your GAV, municipal taxes paid. If they are not paid, don't allow it. Don't subtract it. If they are paid only, then you can allow it. That too by the owner. You will get NAV deductions under 24A, 24B. You will get this house property income. This is my house property income. Now, please remember, this interest on loan is allowed in house property on due basis. On due basis, it is allowed. Even if it is not paid. Now, there is a section in PGBP, 43B. It says that if you have taken loan from a bank, financial institution, etc. But that is PGBP, guys. Right? That will do in PGBP. But here in house property, your interest on loan is allowed on due basis. Your interest on loan is allowed on due basis. And this interest on loan has two parts. This interest on loan has two parts. One is on due basis, you can take it. A and B. Okay, I'm writing it 1 and 2. First is current year interest. So whatever is the current year interest, you have to take it. Current year interest. So what is mean by current year? Our current year is previous year 24-25. So whatever is the current year interest which is due during this year, that is current year is previous year 24-25. Whatever is due during this year, please take that interest. First of all, write that interest. That is part of this 24B interest on loan. Correct? Please also make sure that if your loan is outstanding, now please if there is a dedicated question for house property, let's say of 5 or 6 marks, if there is a dedicated question of house property, so they can also give you that the loan outstanding is changed during the year. So let's say initially the loan was 10 lakh rupees. Now you have repaid during the year, let's say 4-5 lakh rupees. So you have to be very, very cautious that how much is the loan outstanding for the entire year. Please calculate your interest accordingly. If the question is silent, then calculate for the entire 12 months. No issues. Just in one go, you can calculate. But if the question is specifically telling you that the loan outstanding has been repaid during the year at frequent intervals, it has been repaid. So you have to see that how much is the loan and how much is the current year interest. Accordingly, you will calculate. So interest on loan, 24B has two parts. One is current year interest. Second is pre-construction interest also. Pre-construction interest. This pre-construction interest, we all know that it is allowed in 5 installment, 1/5 of pre-construction interest. Generally, in your question, you will find current year interest. But pre-construction interest is also an important point in house property. So if you are in the first 5 years, you are in the first 5 years from the construction, then you have to take 1/5 in the first for the first 5 years also. If let's say the construction has already been completed and it's been 6th year, 7th year, 8th year, then this will not come. It will only come when you are in the first 5 years of construction. Got it? So current year interest, whatever is due, plus pre-construction interest 1/5. Now, what is the pre-construction interest? Guys, pre-construction interest starts from the date of loan. So you have to see that when the loan is taken. And generally, we all know, we have already discussed it many times in the classes also. Generally, we all know that whenever the construction is completed, construction completion date. Generally, a layman will say that this is the pre-construction period. But we will say, what we will say? We have to see that this construction is completed in which year, it is completed, in which previous year it is completed. So let's say they are telling us that this construction was completed on 31st March 2024. So let's say the construction was completed on 31st March 2024. So we have to see that in which year this date belongs to, in which year this date falls. So this date falls in previous year 23-24. Agree? So this year is the year of construction. This year is the year of construction when it is completed. So before this year, it is pre-construction. So before this year, if you go before this, so you will get 31st March 2023 before this, because this previous year started from 1st April 23. So any period which is started from here, it is post-construction. So pre-construction is before that. So 31st March 23, although my house was completed on 31st March 24, but pre-construction period would be from the date of loan till 31st March 23. Have you all understood this or not? About pre-construction period? I believe all of you almost know about this. I think that there should be no confusion in this. Anybody has confusion in this? Understood now? Because we have discussed it many times. So this is the pre-construction period. Now, the thing is that for this pre-construction period, you have to be very cautious, guys. First of all, you identify what is the pre-construction period. Then you should identify that whether my year, previous year 24-25, whether it is in the first 5 years or not. So let's say in this case, the construction was completed in previous year 23-24. This is the first year. And my year is previous year 24-25. So my year is, yes, second year. It is the second year. So yes, it is in the first 5 years. Had it been the 5th year also, then also I have to take the pre-construction. But had it been the 6th year, 7th year, 8th year, so this would not be a pre-construction thing. Correct? Now, the date of the loan from here till here, you have to be very, very cautious. Once you identify what is the pre-construction period, then please make sure to see whether the loan outstanding was changed in this year or not. So if the loan outstanding is same for this entire period, then it would be an easy question. Otherwise, that is also not difficult. But if the loan outstanding is changed anywhere over here, just please be very cautious and calculate your interest accordingly. And whatever is the interest which you will get, please do 1/5 of it, which is allowed in 5 equal installment. You all know, right? So interest on loan, current year plus pre-construction, it depends that whether you are in the first 5 years or not. And it is allowed on due basis. Even if the question will tell you that this interest is not paid, doesn't matter. It is allowed on due basis. Correct? Now, this is the basic overview of house property. Now, if I go deep into it, GAV, how you will be computing the GAV? I also told you many times before also, generally in your examination, you will get the information of actual rent only. 90% or more than 90%, you will get information for your actual rent only. And if you are getting the information of your actual rent only, then please take your actual rent as your GAV. So if they are saying that the actual rent of the property is 35,000 per month, so your GAV is 35,000 into 12. Let's say it is let out for 10 months, so 35,000 into 10. That would be a GAV. Simple. More than 90% you will get this. Sometimes, very rarely, they will give you expected rent information also. So in that case, expected rent or actual rent, whichever is lower. Sorry, expected rent or actual rent, whichever is higher, that would be your GAV. So how you will be calculating your expected rent? For expected rent, you understand, you know that municipal value or fair rental value, whichever is higher, you have to calculate whichever is higher. Then this value should be compared to standard rent, whichever is lower. This is your expected rent. Generally, you will not get it, but I believe that this is easy. Everybody knows that how to calculate the expected rent. Municipal value or fair rental value, whichever is higher, then compare with the standard rent, whichever is lower. This is the expected rent. So this is the expected rent or actual rent, whichever is higher. That would be the GAV. I'm telling you, most of the time, expected rent information is not available in the question. Then actual rent will only be your GAV. Got it? Now, if you are following, let's say it's a self-occupied property. If it's a self-occupied property, what is a self-occupied property? Where the assessee was staying in this particular property for the year, and it is not let out at any time during the year. That is called 100% self-occupied. So if it is 100% self-occupied, we understand we can take the NAV as nil. We'll start with this NAV as nil. So even for a self-occupied property, the assessee has paid municipal taxes also. He will not get any benefit. Why? Because self-occupied property, we start as nil. 24A standard deduction, obviously it would be 0. 24B interest on loan. So for self-occupied property, this interest on loan, now it depends which regime you are following. So if you are following default regime, it is easy. For self-occupied property, you will not get any deduction in default regime. So even for interest on loan, you will not get deduction. For self-occupied property, the house property value comes 0. Because NAV is 0, 24A, obviously 30% of 0 would be 0. And interest on loan, it is not allowed in default regime. So you will get house property as 0. But in optional regime, if you are following optional regime, if your question is for optional regime, then this interest on loan is limited. Guys, if it is let out, then there is no issue. If the property is let out, then there is no issue in either in default, either in optional, and there is no problem with interest on loan. It is 100% allowed without any limit. There is no restriction. But if it is a self-occupied property, there is a restriction. In default regime, you will not get it anything. It would be 0. But in optional regime, there is a restriction of 2 lakh on interest on loan. I'm not saying of current year interest, pre-construction. No, the total of this, first you will do the total of this. If it is there, pre-construction is there, then please take 1/5 of pre-construction, then do the total. If pre-construction is not there, then ignore it. So whatever it is, just do a total of it, and it is limited. 24B is limited. In optional regime to 2 lakh, in some cases it is 30,000 also. Sometimes it is 2 lakh, sometimes it is 30,000. So if it is optional regime, so it is restricted 2 lakh only if this loan is taken for purchase or construction. For purchase and construction, the limit is 2 lakh. But if it is for repairs, it is for renovation, it is for reconstruction. Even if it is for reconstruction is like renovation, then it is limited to 30,000. I'm again repeating, for let out property, there is no limit. But for self-occupied property, in default regime, you will not get it. But in optional regime, there is a restriction of 2 lakh or 30,000 as the case may be. Understood? This thing also. Now, these are the main points of house property. There is one more important point in house property which generally comes. Any arrears of rent or recovery of unrealized rent. So whether it is arrears of rent or unrealized rent, please make it taxable, and please don't forget to give a 30% deduction from it. So let's say in your question, it is saying that 1 lakh rupees we have received, either it is arrears of rent or unrealized rent recovery. So 1 lakh into 70%. So only 30% you can give the exemption, standard deduction. So 70,000 in that case, please make it a deemed house property income. So this also would be the house property income. So recovery of unrealized rent, arrears of rent is also important. but please give 30% as standard deduction. From that, only 70% would be taxable. Next, if it is deemed house property, if it is deemed owner, what is a deemed owner? Not very important point, but you understand that whenever the individual has transferred this property to spouse or to minor child without consideration or inadequate consideration, in that case also individual is the deemed owner. So in individual hands only, we'll be calculating the house property income. We will not be calculating the house property income in the hands of spouse or minor child. Here, clubbing provisions will not apply. If you are transferring the property, to spouse or to minor child without consideration or inadequate consideration, so deemed ownership concept will be applicable. Not so important from examination point of view. Next, which is important, is composite rent. Composite rent. What is composite rent? Let's say if you have let out any property, generally in your total income question, you will get this. So let's say the assessee has let out his property. So he has let out his building for rupees 20,000 per month. And along with building, he has also let out some other assets also, or for services also, for security services, for lift maintenance, etc. We are charging something extra. Let's say for other assets, we are charging 5,000 per month. Generally, if the question is silent, guys, if the question is silent, nothing is mentioned, then for building rent, please make it house property and compute it accordingly in house property. And this other assets, 5,000 rupees, please make it your IFOS income. Please make it your IFOS income. For other assets or other facilities, please make it IFOS income. But in this case, for other assets, let's say we are getting 5,000 rupees per month as rent. Let's say in your question it is mentioned, especially in total income question, if it is mentioned that for other assets we are getting 5,000 rupees, but we have to, let's say for security services, we have given a house on rent, and for security services also we are charging 5,000 rupees. But to that security agency, we are paying 4,000 rupees. Let's say we are paying 4,000 rupees for the security agency. So how much the profit we are making? 5,000 we are getting from tenant, 4,000 we are paying to the security agency. So 1,000 would be the IFOS income. So this composite rent is also a little bit important. So if it is for building, please make it house property. If it is for other assets, please make it your IFOS. It could be PGBP also, but generally make it IFOS. If you are, I will not talk about PGBP. If your business is giving these assets as your main business, you are into these activities, then it could be PGB. But otherwise, 99.99% in your exam, please make it your IFOS income. And any expenses which are incurred, please deduct it from there. Correct. Next point, which is not that important. Let's say if in your exam, in your question, it is mentioned that we cannot give building separately. If we have to let it out, we have to give other assets also on rent, because we cannot give building and other assets separately on rent. So we have to mandatory give them on rent as a one particular bundle. So if you have to give them on rent as a one particular bundle, then in that case, it is called a composite rent. And this composite rent will become your IFOS income. Then you cannot take it as an house property. Have you understood this or not? So if these two are separable, separable means that you can let out your building separately, you can let out your other assets separately. Then for building, it is house property. For other assets, it is a IFOS income. And if the question is silent, then always assume, and there is no need to mention this also, always assume that this building is house property, this other assets is IFOS. But specifically, if it is mentioned in the question that giving this other assets is not separable. Not separable means that we cannot give them separately. We have to give it as a bundle. Then there would be no house property. Entire income, 25,000 per month. 25,000 per month will become your IFOS. And if there is any expenses, you can subtract that. Have you understood this also or not about composite rent? Everybody understood this? Mahendra, I'm coming to that point also. Okay. One more point is vacancy in house property. One more point is vacancy in house property. See, what is vacancy? Vacancy, we all know that when the property is neither let out nor self-occupied, means it is locked, it is empty. So if the property is locked, It is neither let out. It is neither self-occupied. This is called vacant. Vacant means it is locked. It is locked. Nobody is staying over there. Now, let's say in your question it is given. In your question it is given that municipal rental value is, let's say, 50,000 per month. Fair rental value, let's say it is 60,000 per month. And standard rent, it is, let's say, 40,000 per month. And actual rent is, let's say, 32,000 per month. And there is a vacancy of, let's say, 3 months. 3 months there is a vacancy. Now you have to compute the GAV. So now you have to compute the GAV. So we all know that GAV is higher of the two. One is called expected rent or actual rent. Actual rent received or receivable, ARR, or we can call it actual rent. So we understand GAV is expected rent or actual rent, whichever is higher. Okay. So what is the actual rent? Actual rent is 32,000 per month. And let's say it is given that 3 months is the vacancy. So actual rent is actually 32,000 rupees into, because out of 12 months, 3 months is the vacancy. So it is 9 months. So 32,000 into 9. So actual rent comes to 2,88,000. Correct. Actual rent comes to 2,88,000. And what is the expected rent? Expected rent, we all know, municipal rent or fair rental value, whichever is higher, 60. Compared to standard rent, whichever is lower, 60 and 40, whichever is lower, 40,000. So we understand 40,000 into 12. So it is 480. So expected rent is equal to 4,80,000. Got it? Now, expected rent is 480 for the entire house and actual rent is 288. Generally, we know that whichever is higher, expected rent or actual rent, whichever is higher, so 480 would be the GAV in this case. But in case there is a vacancy, I'm repeating this, I have already told you in the chapter of house property, and I was emphasizing on this point, that if there is a vacancy, in case there is a vacancy, then please don't compare these two. Just for the purpose of comparison, in that case, I'm saying just for the purpose of comparison, compute the proportionate expected rent, PER. And how do you compute the proportionate expected rent? You compute the proportionate expected rent by excluding vacancy. Just exclude vacancy. How you will say? You will say, sir, vacancy is 3 months. Just exclude that. So it means that out of 12 months, 3 months was vacancy. So it means 9 months you have to take. So you have to convert this expected rent into PER, proportionate expected rent, after excluding vacancy. So if vacancy is 3 months, so what you have to do is you will say, okay, 4,80,000 is the expected rent. Just make it proportionate. Divided by 12 into 9 months. Exclude the vacancy period. So 480 divided by 12 into 9. This comes 360. Just for the purpose of comparison purpose. Guys, this PER is only for comparison purpose. It will never become GAV. GAV will always be either expected rent or actual rent. That's it. It can be ER, it can be ARR. But just for comparison purpose, we are computing the proportionate expected rent. Okay. Now, in case of vacancy, then only compute proportionate. So now actual rent 288 or proportionate expected rent 360, whichever is higher. So we got PER is higher. So if PER is higher, then GAV will become, GAV can never become PER. It can become ER then. So your GAV will become expected rent. So your answer would be 4,80,000 in this case. Understood? It would be 4,80,000 in this case. I'm giving you one or two more examples quickly. Let's say my actual rent is For example, 50,000 per month. My actual rent is 50,000 per month. The house is self-occupied. The house is self-occupied for 5 months. And it is vacant for 2 months. And let's say the expected rent of the house, expected rent means municipal value, fair rental value, whichever is higher compared to standard rent, whichever is lower. So let's say the expected rent of the property is, for example, it is 5 lakh rupees. Correct? Now, first of all, we know that GAV is expected rent or actual rent, whichever is higher. Expected rent is 5 lakh rupees. Actual rent is, can you tell me how much is the actual rent? 50,000 rupees per month. And for the year, see, self-occupied 5 months, vacancy 2 months. So it means actual rent is 50,000. 5 months it is self-occupied, so it was not let out, so there is no rent for that. 2 months it is it is vacant, so there is again no rent for 7 months. So only for 5 months we got the rent. For 5 months we got the rent. So it is 2,50,000. Guys, everybody is agree with me how I got 250? Should I repeat it or not? I'll wait for your confirmation. Everybody got it how I got 5 months? Correct now? Because 5 months it is self-occupied, 2 months it is vacant. So it means that only 5 months it is let out. So 250 is the let out portion. Okay. Expected rent, actual rent. Now we understand GAV is expected rent or actual rent, whichever is higher. So we will say 5 lakh. But whenever there is a vacancy, we should compute the proportionate expected rent. So how is proportionate expected rent is computed? Just exclude the vacancy period. So how much is the vacancy period? 2 months. Just exclude 2 months. So we have 12 months in a year. 2 months I'll exclude. So I have to compute PER of 10 months. So this 5 lakh is for the entire year. So 5 lakh divided by 12 into 10. So I will get 4,16,667. This is the P here. Correct? Now, just for comparison, because there is a vacancy and I have excluded the vacancy period, 2 months I have excluded, 10 months I have taken now. Now, just for comparison, compare actual rent or proportionate expected rent. Actual rent is 250. Proportionate expected rent is 416, whichever is higher. 416,667 is higher. So in this case, PER is higher. If PER is higher, G will become my expected rent 5 lakh. So in this case, GAV will be 5 lakh. I believe that you are able to recall this provision also. See, if actual rent would have been higher, then there would have been no problem. Let's say this would have been 550. Then in that case, there is no problem. Then 550 would be my answer, GAV. But in this case, if PER is higher, then ER will become your GAV. Mahendra and others, everybody understood this or not? Okay, so please, in house property, please remember that how to compute the pre-construction interest, how to give the deduction of 24A, 24B. In case of self-occupied property, you have to take nil. In case of it is optional regime, then 24A, 24B is limited to 2 lakh or 30,000 rupees. In default regime, it is there is no deduction available for self-occupied property. It would be nil. Okay. Now let us start with our PGBP. Section 28 is now everybody knows that what is section 28. Let me quickly rephrase it. So section 28 is a charging section of PGBP. Some important points which I'll be discussing, because most of the thing you already know about PGBP. But most of the important thing is that gifts perquisite during the course of the business. Yes, this is important. In your examination, let's say there is a professional. Generally, if the question comes of any professional, and PGBP generally you will find in your total income question. So let's say this person is a doctor and his patients are giving him gifts or perquisites or any perquisites, or their family members are giving him perquisites. Or let's say there is a chartered accountant, there is a lawyer who are receiving gifts or other facilities. So please make it taxable as PGBP income. So generally in your total income question, you will get like this. So this person is a doctor, his patients or his family members are giving him gifts or any amount. Please make it PGBP income. So gifts or perquisites in the course of business or profession, that is PGBP. Non-competing fees, you all know. Some receipt from keyman insurance policy. So keyman insurance policy, you understand. Keyman insurance policy, guys, it is always taxable. Whenever you receive the amount of keyman insurance policy, it is always taxable. See, keyman insurance plays role in 3 chapters. Now it depends on who is receiving this money. So if the employee is receiving this money, so whatever is the money received, it will become his salary income. It will become his salary income. If the employer or the business is receiving this money, it will become their PGBP income. Section 28 is covering it. If this money is received by any other person, if any other person is receiving this money who is neither an employee nor a business, then it will become IFRS income. Generally, for your examination, these two are important. So if keyman insurance, although keyman insurance is not a very important point, but if it comes, then it could be either employee is receiving this money, please make it salary income, entire money make it taxable as salary, or if the business is receiving this money, the entire money is of the keyman insurance policy is PGBP. Got it? Although if you ask me, keyman insurance policy is not that important point. Inventory converted into capital asset. So let's say if you have a stock, see in capital gain, we generally do that if a capital asset is converted into a stock in trade. This is the concept of capital gain. But PGBP, if we are converting our stock into a capital asset, if we are converting our stock, it's a reversal of that. If we are converting our stock into a capital asset, so whatever is the fair market value on conversion date, whatever is the fair market value on the conversion date, please make it your PGBP income. Not that important, but still might be little minor adjustment can come in your total income question or in your MCQs. Please don't forget about it, that whenever the stock is converted, guys, in capital gain, I'll be discussing about this when capital asset is converted into stock. But right now I'm discussing that whenever the stock is converted into a capital asset, so as and when it is converted, the same day we'll make it taxable as PGBP. The same day we'll make it taxable as PGBP, and whatever is the fair market value on the conversion date, please make it as a PGBP income. Got it? Now, remuneration received by the partner. Okay, let me discuss about partnership firm also. So you understand. So let's say there is a partner in a partnership firm. And this partner is receiving any remuneration from the partnership firm, or this partner is receiving any interest from the partnership firm, or this partner is receiving any share of profit. So this partner is receiving, this is the partner, and if he is receiving one, interest, second, any other remuneration, third is share of profit. Now it depends. Generally, if question is silent, then always assume that this partner is a working partner. But if the question specifically tell you that this partner is a non-working partner, then you have to proceed accordingly. First of all, share of profit. You all know that whenever a partner receives a share of profit, that is an exempt income. So it does not depend whether you are working, whether you are non-working, it is an exempt income. So how you will get it, please don't make a mistake over there. I don't want you to make the mistake over there tomorrow. So let's say it's a total income question and it's a P&L account of the assessee. Let's say this is a P&L account of Naresh. For example, this is a P&L account of Naresh, and it is given to us that Naresh is having a business and he's also a partner in some firm. In some firm. And here it is written share of profit. He has written a share of profit. Whatever the amount is, let's say 1 lakh, he has received it from the partnership firm. So please, this 1 lakh, it is an exempt income. Delete it from here, from his P&L account. Please delete it. It is not PGBP income. And where you will take it, please don't take it anywhere. This is not a taxable income. Got it? So share of profit is always exempt. So please delete it from here and don't take it anywhere. It is exempt. If this person is receiving interest, so let's say if it's a total income question and it is written over here that he has received interest. Let's say he has received interest on capital of 1.3 lakh. And if nothing is mentioned in the question, then guys, whatever the interest which we receive, a partner received from their partnership firm, it is PGBP income under section 28. Please make it taxable under PGBP only. So if it is already sitting in your penal account credit side, so there is no problem at all. It is perfectly sitting right here. So please don't make any problem here, right? So if nothing is mentioned, please make it PGBP only, and it is perfectly sitting at the right place. In case it is given to you that this interest on capital, it is, let's say, for example, it is 13% per annum. Let's say it is 13% per annum. It is important. Guys, only up till 12, had it been 12%, 11%, 10%, then I have no issues. I have issues if it is more than 12% per annum. So please, any interest on capital which is exceeding 12%, so that excess is not our income. It's not the income of the partner. So let's say 1.3 lakh, it is equal to 13%. So just 1%, which is excess of 12%. So out of this 10,000, I believe that everybody can able to calculate 10,000 rupees. Why? Because that's 1,30,000 is 13% into 12% becomes 120. 120 we can allow, but 10,000 is the extra amount. 10,000 is the extra amount. Please don't make it taxable in the hands of Naresh. In the hands of partner, please don't make it taxable. Only up till 12% make it taxable. So if a partner is receiving interest, whether this partner is a working partner or non-working partner, same treatment you will give. It becomes a PGBP income up to 12% per annum. Up to 12% per annum. In excess of 12%, please don't make it partner income. Everybody understood this point also or not? So if you will get 1 lakh as a partner's share of profit from the partnership firm, please delete it from here because it is not a taxable income for the partner. Second, if you receive interest on capital, so if it is up till 12%, then we are okay. In excess of 12%, that excess shall be ignored. Sorry, that excess should not be our PGBP income. Please delete it. Everybody is okay with this interest on capital? Working, non-working, for interest on capital, there is no issue. Next is remuneration. If in your question, especially in your total income question, you will find that there is any salary which you are received from your partnership firm. So whatever is the amount, it is perfectly sitting right over here. No need to make any adjustment of it. Any remuneration which you receive, it is your PGBP income. It is your PGBP income. Let's say in your question, it is not given right here. It is given in information, then please make it your PGBP income. And generally we assume that this partner is a working partner. So remuneration which a working partner receive, it is PGBP income. And generally we assume that the partner is working. So remuneration is a PGBP income. If it is sitting over there, then it is perfectly fine. Although there is a limit also to it, depends on book profit. That book profit I will discuss separately. But yes, if nothing is mentioned, so any salary, commission, remuneration which you receive from the partnership firm, it becomes your PGBP income. If you are a working partner, very, very important. If I would have been the examiner, I would have given this point. If let's say Naresh is having a business and he's also a non-working partner, he's also a non-working partner in some firm. So it is written that he's a non-working partner and he's receiving salary. So if a non-working partner will receive remuneration from the partnership firm, it is not taxable. Why? Because his partnership firm will pay tax on this income. Partner will not pay tax. So remuneration which you receive, it is not taxable in the hands of non-working partner. But if it is a working partner, then it is PGBP. So to sum it up, whenever partner receives share of profit, it is exempt. Working, non-working doesn't matter. If they receive interest on capital, it is their PGBP income. Working, non-working does not matter, but up till 12% only it is PGBP. In excess of 12%, it is not an income. It is not an income. So in excess of 12%, please delete it, subtract it. Remuneration which the partner receive. If the partner is working partner, please make it PGBP. If it is already sitting in P&L account credit side, then fine. If it is not sitting, please make it PGBP. And if this person is a non-working partner and he is receiving remuneration, please don't make it taxable. I believe everybody got it about the partnership firm. Harish has a question. He's asking that, sir, where is the in excess of 12% would be taxable about interest? See, in excess of 12%, firm will pay tax. So right now, in your question, you don't have to calculate for the partnership firm assessment. You are doing for the individual. So in excess of 12%, it will be disallowed in the hands of firm. So firm will pay the tax on it. You don't have to pay. You means the partner does not have to pay tax on it. So partner does not have to worry about that. Got it? Okay. Export incentive, not so important, but you understand that if you receive export incentive in the form of cash assistance, in the form of import entitlement license, sale of import entitlement license, not so important, but yes, these are also PGBP income. Compensation on breach of business contract. Whenever you breach your business contract, if you receive any compensation, that is your PGBP income. And some receipt on transfer of 35AD asset. Whenever what is 35AD asset? Specified business. So whenever we sell this 35AD asset, because 35AD we claim 100% deduction, right? That says the 14 businesses which we have, specified businesses, optional regime, we take 100% deduction. And whenever we sell it, let's say we in the first year we have taken 100% deduction, and second year, third year, fourth year we are selling it. So whatever is the selling price, that will become our PGBP income. Got it? Section 28. There's a little amendment in section 28 which is not that important, but still this amendment was that if a person is into a business of letting of property, if the person is into a business of letting of property, so what type of income it is? So initially, some people used to tell it is PGBP. Some people used to tell it is house property. So it was clarified this year that if you are into a business of letting of property, if it is your house property, if it is a residential house property, then it is your house property income. But if it is your commercial property, it is PGBP income. Let me explain it to you once again. So let's say Mr. A is into a business of letting of property. He is engaging his activities or businesses that he let out property. He lets out property. Let out of property business. Correct. Now it depends what kind of property he's letting it out. So let's say if he is letting it out residential property, or he is letting out commercial properties, which is non-residential. So letting out of commercial property is PGBP, and letting out of residential property is house property income. This is just the amendment, right? So if you are into a business of let out of the property, and if it is a residential property, please make it house property. If it is not a residential property, it's a commercial property, please make it PGBP. Everybody okay with this? You are into a business of let out property. Okay, now, very good. Now, how do you do the computation? We all know it. How do we do the computation? First, we start with net profit as per P&L account. So whatever is the net profit as per P&L account, we start with that. We all know how do we compute it. Let's say this is the P&L account given to us. These are the expenses side. These are the income side. This is the net profit. So we start with the net profit. Step 1, net profit as a P&L account. Second step, we look at the expenses, whatever the expenses which are allowed under section 30 till 37, these are allowed. And if there is any expense which is specifically disallowed, let's say you have made a payment in cash, more than 10,000 rupees in a single day, please don't allow it. And in fact, in your examination, if it is written that the payment is made of more than 10,000 rupees in cash, please always assume that it is made on a single day. Please disallow that, right? Or if you have made a payment to a related party in excess of fair market value, so in excess of fair market value, you will disallow it. Generally, guys, generally in your examination, especially in your total income questions, you will get these type of adjustment. One is cash payment. You have made a cash payment, or you have made a payment through non-prescribed modes like bearer check, cross check, etc. It is not account pay check, bank draft, etc. That is allowed, but non-prescribed mode, it is not allowed. So if you have made a cash payment, please disallow. if you have made a payment to a related party. Now, please understand that who is a related party also. Let me do that particular section side by side. So please also understand that who is the related party. So let's say the related party for individual, especially for individual, the related party is spouse, children, parents, brother and sister. That's it, full stop. These are the only related party, guys. Parents, brother and sister. So if you have made the payment to your spouse, children, brother, sister, or parents in excess of fair market value, please disallow that that excess. But if you have made a payment to any other person, then you can allow it. Even if it is in excess of fair market value, then please allow it. Section 40 capital A2 will not disallow it. Let's say, so in your examination, few attempts before, they have asked you that if the individual has made a payment to sister-in-law, a sister-in-law, let's say this person has made a payment to sister-in-law rupees 1 lakh, and the fair market value is, let's say for example, 70,000. So 30,000 we have paid extra. So most of the students have disallowed it. No, because sister-in-law is not a related party. This section is only applicable to related party. So if you are making a payment to a related party, then in excess of fair market value disallow. If the assessee has made a payment to a non-related party, so even if it is more than fair market value, we don't have any problem with it. So if sister-in-law payment has been made 1 lakh, whatever is the fair market value does not matter. It will be allowed. Everybody okay with it? So one of the adjustment you get for cash payment, please don't allow more than 10,000 rupees. If it is for related party, don't allow in excess of fair market value. Third type of adjustment generally which you get is that you have made the payment without TDS. You have made the payment without TDS. And generally, we will assume that this payment was made within India. So 30% we will disallow. Without TDS, 30% we will disallow. If it is paid outside India, then 100% will disallow. That I'll be discussing again in section 40 small a. And fourth one, which you generally get, is for section 43B. Section 43B is expenses allowed only on actual payment. So you understand that there are 7 types of expenses which are allowed only on actual payment. If the actual payment is made up to the due date of ROI, then only you will allow it. Otherwise, you will not allow it. Any taxes, any amount of taxes which is paid to the government, bonus or commission, or interest on loan taken from bank, etc. So that adjustment also you can get. So this is an important thing. Cash payment, related party, without TDS, section 43B. These are the important things. And depreciation also a little bit important, that you have debited, let's say 2 lakh rupees as depreciation in penal account, but as per the income tax, it is something else. Then you should know that you will disallow this and you will allow only that depreciation which is allowed under section 32. Okay, coming back. So this is how you would do your section 29, that is computation of PGBP. Section 30 is an easy section, expenses related to building. So if you have paid rent, repairs, insurance, etc. of building, even taxes of building, that is allowed under section 30. But please remember, these expenses should be revenue in nature. Let's say we have incurred repair expenses, so it should be revenue in nature. So again, one of the adjustment which examiner asks you, let's say this is a penal account, and in penal account they have said to you that this is repairs of building, whatever the amount, let's say 1 lakh. This is repair of building 1 lakh. So we will simply allow it under section 30. And if the question says that this repair is of capital nature, then please don't allow it. And there is one more hidden adjustment in that. What is the hidden adjustment in that? Please allow depreciation also. So in that case, if in your information it is mentioned that this repair is of capital nature, then please disallow this 1 lakh first. First of all, add back this 1 lakh because it is capital in nature, and then less the depreciation on this, because anything which is of capital nature, it should be depreciated. So depreciation, and that is for building, depreciation at a rate of 10% of 1 lakh. And if it is put to use for less than 180 days, please also remember that, then give half depreciation to it. So everybody is able to recall this provision also, that if it is any expenses which is related to capital, then it is not allowed. Capital nature expenses are not allowed. And second, first of all, disallow it. One. Second thing is that please give depreciation also, and that too, please also see that whether it is put to use for more than 180 days or less than 180 days. Got it? This, are you able to recall this particular point also? Okay. Next, very good, very good. Next is, guys, if it is taxes, you understand rates and taxes are allowed on payment basis. So this is subject to 43B. If these taxes are paid up to the due date of ROI, then you can allow it. Otherwise, if they are not paid up to the due date of ROI, then please disallow them, right? Other expenses can be allowed as per the method of accounting followed by the assessee. So rent of building, repairs of building, insurance, etc., even if it is not paid, doesn't matter. They're allowed on accrual basis if the assessee is maintaining accrual basis of accounting. And generally, we assume that the assessee maintains accrual basis only. But for rates and taxes, this is subject to 43B. Section 31, it is repairs and insurance of plant, machinery, and furniture. So you understand plant, machinery, and furniture expenses are allowed under Section 31. But please understand these repairs should be a revenue nature. It should not be capital nature. If it is capital nature, disallow them and give the proper depreciation to them. Okay. Then Section 32. Section 32 depreciation. And you all know what are the rates of depreciation is. Okay. I believe everybody's familiar with the rate of depreciation. Let me recall it once again. If it is building, the general rate of depreciation is 10%. If it is residential buildings, residential accommodation, guest house, the rate is 5%. If it is temporary building, the rate is 40%. I believe everybody is okay with this rate. So generally, you will apply 10% on building. If it is residential building, it is 5%. If it is temporary building, it is 40%. On plant and machinery, the general rate is 15%. On motor cars, also it is 15%. But if this motor car are used by such a business which are into hiring of motor car business, then the rate will become 30%. But generally, all the plant machinery should be depreciated at 15% rate, including motor car. But if motor car is used in higher business, then 30%. For computers, for laptop, for books, whether these books are regular books, whether these books are annual publication, whether these books are library books, doesn't matter. It is 40% for all. So for books, library books, computers, computer software, etc., computer accessories, printers, UPS, scanners, etc., 40% rate. Aeroplanes, aero engines is also 40%, not that important. Pollution control equipment is also 40%, not that important. Computers, laptops, books are important. And for other plant and machinery, the general rate is 15%. For furniture and fittings, we all know that the depreciation rate is 10%. For intangible assets, the depreciation rate is 25%. We all know. One more thing which you should remember, for intangible assets, it is 25%, but on goodwill, you will not charge depreciation. Intangible assets could be copyright, it could be patent, it could be know-how, but if it is for goodwill, please don't charge depreciation on goodwill, right? Please do remember, examiner can ask you, this is quite tricky, that on goodwill, we will not charge depreciation, correct? So goodwill is not included over here. Other assets can be charged at 25% rate. And you all know that if the asset is put to use for less than 180 days, then it is half depreciation. And we calculate depreciation blockwise. Some people make a mistake over here. So let me recall it once again for you. Let's say it is a plant and machinery block of 15%. For example, it has an opening WDV. Opening WDV of the block is 10 lakh. And some asset is acquired during the year. Let's say additions during the year, add additions during the year. We have added something. Clinical equipment rate, all equipment rates, Sham, it is 15%. 15%. For all other equipments, it is 15%, 1.5. Okay. Now, additions during the year. So let's say we have added a machine and we have purchased it on 1/4/2024. During the year, we have purchased it and we have used it. Let's say I have given you the date. What was the date? 4th October. Please remember that date, 4th October. So anything which is used on or after 4th October, that is, if you calculate from 4th October, you will get 179 days. That is half. So let's say it is used from 4th October 2024. It means half. So for example, you have added during the year rupees 3 lakh rupees of machine, and you have also sold less of the old machines. You have sold some part of the block, money received on sale, money received on sale or disposal. So let's say some part of the block is sold also, for example, of 8 lakh rupees, of 8 lakh rupees. Then how you should do this? So I'm again repeating, opening value of the block is 10 lakh, additions during the year is 3, less money received on sale or disposal is 8. So 10 plus 3, 13 minus 8, you will get 5 lakh. Now please ask yourself whether the entire block is sold or the part of the block is sold. The part of the block is sold. So now we can charge depreciation on this 5 lakh. This is called WDV at the end for charging depreciation. We all know this is called WDV at the end for charging depreciation on 5 lakh rupees. And how you should charge depreciation. Some students, I don't know why, again and again they make a mistake. They charge depreciation on this amount and on this amount. No, you have to charge depreciation only on this amount. Only on 5 lakh you have to charge depreciation. And if you remember, I used to tell you that first of all ask that whether the asset which is purchased in this year, whether the asset which is purchased in this year, do we have that also or not? The answer is yes, we have that new asset. So that is 3 lakh. And whatever is the balancing figure, so in this case, out of 3 lakh, out of 5 lakh, you have taken 3 lakh as the new asset. So whatever is the balancing figure, 2 lakh. On this 2 lakh, please charge depreciation. Correct? So total depreciation should be charged on 5 lakh only. On this 5 lakh only, the depreciation should be charged. So if it has any new asset, then please take it out. 3 lakh. Whatever is the balancing figure, you charge depreciation on that. So on 3 lakh, let's say it is 15% block and it is acquired in this year, but put to use on or after 4th October, that is less than 180 days. So you understand half depreciation on this 7.5%, and on this remaining, it is full depreciation. So it is 30,000 over here. It is 22,500 over here. So the total depreciation comes to 52,500. Everybody is okay with this? Now, if the assessee is following optional regime, you understand that in PGBP, there are only 3 differences in optional regime and default regime. Everybody remember this? Let us recall it once again. In PGBP, in entire PGBP, if you are following optional regime, if you are following default regime, only there are 3 differences. One is additional depreciation. You get additional depreciation in optional regime, but you don't get in default regime. Second is section 35, outside research. You don't get in default regime, but in optional regime, you can get it. The third and the last difference is 35 AD, specified businesses, where we have 14 businesses, capital expenditure. We don't get in default regime. Are you able to recall this? So only at 3 places, there is a difference in additional depreciation. There is a difference in optional regime and default regime. One is additional depreciation, section 35, outside research. In-house research, you will get in both, but outside research, you will not get in default regime. 35 AD, 14 businesses, it is for optional regime only. Now, guys, this is the depreciation. This is the normal depreciation. 30,000 plus 22,500. If the assessee is following default regime, then we are okay with this depreciation, 52,500 in total. But in case it is mentioned in the question is indicating towards additional depreciation. First of all, you are computing as per optional regime in your question. If you are computing as per optional regime, and the question is giving you indications, the question will give you indication. What type of indication they will give you? On plant and machinery, because you understand additional depreciation is only on plant and machinery. It is not on furniture. It is not on building. It is not on intangible assets. It is on plant and machinery. That too, plant and machinery should be new plant and machinery. It should be installed in factory. It should not be motor vehicles or other vehicles. So if these conditions are satisfied, so how they will be giving you an indication? They will be telling you it is a plant and machinery. It's a new plant and machinery installed in factory. in that case, you have to give additional depreciation also. In that case, you have to give additional depreciation also. And how much is the additional depreciation, guys? Additional depreciation is 20% of the actual cost. The actual cost is 3 lakh. So 20% of 3 lakh, it would be 60,000 rupees. But however, you also know that if the asset is put to use for less than 180 days, so 10% we will get in this year, 10% we will get in next year. So here we will get 10% since it is used for less than 180 days. So this is additional depreciation. Let me recall it once again. Additional depreciation is the concept of only under optional regime. It is not a concept of default regime. In default regime, please don't give additional depreciation. Additional depreciation is only on new plant and machinery if it is installed in factory. It is not on vehicles and not available on any asset where 100% deduction is charged. That point is not that important for you. But yes, please remember should be installed in factory and that should be new plant and machinery. How much? 20% of the actual cost of the asset. This is the additional depreciation only under optional regime. But if the asset is put to use for less than 180 days, 10% in this year and 10% in the next year. Got it? One more point which I would like to discuss. Let's say, for example, opening WDV of the block is 10 lakh. Additions during the year is 3 lakh. It is acquired in this year but used from 4th October or thereafter. That is less than 180 days. And the money received on sale or disposal. Part of the block we have sold. Part of the block we have sold. And part of the block we have sold. Let's say it is for 11 lakh. Part of the block we have sold it for 11 lakh. Still the part of the block is remaining. So first of all, what you will do, opening value 10 lakh, additions during the year 3, 13 minus 12. You will get 2 lakh rupees. Correct? You will get 2 lakh rupees over here. Ask yourself whether it contains the new asset. The answer is yes, it contains the new asset. How much? It is for 3 lakh. So it contains let us assume that the part of the block which is sold, which is of old machines. This new machine still we have. So please ask the question whether it contains the new asset. The answer is yes. How much it is for? 3 lakh. Take 3 lakh out from here. You can't take 3 lakh out from here because it is only 2 lakh which is available. So whatever it is available, keep it 2 lakh over right here. And what is the balancing figure? Obviously 0, because entire 2 lakh you have taken it for the new asset. Now in this 2 lakh, because it is used for less than 180 days, half depreciation 7.5%. And on this one, obviously it is 0. There would be no depreciation. So this is the normal depreciation. In case you are following default regime, then there is no additional. But if it is optional regime, then additional depreciation also. Now, in case if I would have sold it, if I would have sold it for rupees, let's say 14 lakh. If I would have sold it for 14 lakh, so 10 plus 3, 13 minus 14. Part of the block is sold for 14. Now you all know that my total assets, the total expenses which I have made is 13, but I have recovered 14. So WDV at the end will become nil. There would be no depreciation in this case. Why? Because whatever you have expended, you have recovered it. And even you have recovered more, so 1 lakh would become your short-term capital gain. You understand it is a short-term capital gain, rupees 1 lakh. Everybody is okay with this short-term capital gain also? In case the entire block is sold, so for how much it is sold doesn't matter. In that case, it would be a short-term capital gain or short-term capital loss if the entire block is sold. So in that case, you cannot compute depreciation. Why? Because you don't have block of assets if entire block is sold. So this was section 35. Power generating units. You understand that power generating units have an option that they have to exercise in the very first year, that if they would like to follow the SLM method. So if they would like to follow the would like to follow the WDV method, then there is no problem. The same method which we have done so far, we have to follow that. But for power generating unit, if they are following SLM method, they would be charging depreciation as per the SLM rates. We don't have to remember SLM rates. Examiner will not ask you to compute the depreciation also. But what the examiner can ask you, that we have sold a power generating asset. We have sold a power generating asset on which SLM depreciation was charged. So let's say the original cost of the power generating asset was 10 lakh And we were charging 1 lakh, 1 lakh, 1 lakh each year as depreciation on SLM basis, 1 lakh each year. And let's say 3 years have already been passed. And in the fourth year, we are selling it. In the fourth year, we are selling it. So you all know that the original cost of the asset was 10 lakh. So I believe that you are all able to recall this number line. So I used to prepare this. So let's say the original cost of this asset is 10 lakh. The written down value of this asset is, how much is the written down value? It is, because 3 years, fourth year we are selling, in 3 years we have charged depreciation, let's say 1 lakh, 1 lakh, 1 lakh. So the written down value is 7 lakh rupees. So in the fourth year we are selling it. You all know that if we are selling it at more than 7 lakh, it is a profit area. From 7 to 10 lakh, it is PGBP income. From 7 to 10 lakh, it is PGBP income. From more than 10 lakh, it is a capital gain. It is a capital gain. And if it is sold for less than 7 lakh, it is a loss. And what type of loss it is? It's a PGBP loss, which is known as terminal depreciation. This we can claim it as a loss. So if this is the original cost, this is the written down value. So this green area is the PGBP income. This is a PGBP income that we also call balancing charge, taxable under PGBP. If it is more than the original cost, it is a capital gain. But if it is less, it is a terminal depreciation. Now, please understand that how you will get this question in your examination. Generally, it is one of the adjustment in the total income question. Let's say, don't write it, just listen to this. So let's say in your P&L account, you will get like this. By profit on sale of power generating asset. You will get like this: by profit on sale of power generating asset, let's say 5 lakh. Correct? In your P&L account, it is 5 lakh rupees. Profit on sale of power generating asset. And in your information, it is given that this power generating asset is sold during the year. Its original cost was rupees 10 lakh. Its original cost was rupees 10 lakh. And it is on 1/4/2024, its written down value was rupees 8 lakh. And we have sold it for 13 lakh. We have sold it for 13 lakh. So we understand that the written down value was 8. We sold it for 13 lakh. So 5 lakh profit we have made, that is already credited in the P&L account. So this is what the scenario is. So how you should compute, and let's say it's a total income question where you have to compute your PGBP also and capital gain or other things also. So now you understand, just simply make a number line in your rough area. In your rough area, make a number line. So please tell me, how much was the original cost? The original cost was 10 lakh. How much is the written down value for this year? The written down value was 8 lakh. So you know that the asset is sold for 13 lakh. So it is a profit area. So from 8 till 10, it is deemed business income under section 41 PGBP. And in excess of 10 lakh, it is capital gain. So please understand, out of this 5 lakh, can you please tell me, out of this 5 lakh, how much is PGBP and how much is capital gain? How much is PGBP and how much is the capital gain? So you understand, from this 8 to 10, 2 lakh is PGBP. Correct? And 3 lakh is capital gain. Correct. Devipriya, Harish, correct, Pradeep. Now, in this case, so in your P&L account, in your examination, your total income question, your P&L account is giving you 5 lakh rupees sitting in your P&L account. So you will say 2 lakh, we are okay with it. 2 lakh, we are okay with it. And we are not okay with this 3 lakh. We are not okay with this 3 lakh. So please delete. So whenever you will be computing your PGBP, please delete this 3 lakh rupees from here, subtract, because it is not a PGBP income, it is a capital gain income, and please take it in your capital gain. So 3 lakh should be subtracted from your PGBP and you should take it in your capital gains. Got it? So this is the adjustment which you can get in your total income question related to power generating unit. The section 33 is not in your course. Next section is section 35. It's been 2 o'clock. I think that we can take a lunch break right now. You should also have your lunch. So can we take a break for 30 minutes now? All right. So we'll meet at 2:30, guys. We'll meet at 2:30. Pollution control equipment, Harini, it is 40%. Not that important, but yes, it is 40%. Pollution control equipment is 40%. Okay. So guys, we'll meet at 2:30 p.m. Okay. So you might see during this period, I would be charging my iPad also. So you might not see my iPad screen for next 30 minutes, but I'll be back at 2:30, right? And if you want to drop and you would like to join again, then you can join back at 2:30. So there is a half an hour break. Okay, I think we can start now. Okay. Next section is quite easy, scientific research. Am I audible now? Okay. Next section is scientific research. We all know that scientific research, in outside research, only optional regime people will get. If the assessee is following default regime, they will not get for outside research. Outside research, let me complete it. It is a kind of donation which we are giving to IIT, National Laboratory, or any approved institution or association. 100% deduction is allowed for outside research. If we are paying to that particular institution, if it is an unapproved institution, then we will not get it. It should be an approved institution. The day when we are giving this money, it should be approved on that day. Subsequently, if the approval is withdrawn, that does not make any problem. So we can get this deduction, no issues. But please, under optional regime only, in default regime, you will not get this. For in-house research, you will get this deduction. 100% deduction you will get for in-house research. Whether you are following optional regime, whether you are following default regime, doesn't matter. For revenue expenses also section 35 would be allowed. For capital expenses also section 35 allowed, but not on land. If you are spending money on land, then you will not get it. If it is for building, you can get it. It is not that important, but the only thing which is important for scientific research is again the sale of scientific research asset. 2-3 things which you should know about the scientific research asset. First, whenever a scientific research asset, let's say there is any scientific research asset, you have the assessee has purchased. For example, the assessee has purchased the scientific research asset for 20 lakh in any previous year. Let's say in previous year 22-23, he has purchased it for 20 lakh. You understand 100% deduction is allowed on scientific research asset. Section 35 will claim 20 lakh rupees entirely deduction, and the value of this asset will become nil. If we are transferring this asset into our normal business, now, so the actual cost of this asset should be taken as nil. So it should be added in the value of the block, but at nil value. So this is the one thing which you should remember. Second thing is that if you have purchased a scientific research asset, 100% deduction you have claimed, and now you are selling it. So what is the treatment on sale of asset? Same like power generating unit. So it is like, so let's say the original cost of the asset is 20 lakh. And obviously section 35, you have claimed 100% deduction. So the written down value is 0. So whenever you will be selling it, whatever is the amount up till 20 lakh, it is your PGBP income under section 41. Over and above your original cost, it would be the capital gain. So this is again the same treatment as we were doing in the case of power generating unit, right? So this is about scientific research. Although this is not that important point in section 35 as far as examination are concerned, but yes, let me discuss this also. So if you have the assessee has incurred expenses before the commencement of business, they are also allowed. Last 3 years expenses are allowed for scientific research. Capital expenses, all expenses are allowed except land. On land, you will never get deduction in the entire income tax. But for revenue expenses, see, if there is revenue expenses after commencement, then there is no issue. But if they are before commencement, then it is allowed only salary and raw material. Only salary and raw material is allowed, not any other revenue expenses if it is before commencement. But after commencement, all revenue expenses are allowed. Not that important from examination point of view. From examination, this point is important, that what is the treatment on sale of scientific research asset. Got it? Then we have another section 35AD, little bit important. 35AD is for specified businesses. So we have 14 specified businesses, that if the assessee is engaged in these 14 businesses, and if the assessee is following optional regime, see, in default regime, 35AD deduction is not allowed. In default regime, 35AD is not allowed. So I have already mentioned that there are 3 differences in PGBP. One is additional depreciation. Second is this outside research, scientific research outside. And the third one is section 3580 specified businesses. So specified businesses, these are the 3 points where there is a difference in optional and default. So 3580 is for specified business, optional regime only. 100% reduction allowed for capital expenditure. 100% reduction is allowed on capital expenditure. And we have 14 businesses. You don't have to remember the dates of these businesses. Let me quickly read these type of businesses. Cross-country natural gas pipeline network, cold chain facility or cold storage, warehouse for agriculture produce, and then we have warehouse for sugar sugar also. So although sugar is an industrial produce, but sugar was also included. 2-star or above category hotel, beds, hospital of 100 beds or more, housing, slum redevelopment, affordable housing, fertilizer production business, inland container depot or custom freight station, beekeeping business, warehousing for sugar, iron ore slurry pipeline, semiconductor wafer fabrication, developing and maintaining of new infrastructure facility. You don't have to remember all these, you don't have to learn these list, but you should know that yes, these are some of the businesses which are covered under 3580. Most of the common businesses are cold chain facility, warehousing for agriculture produce, 2-star or above category hotel, and hospital of 100 beds or above, right? So whenever the assessee has incurred capital expenditure on these businesses, 100% reduction can be allowed. Now, if there is a loss in such business, so this loss can be set off only from these 14 businesses. Only from these 14 businesses it can be set off. It cannot be set off from other businesses. One thing. Second, if the losses for how many years it can be carried forward, generally we understand that normal business losses can be carried forward for 8 years. But in case of 3580, these losses can be carried forward for unlimited number of years. So please remember that the losses of these businesses can be carried forward for unlimited number of years. Now, the most important thing which can come in examination regarding 3580 is that whenever you claim 3580 deduction, then there is a lock-in period of 8 years. There is a lock-in period of 8 years. If you transfer this asset into your normal businesses, in any other businesses except these, that is called normal business or non-specified businesses. So whatever the deduction we have given it to you, we will take it back. So that is important. So if there is, so this is one of the important point in 3580. Whenever you claim a deduction under section 3580, let's say there is a machine of rupees 20 lakh. There is a machine of rupees 20 lakh. The assessee has purchased it in previous year 22-23. And the assessee has claimed a deduction under section 3580, 100% deduction he has claimed. Got it? Now, there is a lock-in period of 8 years. This asset should not be transferred before 8 years in any other businesses. Let's say now in previous year, 24-25, we are transferring it into normal business. So that is before the expiry of 8 years, we are transferring into normal business. So whatever the deduction we have claimed earlier, it will become our income. So in this year, PGBP income will arise. How much it would be? Whatever the deduction we have claimed earlier. So we have claimed 20 lakh deduction earlier. That will be our PGBP income. However, the assessee will get a benefit of deemed depreciation because this person has not claimed depreciation. He will say that, sir, if I would have used this asset from the very beginning in my normal business, at least you should have given me depreciation. So what we will be giving over here, so 20 lakh will make it his income, but after reducing the deemed depreciation. I believe that you are able to remember this point also. So what we will do, so in 22-23, previous year 22-23, we will ascertain that how much would have been the deemed depreciation. So let's say it is a machine. For example, it is building, then apply 10%. If it is machine, then apply 15%. So let's say 15% I'm applying. So in this year, 20 lakh into 15%. So it would be 3 lakh depreciation I will give. Then the asset value will become 17. After that, for previous year 23-24, also last year also we would have given him a depreciation and he has not claimed it. So on 17 lakh, I believe everybody understood how I got 17 lakh. This is the written down value. 17 lakh, we'll charge again 15% depreciation. So whatever is the depreciation, it will come. Then, so let's say on 17 lakh, 15% would be 2.55 lakh. This is the depreciation. So 3 lakh plus 2.55 lakh, that is 5.55 lakh is the deemed depreciation. So his PGBP income will become 20 minus this 5.55. So I believe it will be 14.45. It will become his PGBP income. So this is the PGBP income if it is transferred before 8 years. If it is transferred after 8 years, then there is no problem. But if it is before 8 years, then please arise as PGBP income. This is little bit important from if section 35AD adjustment comes. This is the one thing which is important. Understood? And if we sell our, let's say before 8 years or after 8 years, whenever we sell our this section 35AD asset, it becomes our PGBP income. So it is very easy. Section 35AD, because in section 28, that is the charging section of capital of PGBP, we have done that whenever the scientific, I'm calling a scientific research, it is whenever a 35AD asset is sold, then it becomes our PGBP. So whenever it is sold, whether it is before 8 years, after 8 years, doesn't matter, it will become our PGBP. But that is not that important. This one is important. If it is transferred into normal, and we are not selling it, if it is transferred into normal business, then PGBP income will arise. Got it? And you also know that if a person is claiming section 35AD deduction, then he is not allowed to claim deduction under section 10AA or chapter 6A, that is 80IA other series, which is not in our course. But please remember, this is not a very important point from examination point of view. This is not that important point, although we have done in our classes, but this is not an important point. But please just remember that if 35AD is assessee is claiming, he will not be able to get deduction under other sections, right? And there is a lock-in period of 8 years, and whatever is the deduction which we have claimed minus deemed depreciation will become the PGBP income before, if it is transferred before 8 years. Got it? 35D guys, 35D, 35DD is not in our course, but 35DDA VRS expenses. This is very important. Preliminary expenses or VRS expenses, generally 99%, if you will get this, so you will get this by this way, that there are certain preliminary expenses or VRS expenses. So for example, any of them, let's say it is 1 lakh rupees. I've written it. Okay. Let's say it is 1 lakh rupees VRS or preliminary expenses. So please remember that these expenses are allowed, but not fully. Only 1/5 will be allowed. 4/5 will be disallowed, because 4/5 will be allowed in next 4 years. Total we have in 5 years, we allow it, but 1/5 only will be allowed. Please don't make a mistake over there. You can see this preliminary expenses or VRS expenses. Out of 1 lakh, 1/5 will be allowed. That is 20,000 we can allow. 4/5, 80,000, simply disallow it. So please don't make a mistake over here also. Now for preliminary expenses, I don't think it comes, but in case it will come, 99% you will get like this, either for VRS or preliminary expenses. But sometimes if there is a specific question entirely, a different question of 4 marks on preliminary expenses, then you understand that eligible preliminary expenses are allowed in 5 equal installment. Now, what is called eligible preliminary expenses? It is actual preliminary expenses, or 5% of cost of the project. 5% of cost of the project. You don't have to calculate the cost of the project. It will be given to you in your question. Cost of the project you don't have to calculate. It will be provided to you into 5%. So whichever is lower, that is called eligible preliminary expenses, and it is allowed in 5 equal installments. Got it? So preliminary expenses would be actual preliminary expenses or 5% of the cost of the project, whichever is lower, that is allowed in 5 equal installment. But generally, I'm again telling you that in your examination, what we have seen in previous papers, generally they will give you just this figure, that this is the preliminary expenses or VRS expenses. We will assume that this is what eligible amount is, and we'll be allowing it in 5 equal installment. 1/5 allow, 4/5 disallow. Got it? Now, if there is a separate question on preliminary expenses, then you have to do, you can do this also. And in case this will not come, if the case is of company SSE, generally company SSE will not come in your examination. It is only for individual. But if it is for company SSE, you know, actual preliminary expenses of 5% of the cost of the project, whichever is lower. But here, first of all, 5% of cost of the project or 5% of capital employed, whichever is higher, then, so it means that cost of the project or capital employed, whichever is higher, you have to take 5% of that. Then compare with your actual preliminary expenses, whichever is lower, that is allowed in 5 installment. But I'm telling you, this is little bit important, not that, this is not at all important. This is a little bit, okay, it can come. But generally, whenever I see preliminary expenses in your examination, generally they give you a direct amount in your P&L account. Just remember to disallow 4/5. Got it? Section 36 is other deductions. Insurance of stock, insurance of livestock, health insurance of the employees. So health insurance of the employee. If we are the employer, we are the business, we have paid health insurance for our employees or their family members, it is allowed. But please remember that this health insurance should not be paid in cash. Even health insurance, if you will see that in your P&L account, there is a health insurance we have paid, it is allowed. So let's say we have paid health insurance of 9,000 rupees. And it is given in the question that this health insurance is paid in cash. Some students might get confused. That, sir, up till 10,000 it is okay. So let us allow this 9,000 because it is not more than 10,000. No. See, for health insurance, it is very, very specific. They say even if you are paying 1 rupee, it should not be paid in cash. So for health insurance, please be very specific. Please don't apply that 10,000 limit over here. Whatever the amount of health insurance is, it should not be paid in cash. It should be paid through a banking mode only. So section 36 says health insurance of employees and their family members, but it should not be paid in cash. Bonus and commission is allowed. Bonus and commission is allowed subject to 43B. So 43B will be doing separately also, but we understand that any type of taxes is allowed subject to 43B. Bonus and commission to employees is allowed under section 43B. Sometimes this is one of the favorite adjustment which examiners gives you. They say that this is the P&L account or an income and expenditure account of a CA firm, of a chartered accountant, and there is some bonus which is given of 15,000, let's say, and in your information it is given that this 15,000 bonus is given to their article assistant, their article clerks who are undergoing training with them. Since they have passed their intermediate examination, or whatever the examinations, then we have given the bonus to them, or we have given some other things to them. So can we give some certain incentive or bonus to our article clerks? The answer is yes. They are also our employees. So please don't disallow it. So even if they have passed the intermediate examination or any other examination and we have given them bonus, so this is a simple bonus to employees, please allow it. Don't disallow it. Got it? This is one of the most favorite of the examiner. They keep on asking about this. Okay. So bonus and commission is allowed. Interest on borrowing, debenture interest, other interest is allowed. But generally what you get in your examination is, this is again important, what you get in your examination is that let's say there is an interest on bank loan and you understand this interest is allowed under section 36. But if this loan is taken from any bank, any financial institution or NBFC, this interest on bank loan is allowed from financial institution or NBFC. It is allowed subject to 43B. It is allowed subject to 43B. If it is paid up to the due date of ROI, then it is allowed. If it is not paid up to the due date of ROI, it is not allowed. Other interest you can pay. If you have not taken the loan from bank, you have taken loan from any other person, or debenture interest, that is allowed on due basis. But interest on bank loan, financial institution or NBFC, it is subject to 43B. Correct? And also please remember, if the assessee, anybody is asking something? Okay. Now, also please remember, if this can come in your examination, if this loan is taken for purchasing any asset, so you remember that interest up to the date of put to use, shall be capitalized. It is not allowed under section 36. Only once the asset is put to use. Once the asset is put to use, after that, you can claim it as a revenue expenses under section 36. But up till the date of put to use, in fact, I would say 1 day before the put to use date, it should be capitalized. So what you need to do is, let's say there is an interest on, for example, let's say we have taken a loan from the bank and there is an interest on bank loan, let's say rupees 1,20,000 is the interest on bank loan. Nothing is mentioned, we'll allow it, no problem. If it is mentioned that it is not paid up to the due date of ROI, then we will disallow it because it is from bank loan, let's say. And let's say if it is given that it is 70,000 is paid before the due date of ROI, 50,000 is not yet paid, or it is paid after the due date of ROI, then we will not allow this 50,000. We'll allow only 70. This is simple. Now, if you will get like this, that this loan is taken from any bank, financial institution, etc., and it is taken for the purchase of any asset. And let's say this is the entire year interest. This is the entire interest. And we have been provided that, let's say from 1st April 23, sorry, 1st April 24, this is the interest for this period. 1st April 24 till 31st March 2025. This is the interest for this period. Let's say it is given to us that this asset was put to use from 1st of November 24. We have taken a loan to purchase an asset and this asset is put to use on 1st November 24. And this is the total interest 120. So 1,20,000 is the total interest. Then we understand that up till the date of put to use, this period from April, May, June, July, August, September, October, that is for this 7 months. For this 7 months, this interest needs to be capitalized. So this 7 months and this is 5 months. This 5 months is a revenue expenses that is allowed under section 36, but this should be capitalized. It is not a revenue expenses. So first of all, this is 7 months, this is 5 months. What you can do is, you can just split this into the ratio of 7:5, or you can simply calculate it. This is simple mathematics, 7/12 into whatever the amount of the loan is, you will get the interest. So simply, if I would have been in your position, I would have divided this into the ratio of 7:5. Understood? I believe everybody understood how I got this 7:5. So let's say it is put to use from 1st November. So 7 months before put to use, 5 months after the put to use. So let's say it becomes 70,000. 7:5, it becomes 70,000. This becomes 50,000. Once the asset is put to use, so I have no issues with this 50,000. This 50,000 is allowed once it is put to use. So I have issue with the 70,000. I will say no, it is not allowed under section 36. We will disallow this. Correct? We will disallow this. And now because it is a capital expenditure and we have disallowed it, now you have to claim depreciation also. So it depends what type of asset it is. Let's say it is machinery. So please claim depreciation also. And let's say on machine, you have to claim 15% depreciation. So there are two things. First of all, you have to disallow the capital expenditure, 70,000, and depreciation thereon. Then it is a hidden adjustment, you can say. Then you have to apply depreciation thereon at a rate of, depends on the type of asset, what type of asset it is. So let's say it is machine, so at a rate of 15%. So also please remember that what is the date of put to use. If it is on or after 4th October, then you have to see half depreciation also. So in this case, it is 1st November. Obviously, you have to claim half depreciation. So on 70,000 into 15% into half depreciation. Got it? I believe that you are able to recall this provision also. Interest on zero coupon bonds is very easy. It should be spread over the life of the bond. So how we will be doing it? Interest on zero coupon bonds. Again, not a very frequent thing which examiner asks. I don't remember that when was the last time they have given this. But still, let us do this. So what is the interest on zero coupon bonds? Interest is the face value, because we will redeem it at a face value minus issue price. You understand that these bonds are issued at a discounted price. So let's say the face value of the bond is 100 minus issue price. Let's say it is issued at rupees 20. So company is paying face value minus issue price. So company is paying 80 rupees as interest. So we have to divide it into we have to spread this over the life of the bond. So we'll spread it over the life of the bond. And generally, I would recommend, please take this life in the number of months. Don't take it in the number of years. I would recommend please take it in the number of months. So let's say, for example, it is for 10 years. So face value minus issue price divided by 10 years. 10 years you should take as 10 into number of months, 120. So please divide by 120 into simply number of bonds. How many number of bonds are we have issued? Because 80 rupees is the interest on every bond. So let's say we have issued 1 lakh bonds. So 1 lakh into 80, 80 lakh would be the interest divided by, let's say, the life of the bonds in months. Let's say divided by 120. So you will get what you will get if you will divide it by number of months. You will get per month interest. Agree now? You will get per month interest. So now it depends that whether you have issued this, when you will get per month interest. So it might be the possibility that this bonds are issued during this year. Let's say in previous year, 24-25, these bonds are issued. Let's say on 1st July 24. So you got the per month interest. So in this year, because these are issued from July onwards, so you have to take the number of months. Can you take 12 month number of months over here? No. Now you have to take from July onward, July, August, September, October, and so on. So I believe it is 9 months. So when you will get per month interest multiplied by 9, because in this year, how much deduction you will get, whatever is the interest for related to this period. Because in this period, see, if the bonds were issued on 1st April 24, or let's say the bonds were issued any day before this previous year, in any earlier previous year, then obviously we have used the bonds for entire year. But let's say if the bonds are issued during this year, for example, 1st July 2024 or any other date in this year, so we have to see that for how much period we have used these bonds. So in this period, we have used it only for 9 months. So when you get the per month interest, please multiply it by 9, 10, whatever it is. Have you understood this point also or not about zero coupon bonds? So please remember to divide this by the period, and this period should be taken in months rather than years. Then we have Guys, are you able to hear me now? Actually, that my internet dropped. Okay, good. Okay, next is employer contribution to recognized provident fund or statutory provident fund, etc. So in case you all know that if in your P&L account you will see employer contribution to recognized provident fund or statutory provident fund or approved provident fund, it is allowed under section 36. But please remember, subject to 43B, employer contribution is allowed only if it is deposited in that fund up to the due date of ROI. Here it is employer contribution. So it is subject to 43B. It should be deposited up to the due date of ROI. If it is not deposited, then it will not allow it. Second thing, what about employee contribution? What about employee contribution? Please remember, this is also important. Employee contribution should be deposited up to the due date of ROI or up to the respective act, So this employee contribution, if it is not deposited, employee contribution. So any employee contribution, if it is not deposited up to the respective act, so generally you will get it for provident fund, RPF. RPF should be deposited within next 15 days. Whenever the month is over, so in next 15 days, you should deposit this. And if you have not deposited up till in next 15 days, it will become permanently, it will become your income. So permanently, it will become your income. So please also remember in your information, in your P&L account, in your information, you can get this thing also, that there is an employee contribution. So how you will get this? So first of all, let's say, for example, you will get salary rupees 10 lakh, employer contribution to RPF, let's say 2 lakh. Correct. You will get salary 10 lakh, employer contribution to RPF 2 lakh. And in your information, it would be mentioned, in your information, it might be given that both, or okay, I'll write like this. In your information, it is given that employer contribution is deposited on 15th July 25, and on same day employee contribution is also deposited. Employee contribution is also deposited, which is included in salary. So what does it mean? See, first of all, look at this employer contribution. Employer contribution is deposited on 15 July 2025. So we understand that the due date of ROI is 31st July or 31st October. Let's say it is 31st July. So it is deposited on or before the due date of ROI. So for this, we don't have any issue. This 2 lakh is 100% allowed. This is employer contribution. It is also deposited before the due date of ROI. Now, this salary of rupees 10 lakh, includes, let's say, 2 lakh rupees. Whatever the amount is, let's say it also includes 2 lakh rupees. This salary includes employee contribution. It includes. And this employee contribution is also deposited on 15th July 2025. So we understand for this employee contribution, we have only 15 days. So let us say this is previous year 24-25. For example, we assume that it is March month PF. So March month PF should be deposited by 15th of April 25. And we are depositing it on 15th of July 25. It is after 15th of April. So this, whatever the amount of employee contribution here it is, let's say for example, I assume it is also 2 lakh rupees. So please 2 lakh make it your income. Separately show that this is employee contribution which is deposited late after the due date of the respective act. So this amount which is included over here, please make it your income. Employer contribution, we are okay. Because for employer contribution, we apply due date of ROI. But on employee contribution, we don't apply ROI date, we apply respective act date. Have you understood this also or not? This is a little bit important, right? Have you all understood this? Should I explain it once again, or you have understood this? Okay, got it. Good. Now, guys, there was an amendment this time, and it is also important. Let's say this is a penal account. This is the penal account of the assessee, and here in this penal account, it is written employer contribution to new pension scheme. Employer contribution to new pension scheme, whatever is the amount, it is also allowed under section 36, subject to 43B. It is also employer contribution to new pension scheme. This is also subject to 43B. But there is a very, very important point that this amount should not exceed more than, earlier there is an amendment, earlier it was 10%, now it is 14%. Please remember, it is 14% now. So it should not exceed more than 14% of your salary. And here, please remember, here I have written that employer contribution to pension scheme. I'm not talking about RPF. RPF is allowed. That is okay, subject to 43B. But pension scheme, this can come in examination because this is an amendment for this year. So employer contribution to pension scheme, if it is in excess of 14%, so that excess amount shall be disallowed. Only up till 14% is allowed. Excess of 14% will be disallowed. 14% of salary, what does salary here means? Basic salary plus DA forming part. So this is an important point. Bad debts is allowed. Provision for bad debts is not allowed. Provision for doubtful debt is not allowed. Only actual bad debts is allowed. Next is family planning expenses. Please, you will get it for individual. Neither allow revenue expenses nor capital expenses. For individual, HUF, etc. Please don't allow family planning expenses, because this family planning expenses is only and only for the company assessee, not for anybody else. It is only for company assessee. For company assessee, revenue expenses are allowed. Capital expenses are also allowed. Capital expenses are allowed in 1/5. But I'm telling you, for your examination for tomorrow, they will give you question on individual. And also they might give that there is a debit in their debit side. There is an expenses related to family planning. Let's say revenue expenses, let's say capital expenses. And some students, what they will do, they will allow revenue expenses, they will disallow capital expenses, or they might disallow 4/5 of capital expenses. I'm sorry, what you have to do is you have to disallow entire thing, because this is, let's say, individual. For individual, family planning expenses are not allowed, whether they are revenue, whether they are capital. Please don't allow them. Got it? So please don't allow them. Securities transaction tax, commodities transaction tax is not that important, but yes, if it is a PGBP income of the assessee, then these expenses can be allowed, not that important. Section 37, we all know it's a general deduction. Please do remember that any expense which is not allowed under section 30 to 36 can be covered over here. It should be revenue in nature. It should not be personal expenses. It should be for business related or profession related, and it should not be illegal. If it is an illegal expense, then we will not allow it. Correct? Corporate social responsibility expenses, CSR expenses is not allowed because it is not related to the business. Any illegal expenses will not be allowed. So please remember, most of the time students ask me that, sir, if it is if there is any expense which is compensatory in nature, that is allowed. So if you are paying interest on GST amount, interest on GST, or you are paying late fees for GST return or any other custom thing, etc. So interest on GST, late fees on GST, these all are allowed. These are allowed under section 37. But anything which is in the nature of penalty, which is in the nature of prohibited by law, which is in the nature of contravention of law. So let's say if it is penalty under GST or any other law, then it is not allowed. So interest on GST is allowed, late fees on GST, or not only GST, GST is just an example. Late fees of any other thing is also allowed. Interest on any other thing is also allowed. But penalty or anything which is in contravention of law, that is not allowed. So please do remember that for penalty, you don't have to allow it. Correct? And also please remember that whenever you give interest for income tax. See, any amount which is paid to income tax department is not allowed. Any amount which is, any interest is not allowed. Any late fees for income tax is not allowed. So anything which is for income tax, please don't allow that. Correct? And the same way, if you get income tax refund, and you get interest on income tax refund, income tax refund is not your income because it is not your expense. Whenever the income tax is paid, it was not your expense. Income tax refund is also not your income. But interest on income tax refund is our income, but not PGBP. You all know it is a IFOS income. I believe everybody's almost clear on this point. So income tax refund is not your income, but interest on income tax refund is not PGBP. You will delete it from PGBP, but you will take it from IFOS. Any amount paid to political party is not allowed as a business expense. So any advertisement given in political party brochure or any other contribution which you have given to political party, it is not allowed as a business expense. So any amount given to the political party, it is not allowed. Section 38 is not that important. It says proportionate expenses. If you have incurred any expenses which is partly for personal, partly for other things, also partly for business, then only business related expenses are allowed. Other proportion is not allowed. But one of the important point over here is depreciation. So let's say, this is the important point of depreciation. So let's say there is an asset. Let's say there is a car which is purchased for 5 lakh rupees. In any year, it is purchased for 5 lakh rupees. And it is given to us that 80% is used for business purpose and 20% is used for personal purpose. So please tell me in the first year, how much would be the depreciation in the first year? So first of all, on 5 lakh, compute the depreciation on car. Let's say I'm assuming that this is not a higher business. So depreciation on car is 15%. So first of all, compute 15% of 5 lakh. So this is the depreciation, 75,000. This is the expense, depreciation expense. Now out of this depreciation, 80% is for business purpose and 20% is personal. So in personal thing, we never charge depreciation. So only the depreciation which we charge is 80%. So 75,000 into 80%, it will come as 60,000. So guys, first year depreciation would be 60,000 only. Got it? So on 5 lakh, first of all, compute depreciation normally. And after that, just see that how much is proportion is related to business. So 80% is related to business, 20% is personal. That we will not allow. Now, this is important. In second year, how much is the depreciation? Now, because it is written down value, right? So your original cost of the car was 5 lakh. First year depreciation was 75. No, first year depreciation was 60. 75 was the depreciation, but only related to business, we charge depreciation 60. So your asset value will become 4,40,000. Got it? Please don't subtract 75. No, because that 15,000 is nothing. It's not depreciation even, because on personal thing, we don't charge depreciation. So depreciation was 60 only. So what you will should do in the second year on 440 into 15%. So 4,40,000 into 15%, it will become 66,000. Just first of all, calculate the depreciation. And out of this, only 80% should be allowed. So 66,000 into 80%, it will become 52,800. I believe you understood it. And let me revise for the third year. How much it would the depreciation in third year? 440 minus 52,800. So it is 3,87,200 into 15%. Whatever you will get, take 80% of that amount also. Take 80% of that amount. This is how you should claim depreciation. Understood? One more point related to this is, if there is any asset, for example, there is a machine which is used for partly agriculture and partly for business purpose, and partly for agriculture. In this case, you can claim 100% depreciation. In this case, you can claim 100% depreciation. It happens with tea, coffee, rubber business also, where we say that some portion of it is business, some portion of it is agriculture. So in that case, please remember, because this is a little bit important. So let's say if you have purchased a machine of 1 lakh, let's say it is tea business. In tea business, we understand 60% is agriculture, 40% is business. Correct? If you don't remember, then we will be revising that also. But 60% is agriculture, 40% is business. So in this case, the first year depreciation would be 1 lakh into, let's say it's a machine, 15% is the depreciation rate. So it would be 15,000. So you can claim 15,000 as a depreciation amount. No problem. So now should we split this into 60-40? No. For agriculture, if it is for agriculture purpose as well as for other purpose, then you can take entire depreciation. Second, 15,000 you will take in first year. Second year it is 85,000. 85,000 into 15%. Whatever is the amount, you can claim it entire as a depreciation. No issue at all. So for agriculture purpose and for other purpose it is used. So there is no problem. But if it is used for business purpose as well as for personal purpose, then only business purpose is allowed. And this is how you should do it. I believe this is also clear to you. Now, section 40 small a is a very important section. It says that if you have paid anything outside India, any interest, royalty, fees for technical services outside India, then 100% would be disallowed if you have not deducted the TDS. So you should deduct the TDS. You should deduct the TDS up to the in the previous year and deposit it up to the due date of ROI. In your examination, they don't ask you that much. They will simply tell you that we have paid this interest, we have paid this royalty, we have paid this fees for technical services outside India without TDS. Simply disallow 100%. If it is outside India or to a non-resident, disallow 100%. But if the payment is made to a resident within India, and generally if the question is silent, we always assume that the payment is made to a resident within India, and where TDS is required to be deducted and you have not deducted it, then 30% will be disallowed. Now, please remember, because this is very, very important. Let's say, for example, this is the P&L account of the assessee. Let's say this assessee name is Mr. Suresh. This is the name of the assessee. And it is given to you that in this year, this is previous year 24-25, right? By sales. Let's say sales is given as 1.2 crores or 120 lakh. It is 120 lakh, his sales it is. And it is given that he has paid rent. He has paid rent of rupees 10 lakh. And there is a net profit which is given to you. For example, it is 15 lakh. Got it? Again, I'm repeating. This is previous year 24-25. Individual assessee, his sales for this year is 120 lakh. Rent is 10 lakh. Net profit is 15 lakh. If it is given in your information, see, because this always comes in your exam. In every attempt, this kind of information is always given. So first information is that on rent, TDS is not deducted. 90% you will get this. 90% you will get simple this. On this rent, TDS was not deducted. So we understand, we have done the chapter of TDS also in our classes. We know that on rent, TDS is required to be deducted. And if you have not deducted it, then we understand, then 30% of this would be disallowed. 40 small a will say 30% of this would be disallowed. So what you need to do is, when you will be computing your PGBP, you will be mentioning this net profit as a P&L account, step 1, 15 lakh, and you will add back 3 lakh out of it. I believe everybody is okay with this 3 lakh. 30% will be disallowed. Now, sometimes if they will make this question a little bit more tricky, so what they will do, they will say that on this rent is paid to someone and TDS is not deducted. Okay. And let's say in some other information, let's say in the last information, somewhere in 10th information, they have given that turnover of previous year, 23-24, that is last year, turnover was 99 lakh. Your business turnover was 99 lakh. Now, please tell me. Now, please understand, if your turnover, because now you are a small individual. Why small individual? Because you are not supposed to deduct TDS. Why? Because we see the turnover of the last year, that whether I am eligible to deduct TDS or not. So in this case, we will not see the turnover of the current year. We will see the turnover of the last year. So last year turnover was not more than 1 crore. Last year turnover was not more than 100 lakh. So this person is not required to deduct the TDS if he is paying within India. See, for outside India, you are always required. But within India, that 30% thing, only 30% thing will only come into picture if you are required to deduct TDS. So in this case, if the turnover of the last year was not more than 1 crore, not more than 100 lakh, then this person is not required to deduct TDS. Got it? So in this case, even if the TDS is not deducted, no problem at all. In that case, you can simply allow entire 10 lakh, and then you have to just mention that this person turnover of the last year was not more than 1 crore. So he was not required to deduct the TDS. And if he is not required to deduct TDS, so everything would be allowed, nothing will be disallowed. Please tell me, have you understood this or not? Guys, if it is not mentioned, then please apply 30% disallowed. But if this is mentioned about the last year turnover, please remember this also. Got it? Very nice. And also please remember, if this person is carrying a profession, so whether he's a small individual or a big individual depends on his turnover of the last year. And in that case, we will see 1 crore or 50 lakh. 50 lakh. Correct? So in that case, we will see 50 lakh rupees. So 1 crore in case he's carrying a business, whether he's eligible to deduct the TDS, we will see the last year turnover as 1 crore. If he's carrying a profession, we will see last year turnover as 50 lakh. So if last year turnover was more than 50 lakh, then he's required to deduct TDS, and then 30% will also be disallowed. But if last year turnover is less than 50 lakh and this person is a professional, then we can allow entire 10 lakh rupees. Got it? Guys, this will come, this information will be there only if the question is little bit tricky. Otherwise, if this information is not there, simply disallow 30%. Got it? Tax on non-monetary perquisite is not allowed. Provision for income tax, any amount which you are paying to income tax, it is not allowed. We have already discussed. So any amount which you are paying to income tax, it is not allowed. If you will see tax on non-monetary perquisite, please remember, I'm not explaining it again now. We have done it in class so many times, but still, just for tomorrow examination, please remember that if they will be giving you that we have paid a tax on non-monetary perquisite, simply disallow this. It is not allowed. Correct? Then 40B will give, we'll do a little bit later. 40A2, we have already discussed that this is the expense which you have made to a related party. Who are the related party? Spouse, sibling means brother and sister, linear ascendant or descendant means children or parents or grandparents. So if you have made the payment to them, then it is subject to 40A2, but that is in excess of fair market value would be disallowed. But in case you are making a payment to a non-related person, then it is 100% allowed. So I have already mentioned about sister-in-law. If the payment has been made to father-in-law, mother-in-law, sister-in-law, then even if it is more than fair market value, does not have any problem. Simply allow them. Got it? 40A3, cash payment. We all know it very well. So whenever the cash payment expenses has been made, has been incurred, and if it is written that it is paid in cash, and if it is more than 10,000, simply disallow it. Entire amount should be disallowed. If we have paid 11,000, whether 1,000 will be disallowed or 11,000, entire 11,000 will be disallowed. To a transporter, if it is a revenue expenses, because 40A3 deals with revenue expenses. So if it is a revenue expenses to a transporter, you can allow up till 35,000 you can pay in cash. If it is more than 35,000, then please disallow. But if it is up till 35,000 or less, then you can allow to them also. So how you should make the payment? You should make the payment through account pay, check, bank draft, ECS, etc. Then there are certain exceptions. You can pay to the bank. Most important exceptions are purchase of agriculture or forest produce. So if you are purchasing agriculture, forest produce, or fish, meat products, or poultry, horticulture, apiculture, from whom you are making a payment? You are making a payment to the cultivator, to the producer. If you are making a payment to any vendor, then it is not under exception. We will disallow it. But if you are making a payment to the cultivator, to the farmer, to the grower, then we will allow it. Purchase of products made without aid of power. To whom you are making the payment? To a manufacturer who actually making such kind of handicraft goods. So that you can make the payment more than 10,000 also. But if you are making a payment for a handicraft good to any other person, not to manufacturer, but to any other person, it will be disallowed. Correct? Payment made in a village where there is no bank, that is okay. That is okay. These are the things only which is a little bit important. 48.7 you can leave, no issues. 43B, very important. These are the 7 expenses. Any type of taxes you have seen, bonus and commission, interest to any bank, financial institution or NBFCs. Payment of leave salary is also there, which is not that important. Payment to Indian Railways is also there, which is not that important. Payment to MSME, this is a little bit important. Please understand, if you are making a payment to MSME, see, these expenses are allowed if they are paid up to the due date of ROI. Due date of ROI is 31st July or 31st October, as the case may be. But this MSME is quite a special provision over here. If you are making a payment to MSME, so it should be made as quick as possible. If you are making a payment late, then we will not allow it on accrual basis. Then we will allow only on payment basis. So what is the payment which is made late or quickly? So if there is a written agreement, so if there is a written agreement, and if you are making a payment as per the written agreement, but please remember, this written agreement should not be more than 45 days, maximum 45 days. If it is less than 45 days, then it's okay. But if it is more than 45 days, we will take maximum 45 days as the written agreement. So if you are making a payment within 45 days or as per the written agreement, then we'll allow it on accrual basis. Otherwise, we will not allow it on accrual basis. Then we'll allow it on payment basis only. And if there is no written agreement, please make the payment within 15 days. So if you are making a payment after 15 days, so it will be not be allowed on accrual basis. It will be allowed only on payment basis. But if you are making a payment within 15 days, then we will allow it on accrual basis. So MSME is also a little bit important. Deemed business income, we understand, we have already done so many times. So whenever any bad debts which is recovered or any power generating asset which is sold, which is more than the WDV and up to the original cost, any scientific research asset is sold. So you understand, we have already done section 41. That is not difficult. 40 small b, sorry, little bit important. 40 small b, remuneration to partners, little bit important. There's a little change in 40 small b this time, although we have discussed in the classes already. But now you understand that to partners, a partnership firm can pay interest to partners, can also pay remuneration to partners. A partnership firm can pay interest or remuneration to partners. How much interest they can pay as per the partnership deed, but not more than 12% per annum. So in excess of 12%, we will not allow in the hands of partnership firm. Only up till 12% per annum it is allowed. So that is okay. It can be paid to working partner. It can be paid to non-working partner. That we know. Remuneration. A partnership firm can pay how much remuneration to the partners? To non-working partner, we cannot pay any remuneration. So it is simply disallowed. So what does it mean? It means that if this is a partnership firm P&L account, let's say if it is a partnership firm P&L account, it's a partnership business, it's a firm P&L account, and they have paid remuneration. Let's say they have paid salary, commission, bonus, or any remuneration to a non-working partner for any amount. Let's say 2 lakh, 3 lakh, 4 lakh, whatever it is. Let's say 3 lakh. So if this person is a non-working partner, then simply disallow it in the hands of the firm. What does it mean? It means that we are disallowing it. Then who will pay tax on this amount? Firm will pay. Why? Because we have disallowed it. So it will be added back in the PGBP of the firm. So firm has to pay. That is the reason I've told you before also. Let's say this is a partner. Partner is also doing some separate business. His individual business he is also doing. And he has received remuneration. let's say 3 lakh. Why? Because this firm has paid 3 lakh to him and he has received it. So this is firm penal account. This is partner's penal account. In firm penal account, we will not allow it. It means that who is paying taxes on this? This income. Firm is paying the taxes on this income. Got it? And whether this partner should pay the taxes on this? No. So that is what I have told you. So if this partner is a non-working partner, if this partner is a non-working partner, please don't make this in his income. Why? Because on this 3 lakh, his firm will pay the taxes. He will not pay the taxes. So generally, you will get this in your total income question. You will get this in your total income question. You will get that this is the penal account of Mr. A. Mr. A is also a partner in some other firm, but he is a non-working partner. So if he is getting any remuneration, please don't make it PGBP income. Why? Because his firm will pay the taxes on this. Got it? However, if we are paying remuneration to our working partner, if we are paying remuneration to our working partners, so we can pay remuneration to our working partners. How much amount we can pay? How much amount we can pay? So we have a maximum limit also. So what we have to say to working partner A, the amount paid, the actual amount paid, or B, the maximum amount which we can pay, whichever is lower, only that is only allowed in the hands of the firm. So to working partner also we can pay, but there is a limit to it. So whatever we have paid, whatever is the actual remuneration we are giving to the working partner, plus there is a maximum limit. Now you should understand what is the maximum limit. This maximum limit depends on your book profits. This maximum limit depends on your book profits. So what we will do, whatever is the book profit, we will make it 2 parts. First 6 lakh and remaining book profits. First 6 lakh or remaining book profits. So here it is mentioned that if book profits, first part, first 6 lakh, maximum remuneration is 3 lakh rupees or 90% of such book profit, whichever is higher, or on balance 60% of the book profit. What does it mean? It means that, let's say, the book profit comes to 10 lakh rupees. Guys, what are we doing? We are doing that how much maximum remuneration we can pay to the working partner. Remuneration to the working partner, how much we can pay. So let's say the book profit is 10 lakh rupees. So what we will do, how much is the maximum amount we can pay? We will split this 10 lakh rupees into 2 parts. First 6 lakh, this is fixed. First 6 lakh. Guys, there is a little change over here. Although we have done the 6 lakh in the classes also, but till last year it was 3 lakh. But now they have increased, they have doubled the amount. So now it is first 6 lakh. So we'll make it into 2 parts, first 6 lakh and remaining 4 lakh. So on this 6 lakh, it is 90% of such amount or rupees 3 lakh, whichever is higher. So 90% of 6 lakh, it is 540 or rupees 3 lakh. 3 lakh is the fixed limit, whichever is higher, we'll get 540. On first 6 lakh, we can pay 540. And on the remaining, what is the remaining? Total book profit is 10. We'll make 2 parts, 6 and the balance. 4 lakh is the balance. On this balance, 60%. So 60% of 4 lakh is 240. So how much is the maximum remuneration which we can pay to the working partners? 540 and 240, 7,80,000 is the maximum remuneration that we can pay. Got it? So this is a little bit important point. So on first 6 lakh, how much you can pay? On first 6 lakh, 3 lakh rupees or 90% of such profit, 90% of that 6 lakh would be 540. So 3 lakh or 540, whichever is higher. But let's say if the book profit, for example, if somebody will say, sir, my book profit is only 5 lakh rupees. It's only 5 lakh rupees. So what we have to do? First 6 lakh, but we don't have first 6 lakh. We have only 5 lakh rupees. So it doesn't matter. So we'll take it 5 lakh over here and here it would be 0. Correct, because we don't have any balance now. So on this amount, how much is the maximum amount? 3 lakh rupees is the fixed amount or 90% of such amount. 90% of such amount means 90% of 5 lakh now. 90% of 5 lakh will become 450. So 3 lakh or 450, whichever is higher, 450 we can pay the remuneration. Got it? Now, how you will be computing the book profits? Book profit is, first of all, determine the PGBP. First of all, determine the PGBP of the firm. And if there is any remuneration which is paid, let's say this is the partnership firm. Let's say it's the partnership firm penal account. And in your debit side, you will see that there is any salary which is being given to the partners, whether they are working, non-working, doesn't matter, or any interest which is given to the partners. Let's say 4 lakh rupees is interest is given, salary to partners is given 3 lakh rupees, and here there is net profit. First of all, how do you compute your book profits? You have to add back these things. Add back these things, whatever the salary or any other remuneration, any other interest, even the interest, whatever you are paying to the partner, just simply add it back. Simply add it back. Okay. So whatever is my net profit, I will add back this 4 lakh. I will add back this 3 lakh. Or any other adjustment which you have to make under section 30 till 37, whatever. It means that you need to compute your PGBP normally. So let's say there is a depreciation which is debited over here, let's say 7 lakh. But depreciation as per income tax is something else. So please take that also into effect. That is normally compute your PGBP. And also while computing your PGBP, disallow everything which you are paying to the partners, first of all. So it is written over here. The first step should be determine PGBP income without any, first of all, determine PGBP without any interest or remuneration to partners. You will get it. Now, subtract 2 things out of it. First, interest allowable to partners. So whatever is the first, disallow everything, then just allow how much is the interest allowed, not the remuneration, only the interest. How much is the interest allowed, subtracted. And if there is any unabsorbed depreciation of last year's, please brought forward unabsorbed depreciation, also deduct that amount. You will get this book profit. So this is also important, that how much book profit we have. So whatever is the book profit, 6 lakh, the balance, please work it accordingly, right? So this book profit, more or less, it might come in examination, but generally what I'm presuming that they will directly be giving you book profits, but they would be they might test you on this amount, especially in case scenarios. In MCQ's case scenario, they might directly give you book profits, or you might have to calculate it. That is also not difficult, but they can test you on this because this is also a recent amendment. Okay. Some last sections of PGBP. 44AA, who is required to maintain books of accounts if the person is carrying a notified profession. Let us simply read it. Who are the notified professionals? If you are carrying a medical professional, doctors, engineers, lawyers, chartered accountant, cost accountants, company secretary, architect, interior decorator, film artist. Again, once again, I'm reading it. It is medical professional, engineer, lawyers, CAs, CMAs, company secretary, architect, interior designers, film artist. If you are a notified professional, you have to maintain your books of accounts compulsory. And in case the gross receipts of all last 3 years, exceeds 1.5 lakh, then you have to maintain prescribed books of accounts also. So not so important from examination. I don't think that on this question will come. I'm not expecting this question on this 44AA, especially on notified professional, but still notified professionals are 100% required to maintain their books of accounts. And if their last year gross receipts of all last three, 1, 2, 3, all 3 got ticked, then they are required to maintain prescribed books of accounts. So what are prescribed books of accounts? Cash book, general ledger, bills issued, which is more than 25 rupees, bills received more than 50 rupees. Not that important. And in case of doctors, daily case register and inventory details is also required. But if the assessee is not a notified professional, then what he or she is carrying any other business or any other profession. Businesses they are carrying, or they are carrying any other profession which is not notified. Then whether they are required to maintain books of accounts, the answer is depends on their income or turnover. So if a person is carrying a normal business, or a person is carrying any other profession, then whether they are required to maintain the books of accounts, the answer could be yes. The answer could be no also. So the answer would be yes. It depends either on their income or on their turnover. So either their income is higher, they are required. If their turnover is higher, they are required. So what is the criteria over there? What is the parameter? For individual and HUF, if the income of any of the last 3 years, any, here means any one. Here, there in notified profession, we were requiring all last three. But here we require any one out of three. Either the income is higher. If the income is not higher, either the turnover is higher. If any of them is satisfied, you are required to maintain the books of accounts. So for individual and HUF, which is important, if the turnover is more than 25 lakh of any of the last 3 years, then you are required to maintain the books of accounts. If turnover is not higher, but income is more than 2.5 lakh rupees of any one, then you are required to maintain the books of accounts. And if last 3 years information is not available, why? Because this assessee is carrying a new business. In that case, if we will ask him, it's a very subjective issue. You will not get this again in your examination. But if it is likely to exceed, the income is likely to exceed 2.5 lakh or the turnover is likely to exceed 25 lakh, then also you are required. Okay. Now, generally you will get for individual or HUF, but if this is other person, you will not get it. Here, we will not take income as 2.5. There we will take income as 1.2 lakh and turnover we will take at 10 lakh. But for individual HUF, we will take turnover 25, income 2.5. Audit. This is important. Because this is always an evergreen section for the examiner and they keep on asking it. Although there is no amendment this year, but this is again a little bit favorite of the examiner. 44AB. When is tax audit required? See, for tax audit, we will divide our group only in two parts. So for tax audit purpose, all businesses in one or profession in other, right? All profession, whether they are notified, whether they are not notified, does not matter. For audit, it is business or profession. For profession, whether this profession, let me talk about profession first, whether you are required to get your accounts audited. So if you're in previous year 24-25, so we don't have to see the turnover of last year, no, for audit, because audit is conducted when the year is over. So in this previous year, if the gross receipts of the profession is exceeding 50 lakh rupees, then you are required to get your accounts audited. If the gross receipts exceed 50 lakh rupees, simple. So in case of profession, in case of person carrying profession, gross receipts exceed 50 lakh rupees. Which year? This year only. Previous year, 24-25 year only. If the gross receipts exceed 50 lakh, you are required to get your books of accounts audited. Again, I'm telling you, little bit important. Most of the time we see that on and off, they keep on asking a question on this particular point, 44AB. Second is, if you are carrying a business, now for business, if you are carrying a business and if your turnover, see, if your turnover is from 0 to 1 crore, then no audit required. If your turnover is up till 1 crore, then no audit required for business. This turnover, guys, I'm again repeating, I'm looking this turnover of this year only, previous year 24-25 only. So if your turnover is up till 1 crore, then no audit required. If your turnover exceeds 1 crore, then audit is required. However, if your turnover exceeds 10 crore, obviously after 1 crore, audit is required. But we are relaxing some people. We are relaxing some people who are falling under this category. We are relaxing some people who are falling under this category. What we are telling, this is important, little bit important. See, after 1 crore, generally, if somebody will ask me when a business is required to get their accounts of audited, I will simply, if I have to give answer in one sentence, I will simply say, if the turnover is more than 1 crore, that's it. So after 1 crore, your liability arises to get your books of accounts audit. But whose turnover is more than 1 crore, but up till 10 crores, these people can get a benefit also. So if there is any person who is between this 1 crore and 10 crore and they are maintaining very transparent records, What does it mean? It means that generally they do transactions through banking mode. They do most of the transactions through banking mode. They don't use cash mode, and very minimum transactions they do through cash. So if your cash receipts is not more than 5%. If it is exactly 5%, we are okay. It should not be more than 5%. Plus, your cash payments is up till 5%. Both the things should be satisfied. Cash receipts also should not exceed 5%. Up till 5%, we are okay. More than 5%, we are not okay. Both the things should be satisfied. Cash receipts up till 5%, cash payment up till 5%. If you satisfied both these two things, then you will be relaxed from audit also. Guys, this relaxation is only for those people who are in this category from 1 crore to 10 crore. If you are above 10 crore, no relaxation. Above 10 crore, there is no relaxation. Even if you are maintaining 100% transparent records, even if 100% banking mode transactions is given, no problem. In that case, you have to maintain your audit. You have to get your accounts audited by a chartered accountant. But in case you are between 1 to 10 crore, some people are exempt from audit if their cash receipts plus their cash payment, both of them should be satisfied. It is up till 5%. I believe you understood this. We have already done it, and I believe that we have recalled it. So generally, we say that if your turnover exceeds 1 crore, then we will say generally you are required. But up till 10 crore also, some people are relaxed if their transactions are up till 5%, both your cash receipts as well as cash payments. So this is for audit. And we all know that people who are maintaining their or who would like to adopt presumptive income 44AD, 44ADA or 44A, those people are not required to maintain their books of accounts or audit. These people are relaxed from accounting provision or for audit provision. But if you are not following these presumptive income and you are satisfying those conditions, then audit is required or books of accounts is required. Now, presumptive income, which is very, very important. So this is again, out of these three, on and off, we keep on getting at least one out of these three. So that is also very important, guys. That is also very important. So you can expect one of the question. So this page, see, 44B, BB, this is not that important, but this page, in fact, agriculture income is also important. This is chart book page number 13, guys. Important, little bit important. So if you want to revise it once again after today's class, please revise this. Also, this is little bit important. Most of the questions can come from here. Presumptive income. Presumptive income, you understand 8% and 6% thing. So presumptive income is eligible. Who is the eligible assessee? Resident individual, HUF or partnership firm, not any other else, not any other assessee. Again, I'm repeating, individual, HUF or partnership firm, not even LLP. If you are resident, then you are eligible to take the presumptive income section. And how much is the should be the turnover? If your turnover, again I'm repeating, let us understand by this. If your turnover is from 0 to 2 crores, you are 100% eligible. So Andram, I'm just answering your question as well. Give me a moment, guys. Let me have a glass of water. Okay. I'm explaining you section 44AD. 44AD. Anybody whose turnover, if you are resident individual, resident HUF, resident partnership firm, not LLP, not company, not any other assets. If anybody whose turnover is from 0 to 2 crores, that person is eligible. That person is eligible, right? So whatever is your cash receipts, whatever is your banking receipt, doesn't matter. Up till 2 crores, you are 100% eligible. But some people are even eligible if they are exceeding 2 crore turnover, but up till 3 crores. Some people are still eligible. Here, if their turnover, out of the turnover, their cash turnover does not exceed 5%. Their cash turnover, we will not see payment over here. We will only see their turnover. So out of your total turnover, how much is your cash turnover? If your cash turnover is up till 5%, it means that you are also quite a transparent person. But here we will see only the turnover. So if you are above 2 crores, up till 3 crores, and your cash turnover is up till 5%, then this person is also eligible. But if anybody who is sitting in here in this particular box and his cash turnover is exceeding 5%, that person is not eligible. Any person whose turnover is more than 3 crores, 100%, that person is not eligible for this section. So this section is only for those people whose turnover of the year is up till 2 crores. Some relaxation is given to those people also who are going beyond 2 crores up till 3 crores. But this relaxation is only if their cash turnover is up till 5%. So first of all, you should understand who are eligible. So once you identify that this person is eligible, now, how much is the presumptive income? How much is the PGBP income? This PGBP income is calculated on presumptive basis. So how much is the PGBP income? So we will ask you that how much is your turnover, and out of this turnover, how much turnover you have received through banking mode up to the due date of ROI. So up to the due date of ROI, how much is received in banking mode? So let's say the assessee turnover is, for example, the assessee turnover is 180 lakh. 180 lakh, 1.8 crores. So obviously up till 2 crore, everybody is eligible. So this person is also eligible. So your turnover is 180 lakh. So out of this, we will ask you, the question will tell you that out of this, how much is received through banking mode up to the due date of ROI. Even if it is not mentioned, then you will assume that it is received up to the due date of ROI. But this is important that this, out of this, how much turnover is received through banking mode up to the due date of ROI. So up to the due date of ROI, let's say this person has received 150 lakh. Okay. And the balance is 30 lakh. 180 minus 50, this is the balancing figure, 30. So what you have to do, 180 lakh into 6%, this is the PGBP income for this one. 30 lakh into 8%, this is the minimum. If you want to take more, then if the examiner is saying that can we take more than 6% or 8%? Yes, but we cannot go less than 6% or 8%. 6% and 8% is the minimum. So 30 lakh into 8%. So whatever is the amount over here, this and this will become the PGBP income. Got it? So 44 AD, quite an important section. Again, I'm repeating. It is only available to resident. It is not available to non-resident, first of all. Individual HUF partnership firm whose turnover is up to 2 crores. But there is a relaxation between 2 to 3 crores also. 2 to 3 crores if the cash receipts is up to 5%. It is actually cash turnover, right? Cash turnover is up till 5%. So presumptive income would be 8% of turnover, but 6% also in case of banking transaction. But this banking transaction should be up to the due date of ROI. Non-applicability, the people who are covered under the notified professionals, because for notified professionals, we have 44 ADA. For them, it is not eligible. People who are earning, that is not that important, but still I'm reading it. People who are earning commission or brokerage income, they are not eligible. People carrying agency business, not eligible. Person referred under 44A, because we have separate section 44A, goods transporter. So they have a separate presumptive income section. So that is also not eligible. People who are claiming reduction under 10AA and that heavy reductions in chapter 6A, 80IA, etc., which is not in our course. So that people are also not eligible. I'm again repeating, although I don't think that this is examiner should ask you, but still let me do it once again in case they will ask you. So people who are covered under 44AA, why? Because notified professionals, for notified professional, we have a separate section. For people who are covered under 44A, we have separate sections. People who are claiming heavy reductions under 10AA, SEZ unit transaction, or chapter 6A heavy deductions like 80IA, etc., which is not in our course. If you are claiming that, you are not eligible. People earning commission, brokerage income, this might come in MCQ. So in the back of the mind, till tomorrow at least, please remember this. So people who are earning commission or brokerage income or agency income are not eligible. And again, important point is that this is only for resident individual. Got it? This is 44AD. 44ADA is very, very similar. It is only for the notified professionals, and the presumptive income here is for 50%, 50%. So who are eligible? The same thing is here also. So in 44ADA, if your gross receipts is between 0 to 50 lakh, 0 to 50 lakh, you all are eligible. That is 44. Those are the notified professionals, chartered accountants, lawyers, engineers, architects, doctors. These people are eligible, and their presumptive income is 50% of your turnover. Turnover means gross receipts over here. But if your gross receipts is exceeding 50 lakh and it is going up till 75 lakh, so you are also eligible. But again, the same thing, your cash receipts should not be more than 5%. Should not be more than 5%. Your cash turnover should not be more than 5%. Then you are eligible. But if your turnover is more than 5%, then for you only 50 lakh limit is applicable, not 75 lakh. I believe that you understood this also. Sondram has asked me a question that what is included in cash receipts. So I believe, see, in 44AD and 44ADA, here we only take turnover. In 44, actually, I think that he is asking about this thing. 44AB, what we take in cash receipts, we take all the receipts, whether it could be revenue receipts, it could be capital receipts also. But I'm telling you, Sondram, that they will not be asking you. They will simply say that, they will simply tell you that this much is the cash receipts. But if you ask me, in 44AB, we take all the receipts. So generally, whether it is a revenue receipt, whether it is a capital receipt, all the receipts which we are taking should be banking receipts. All the payment which we are making, whether it is on revenue ground, whether it is on capital ground. So even if you are purchasing any assets also, then also it should be through banking mode only. So in audit, because we don't have to take turnover here in audit to ascertain whether this 5% transactions. So whenever we say 5% transactions, it is all transactions, all receipts, all payment, any kind of receipts, any kind of payment. Sondram, understood? So any kind of receipts, even if you are taking loan, it should be in not in cash. If you are taking any other amount, it should not be in cash. All your transactions, all your receipts, all your payments should be in not in cash. Maximum it is allowed only 5%. So although they will not ask you to calculate, but yes, it is. Got confused between inclusion in specified mode and cash receipts. See, in presumptive income, see, in presumptive income is mostly based on turnover. 44AD and 44ADA is mostly based on turnover, right? So here you will see only the cash turnover, and here the cash receipts, specified mode. See, if you are receiving the money, or if you are paying the money through specified mode, so if you are making the payment through banking mode, account pay check, or UPI, or through debit card, credit card, internet banking, these are specified modes. So this is not cash receipts. These are not cash receipts. These are not cash payment. Cash receipts means hard cash, bearer check, or cross check. This is cash receipts. So whatever is the total receipts which you are getting, whether it is banking mode specified, whether it is cash mode, first understand that how much is the total receipts. So let's say somebody has a total receipt of 300 lakh. So out of this, let's say cash receipts, for example, it is, let's say 10 lakh, or let me take it 30 lakh. So out of 300 lakh of total receipts, your cash receipts are, cash receipts, when I'm saying cash receipts, I'm talking about only about these things. Sondram, are you getting it? I'm talking about only these things. So let's say it is 30 lakh rupees. So out of 300, first of all, tell me the total of the total receipts. Total receipt, let's say it is 300. Bank also, cash also. Total receipts are 300. Out of this, cash receipts are 30. So it means if you calculate the percentage, it is coming as 10%. So it is exceeding 5%. So we will say, no, boss, your 10 crore limit would not be applicable to you. You have to get your books of accounts audited. even if the turnover exceeds 1 crore. 10 crore limit would not be applicable to you. Got it? Okay. 44 AE, goods carrying vehicle. Goods carrying vehicle, you understand? See, if it's a heavy good vehicle, in fact, first of all, let me take about a light good vehicle or a medium good vehicle. What is a heavy good vehicle? Heavy good vehicle is where the vehicle weight is more than 12 tons. Where the vehicle weight is more than 12 tons, or you can say 12,000 kg. 1 ton is equal to 1,000 kg, you all know. So if it is more than 12 tons, it is a heavy good vehicle. And if it is up till 12 tons or less than 12 tons, it is called a light good vehicle or a medium good vehicle. For medium good vehicle, it is very easy. The presumptive income is 7,500 rupees for every month, or part of the month also will be taken as full month. So if it is five months, 10 days, so please take it as 6 months only. You have to round it off, compulsory round it off. So it is 7,500 for every month or part of the month for each vehicle. But if it is a heavy good vehicle, then it is 1,000 rupees for every ton. It is 1,000 rupees per month per vehicle for every ton. So we all know it. Let's say there is any vehicle which is of 14 tons. So it means that presumptive income will become 14,000. So if there's any vehicle of 16 tons, then the presumptive income will become for this vehicle 16,000 per month. If any vehicle is 16.5 tons, 16.7 tons, 16.1 ton, then you have to compulsory round it off. We will take it as 17 tons. Correct? So presumptive income will become 17,000 over here. Again, I'm repeating, if the vehicle is 16.1, 16.5, 16.7, please take it as a 17 ton vehicle, and the income will become presumptive income per month of that vehicle will become 17,000 rupees. Got it? If it is 20 tons, 20,000. If it is 20.2 tons, it means 21 tons, 21,000 rupees. Okay. And please, this is again, I've already told you that this page is little important. Agriculture income. Agriculture income, if it is, you should remember these percentages. And the majority percentage is going towards agriculture. Minority percentage is going towards business. Majority percentage is going towards agriculture. If it is tea business, 60% agriculture, 40% business income. Got it? So 60% you will exempt, you will make it an exempt income. 40% make it taxable. Rubber business, 65-35. Please remember, this is a little important. 65-35. Coffee, if it is growing and curing coffee only, 75%, 25%. But if it is growing, curing, roasting, grounding, etc., so many things are taking place for coffee business, then 60%, 40%. Again, I'm repeating, 40, 60, 40. Coffee is also one of the coffee business is also 60-40. If you are doing so much of processing also on coffee, roasting, grounding, etc., 60-40. Otherwise, just growing and curing coffee, 75%, 25%. Rubber business is 65-35%. Got it? So also please remember that this business, this agriculture should be in India. If it is agriculture, it is outside India, 100% it will be taxable. Nursery business, even on nursery business, you don't do basic operation. What is basic operation? Basic operation agriculture means that you are doing operations on land. And if it is a nursery business, what is nursery business? The people who are engaged in the business of selling plants, small plants, flower pots, etc., they sell. So if it is a nursery business is 100% agriculture business, 100% agriculture business. Got it? Also, please do remember that whenever there is an agriculture income, let's say in your exam, tomorrow, let's say this is the penal account of the assessee, and here it is mentioned that there is an agriculture income from India, I'm presuming, let's say rupees 5 lakh. So you understand it's a penal account given over there, and one of the income on the credit side is agriculture income, rupees 5 lakh. So you know it is exempt. Everybody know, every student will know that this is an exempt income. So while computing my PGBP, I will subtract this. I will subtract this because this is not my taxable income. It is an exempt income. Got it? So you will subtract this. Now, if the question is asking to compute the tax liability also, so if the question is asking about the tax liability also, 90% students make this mistake. 80-90% students make this mistake. They calculate the tax liability also. No problem there. First of all, they say that this is an exempt income. 100% correct. This is an exempt income. Delete it. But when you have to compute your tax liability, please remember the concept of partial integration. What was that? Tax 1 plus tax 2. So what you need to do is, first of all, tax 1. Whatever is the total income which you have received, first of all, exclude this 5 lakh. You have to say that this is an exempt income. Let us exclude that. So whatever is the total income which you receive, just don't calculate tax on that total income. No, that is wrong. This is 80-90% students make this mistake. So let's say your total income comes to about, for example, you calculate everything. You have said that this is not my taxable income, it is exempt income. Let's say your total income comes to rupees 20 lakh. So this is the mistake which they make. They just calculate tax on 20 lakh. Correctly, they calculate the tax on 20 lakh. That's it. No, they have made a mistake. What mistake they have done? They have to do tax on tax 1. What is it? Is tax 1 is tax on total income plus agriculture income. This is called tax 1. Correct? Do not apply cess on it. Just calculate the tax. Take total income plus agriculture income. Tax 2. I believe that you are able to recall now. Agriculture income plus basic exemption limit. So let's say this person is following default regime. So basic exemption limit is 3 lakh. If this person is following optional regime, the basic exemption limit would be 2.5, depending on the age, 3 or 5 lakh also. So agriculture income plus basic exemption limit, this is tax 2. Now tax 1 minus tax 2. This is your tax, and please apply 4% cess on this amount. On this amount, this should be your tax. So please don't make a mistake over here. If the question is asking you just to calculate total income, then there is no problem. So that is what I have mentioned it before also. Please read your question carefully. If they are asking you to compute the tax liability also, you have to compute the tax liability then. But please remember, if there is agriculture income, then please you have to follow this partial integration method. Understood or not? End of PGBP. Okay. Capital gain. Rajalakshmi, basic exemption limit depends now that which regime you are following. If you are following default regime, then 3 lakh. If you are following optional regime, then 2.5 lakh. If the assessee is a senior citizen resident, 3 lakh also, 5 lakh also in optional regime. Got it? So it depends on the regime which you are following. Okay. Capital gain. Guys, 5 minutes quick break on before capital gain. So 5 minutes quick break. Can we take a break for 5 minutes right now? Or 10 minutes do you want? I think 10 minutes. Okay. I think 10 minutes we can take a break. Let me have a cup of coffee quickly, and then we'll resume after 10 minutes. Oh, 4:21. Okay. Let's start with the capital gain chapter. We all know that 45.1 is the charging section. It says that if there is any capital asset, provided it is transferred. So what is a capital asset? All assets are capital assets, except we know that stock in trade is not a capital asset. Personal movable assets, rural agriculture land, gold deposit bonds are not capital assets. This, I believe everybody knows it, and you will not make a mistake here. Some personal assets are also capital asset. Jewelry, precious stones, semi-precious stones, paintings, drawings, sketches, sculptures, archaeological collection. Securities, if you sell shares, debentures, other securities, these are capital asset. Virtual digital assets are also capital assets. This will, everybody knows it. This doesn't come. Examiner doesn't ask you this. Examiner generally in capital gain chapter, what type of question it is asked to us? That the assessee has sold his land, assessee has sold his building, assessee has sold his jewelry, etc. And then it is a question where they ask you deduct this exemptions also under section 54. So this is the type of question generally we get in capital gain. But still, period for holding. The period for holding of the capital asset is generally now it is 2 years. Before budget, it was 3 years, but generally now it is for 2 years. So the period of holding starts from the date of acquisition till 1 day before the date of transfer. Because when you transfer it, let's say I have an asset, I'll transfer this asset to you. So let's say today, on 6th of May, I'm transferring this asset to you. So my holding period was till yesterday, because today, this day belongs to you. So from 6th May, you are the owner. Till 5th May, I was the owner. So on 6th May, if I'm transferring 1 day before that, it would be my period of holding. And if this period of holding is more than 2 years, then it is long term. Otherwise, it is short term. Earlier, it was 3 years before budget, but now it is 2 years. In some cases, we take as for 1 year. In fact, this 1 year is same for these 4 types of assets. It is pre-budget, post-budget. It is 1 year for every for all these assets. Doesn't matter it is pre or post. Listed securities. So whenever you sell your listed shares, listed debentures or other things, it is always 1 year. Equity oriented units of mutual fund, units of UTI, zero coupon bonds, it is 1 year. But I am telling you for examination purpose, if you want to remember, only remember this listed securities. So whether it is listed shares, listed debentures or any other thing, generally listed shares, after 1 year, it would be long term. Got it? Pre-budget, the general period of holding was 3 years. Pre-budget, generally it was 3 years for land and building, and for unlisted shares, it was 2 years. But now it is 2 years for everything. It is 2 years for everything. So now it is only 1 year and 2 years. Unlisted debentures. This is an important point. Actually, this is section 50 capital AA, 50 AA, but you don't have to remember the section number. Whenever you sell, this is important, guys. Whenever you sell your unlisted shares, unlisted shares will always be short term. Unlisted debentures will always be short term, irrespective of the period of holding. I'm again repeating, this is important because although it's a very, very small section, but it is very important. This examiner can ask you tomorrow. I am expecting question on this thing. There's an amendment. 50 AA was introduced last year, but here they have made a little amendment over here. So this is what I'm expecting tomorrow. It can come, not 100%, but yes, this is a little bit I'm expecting that examiner can ask you about this. They will not ask you market linked debentures. They will not ask you about other things because that is last year amendment, but they can ask you about unlisted debentures. So how they can ask you? ABC Private Limited. It is a unlisted company, obviously. So it has had debentures. So we have debentures of ABC Private Limited and we are selling it. So let's say we are selling these unlisted debentures and we were holding it for last 3 years, 4 years, 5 years, 6 years, 7 years. Guys, please make it short term for everything. Please make it short term. It is always short term. First of all, tell me, have you understood it or not? I will explain it once again. I'll give you an example if you want. This is a little thing which I'm expecting tomorrow. Tell me whether you have understood or should I explain more? Okay. guys, if you will get, okay, let me give you an example. So you might get an question. You might get a question tomorrow. Let's say example is, because generally we know that if it is more than 2 years, generally it is long term now. Correct? For listed securities, it is 1 year. So let's say you get an question that Mr. A, no need to write it, just understand it. Mr. A purchases debentures of XYZ Private Limited. Let's say 100 debentures he has purchased at a rate of rupees 80 each. He has purchased the debentures of XYZ Private Limited, 100 debentures of 80 each on, let's say, before 2, 3, 4, 5 years. Let's say somewhere on 15th January 2015. So many years back, 10 years back. Now he's selling it. He sold these debentures. He sold at a rate of, let's say, rupees 120 each. He sold all these for 120 each. And let's say he's selling it on 1st of September 2024. He's selling it on 1st of September 2024. So please, on this section 50 capital AA will apply. 50 AA will apply. You don't have to mention the section number, but here you have to mention like this solution. These are unlisted debentures. How can I say that these are unlisted debentures? See, it's a private limited company, or they can specifically tell you that these are unlisted debentures, right? So these are unlisted debentures irrespective of the holding period. See, holding period is how much? From 2015 till 2020-24. It's been 9-10 years, correct? So irrespective of the holding period, they are always short term. They are always short term. They are always short term. Got it? So they will be always short term. There would be no long term capital gain. It would be a short term capital gain. Now, how you will compute the capital gain, you all know. Let me compute it for 1 debentures, then we can multiply. Full value of consideration 120. Cost of acquisition, obviously it is short term, so you will not do indexation also. And obviously you know that post budget there is no indexation as well. So 120 minus 80, 40 is the capital gain into 100. So 4,000 is the capital gain. And what type of capital gain it is? Short term capital gain. Is it 111A? No, it's not 111A. 111A is on equity shares, equity oriented units which are sold on stock exchange. So it is unlisted debentures. It is normal short term. It is not even a special income. It is short term capital gain. So unlisted debentures, this is the amendment. This can come in examination. Please. So some students, if they will write it is a long term capital gain, they will not get marks. They will not get marks because they are ignoring the entire section. So just see, if you have done it correctly, 4,000 you will get it anyways, because you understand it is sold post budget. There would be no indexation. 4,000 everybody will get. But let's say it is a 4 marks question. It would be around 4 marks question if it will come. So it's a very small question, but it contains the concept. If it is a 4 marks question and if somebody will write LTCG, he will not get any mark. If you will write STCG, then there is a difference of S and L only, but you will get full marks in that case. Have you understood it or not? This is 50 capital A section. If you want to mention this, mention the section number, it is 50 AA. Otherwise, not that much required. But this line you should mention. Got it, Hari? Got it, na? Rajalakshmi got it. Aditya got it. Very nice. Always short term. So for unlisted debentures, please remember, it is also for market linked debentures for a specified mutual fund. They will not ask you this. This last year amendment, but this, they will ask you this, unlisted debentures. It is always short term. Okay. Computation, I'm not telling everybody know that how to compute the capital gain. Full value of consideration, cost of acquisition, cost of improvement minus expenses on transfer is capital gain. And generally, if it is long term, then also indexation is not applicable now. But if it is the asset is transferred before budget, then indexation will also be there. CI for this year is 363. We all know it. Any asset which is acquired before 1st April 2001. This is important. Kavya, it is for unlisted debentures only. For listed debentures, it would be long term. For listed debentures, see, for listed securities, 1 year is the holding period. Kavya, got it? For listed securities, whether it is shares, whether it is debentures, for listed securities, it is 1 year holding. After 1 year, it will become long term. But for unlisted debentures now, irrespective of the holding period, they will always be short term. They will always be short term.
Yes.
Okay. Now,
Yes.
any asset which is acquired, any asset which is acquired before 1st April, this is 363, I have not mentioned it over here. Okay. Any asset which is acquired before 1st April 2001, you understand that we can take the actual cost of the fair market value as on 1/4/2001, whichever is higher. Second thing is that in case of land and building, you have to take the fair market value as on 1st April 2001 or the stamp duty value Just give me a moment. Okay. Okay. So in case of land and building, you have to take fair market value as on 1st April 2001 or the stamp duty value, whichever is lower. So it should not exceed more than the stamp duty value. In case of other assets, it is jewelry or any other asset, you can take the fair market value. But in case of land and building, if stamp duty value is given, you have to take the stamp duty value as on 1/4/2001 or fair market value, whichever is lower, then compare with the actual cost, whichever is higher. Got it? Any improvement before 1st April 2001 needs to be ignored. No indexation if it is post budget, we all know it. Bonds and debentures is not indexation. Indexation, we understand that how we do the indexation, CI of the year of transfer divided by CI of the year of acquisition into cost of acquisition. Now, sometimes you can get this question also. And this is again a frequently repeated question. Let's say Mr. A has sold a land, for example, of rupees 70 lakh on 1/5/2024 pre-budget. He has sold this land pre-budget of rupees 70 lakh, which was gifted to him, gifted by father on 1/7/2010, and father has acquired it, has purchased this on, let's say, 1/5/2001 for rupees, let's say, 10 lakh. Now, it is Mr. A who is selling this land. So the capital gain will arise in the hands of Mr. A. He is the transferor. He is the owner now. His father has gifted him. Now, how you will, in this state, capital gain is getting arise. It is pre-budget. So full value of consideration, it is 70 lakh minus index cost of acquisition. Why index cost of acquisition? Because it is pre-budget, it's long term. Index cost of acquisition. We understand CI of the year of transfer, 363, this year CI of the year of transfer, divided by CI of the year of acquisition into cost of acquisition. So first of all, tell me what is the cost of acquisition. So some students can say, sir, the cost of acquisition is nil. Why? Because it is gifted by the father. So our cost is nil. No, it is not nil. It is father's cost. So we understand, please understand this thumb rule. So we also understand, please combine it with IFOS. Please combine this with IFOS also. In case of gift, whenever you receive gift from your relative, please guys, please tell me whether it is taxable or whether it is exempt. Whenever you receive gift, any type of gift, mostly capital asset. See, other gifts are not taxable. I'm talking about capital asset. Whenever you receive gift, whether it is from your relative, whether it is taxable or not taxable. Whether it is taxable or not taxable, it is not taxable, right? So whenever we receive gift from our relatives, it is not taxable. Correct? Very nice. It is not taxable. It is not taxable. So there is no tax implication. There is no tax implication. Please tell me, in 2010, when the father has gifted this asset, when the father has gifted this asset to his son, in that case, Mahendra, in case of relative, relative can give you gift as much as possible. No problem at all. It is exempt. Relative. Please remember, it is relative. So whenever here this person has received gift in the year 2010, can you tell me what is the tax liability over here? No tax liability. There is no tax over here. There is no tax over here. So whenever you receive a gift, let's say land or building or other assets from your relative, then it is not taxable. If it is not taxable, there is no tax liability. In that case, the concept of previous owner will prevail. The concept of previous owner prevails. So what is the concept of previous owner? You have to take the cost of the previous owner. The cost of acquisition of the previous owner will become your cost. The holding period also will become your holding period. The holding period of previous owner should also be included. I'm again repeating. Whenever you have received it, whether there is a tax liability, the answer is no. Why? Because you have received it from your relative. So you have to take the cost of the previous owner and also the holding period of the previous owner. So here, the cost will become, so some students will say, sir, he has received it as a gift, so his cost is zero. No, his cost is not zero. Because when he received it, there is no tax liability. So he will say, sir, my father has incurred a cost of 10 lakh. That will become my cost. So his cost of acquisition will become 10 lakh, whatever is his father cost, divided by CI of the year, in which the CI of the year of acquisition. So the previous year owner concept will apply. So the CI of the year of this 2001. So it would be 100. Understood? Everybody got it? Index cost of acquisition is equal to 363 divided by CI of the year of acquisition. So he acquired it in 2010. He acquired it in 2010, but the previous owner concept will apply. And this was decided in a very celebrated case that you have to take the CII of the previous owner. This is decided in a very celebrated case, a very landmark judgment, Manjula J. Shah. So whenever this question will come in your examination, let's say tomorrow it comes in your examination, please mention this name also, Manjula J. Shah. Just mention this name, Manjula J. Shah. As for Manjula J. Shah, we are taking the CI of the previous owner also. Have you understood this also or not? CI of the year of transfer 363. This year we are transferring it 363. CI of the year of acquisition, we will take the acquisition of the previous owner 100 into cost of the previous owner 10 lakh. Guys, any issues? We will not take it zero. Somebody will say that we have received it as a gift, that it is zero. No. For the previous owner, we will take it. When we will apply the concept of previous owner, whenever we have received, there was no tax liability. So this will become our index cost of acquisition. Got it? Second thing, if I will say that you have received this gift not from your father, but from your friend. If you have received this gift as from your friend, please tell me if you receive the gift not from your relative, it is from your non-relative, whether it is taxable. The answer is yes. It is taxable now. Correct. It is taxable now. So in case in IFOS we have seen that, let's say it is land and building. So whatever is the stamp duty value, if the stamp duty value is more than 50,000 rupees, we will make it taxable. Let's say in 2010, the stamp duty value of this house was rupees 18 lakh. Please tell me now, if you have received this gift from your friend, now it will become taxable. And if it is a fair amount, if the stamp duty value is more than 50,000 rupees, then it becomes taxable. So 18 lakh will become taxable in 2010. Have you all understood that 18 lakh will become taxable in 2010? Now, once it becomes taxable here, now whenever you have received it, it becomes taxable. Then there is no concept of previous owner. Now, what will happen is, if you have received it from your friend, then previous owner concept will not exist in that case. Now, the capital gain would be, if now you are selling it for 70 lakh, full value of consideration 70 minus index cost of acquisition. it has sold before budget. So index cost of acquisition would be CII of the year of transfer 763, 363 divided by 2010 CI. 2010 CI. Let's say 2010 CI was 200. Randomly, I'm taking it 200. Will you take the CI of 2001? No. Previous owner concept will not apply over here. Previous owner concept will only apply when it was exempt when received. But here now it becomes taxable. So previous year concept will not apply. So let's say it was, for example, 2005 I am taking. It is 2005 CI of 2010, 11, whatever it is. Into what is the cost of it? 0? No, we will take this cost 18 lakh because on 18 lakh he has already paid tax. So this will become the cost 18 lakh, not 10 lakh. So this will become whatever you can do the calculations. And this is my long-term capital gain. Have you understood it or not? I'm again repeating. If you have received it and there is no tax implication, why? Because you have received it from your relative. Then the concept of previous owner will apply. Previous owner cost, previous owner holding period, previous owner CII. But if it becomes taxable, why? Because you have received it from your non-relative, then there is no concept of previous owner. So whatever is your cost will actually, it is nil. So we will not take it as 0 because you have already paid tax on 18 lakh in 2010. So 18 lakh will become your cost. So 18 lakh, you have to pay tax over and above 18 lakh. So 18 lakh will become your cost. And since because of indexation, we will give you indexation also, not from previous owner, but from here. Guys, whenever you apply your previous owner concept, please do mention this case, just refer this. You have to mention like refer Majula J. Shah. That's it. Majula J. Shah. It's a celebrated case of Bombay High Court. This you have to refer. Okay. Also refer Manjula J. Shah. But I believe because if the transfer is happening post budget, then there is no problem as such, because in that case, there is no indexation which is allowed. Okay. Insurance claim 45(1)(a). You understand that whenever the asset is destroyed, then also capital gain will arise, but we will make it taxable in the year when the claim is insurance claim is received. If the transfer is happening in previous year 23-24, this is the destruction when it is happening, although the transfer happened over here. But if the insurance claim we are receiving in 24-25, we will make it taxable here. The capital gain tax liability will be taxation over here, but the holding period will be taking up till here only, because the transfer took place only here, but we are deferring the capital gain tax. So 45(1)(a) is not that important, but in fact it is very easy. So we will make it taxable only in the year. Let me give you a quick example also on this. So let's say there is any asset, it was destroyed in previous year 23-24, but the compensation is received in the insurance claim is received in previous year 24-25. So we'll arise the capital gain, we'll tax the capital gain in previous year 24-25. Let's say full value of consideration, whatever it is, less. But the transfer has happened in the year of destruction. So this was a pre-budget period. So indexation, let's say index cost of acquisition would be CI of the year of transfer. So this year CI was 363. This year CI was, let's say, 348. So in the numerator, which CI I have to take? 348. Why? Although I am taxing it in previous year 24-25, we are taxing it at 24-25. In this year, we will do the computation. But actually, the capital gain has arisen here only. We are taxing it here, but we are deferring the tax liability. So we will tax capital gain here, but indexation will be done till here only. So in numerator, please keep that CI as 348 this year divided by whenever it was acquired that year CI. Let's say it was 100 into whatever is the cost, you can take it. So I believe that you are able to recall this insurance claim also. Conversion of capital asset into stock in trade, that is again very easy. So if there is a capital asset and it gets converted into stock in trade, this is also a kind of transfer. We will going to tax you, but we will defer the tax liability. Here we will defer the tax liability till it is actually sold. So let's say we have acquired a capital asset in previous year 2010-11. This is the year when we have acquired this capital asset, and we have converted this capital asset into stock in trade in previous year 2023-24. On this date, the fair market value was, let's say, 20 lakh. We have acquired it for rupees 11 lakh. We have acquired it for 11 lakh in 2010-11. On this date, on conversion date, the fair market value is 20. And here, the capital gain might arise, but we will not tax it. We will wait till the asset is actually sold. And let's say it is actually sold in previous year 24-25. In our year, it is actually sold. And let's say we are selling it for rupees 24 lakh. So if you look at it, so we are selling it for 24. We have purchased it for 11 lakh. So total we have made 13 lakh rupees as profit. So we have made 13 lakh as profit. But is this 13 lakh PGBP because we have sold the stock? Is it 13 lakh capital gain? We have to split because 24 minus 11. So we have actually covered up this much distance. But you understand that this much, this blue color pen, it is actually a capital gain over here. But this red area, it is a PGBP. Why? Because we are selling a stock. So what will happen in this year? In this year, there will be two income which will arise. One is capital gain, other is PGBP. So how much is PGBP? PGBP started from here. So 24 minus this amount. This amount was fair market value. So fair market value will be given in your question. So 24 minus 20. 24 minus 20. 4 lakh would be PGBP. And this 20 minus 11. 9 lakh would be the capital gain. 9 lakh would be the capital gain. Now it depends whether indexation would be there or not. So in this case, the answer is yes, because we have acquired in 2010-11. The transfer date is 23-24. This period is a pre-budget period, more than 3 years. So indexation would be there. And so indexation would be there. So 11 lakh you need to index. But the only important point over here is whenever the capital asset is converted to stock in trade, we will not tax it right here. We will wait till the asset is actually sold. This area is PGBP. This area is capital gain. Got it? And indexation should be done over here only. Whenever you will be doing the indexation, CI of this year or this year? This year. Because transfer actually happened on this date. In numerator, please keep the CI of this year, 348. Whatever is the CI of this year, in denominator into 11 lakh. Got it? 45.5. Compulsory acquisition of capital assets, same thing. Whenever this is quite important. This is quite important. So whenever, let's say, there is a land, assessee has purchased a land in previous year 2001-2002 for rupees 10 lakh, and it is compulsory acquired. For example, it is compulsory acquired in previous year 2021-22, and here the government has fixed a claim that we will give you a compensation of rupees, let's say 50 lakh. But they have not given this money to us as of now. First time we are receiving this compensation, let's say in previous year 24-25. This is the first time that we are receiving this compensation. So what we will do, although my asset was acquired here 2021-22, but in this case, in case of compulsory acquisition, we will wait till the compensation is first received. So in this case, we will receive the compensation here. So in previous year 24-25, capital gain will arise. Full value of consideration, how much we are getting? 50 lakh minus index cost of acquisition. So indexation you have to do till this red particular point. This red point you have to do the indexation. And this is the transfer date. This is the taxable date. So in this case, the year of transfer, if you remember in your classes, I used to say like this, that the year of transfer is this, year of taxability is this. So this is the year of taxability, but this is the year of transfer. So you have to do indexation till here, and it is a pre-budget. It's a pre-budget period. So you have to do the indexation also. So CI of the year of transfer, this year CI to 21-22. Let's say this year CI was, I don't know, let me take it randomly as 310. So you have to take, see in this year, you will make it taxable. I'm making it taxable in previous year 24-25, but less index cost of acquisition. CI of the year of transfer 310 divided by 100 into 10 lakh. Whatever is the amount, you have to subtract it. Got it? So this is the case of compulsory acquisition. Whenever the asset is compulsory acquired, the year of transfer and the years of taxability can be different. Got it? And if the person is receiving any enhanced compensation also, then whenever the enhanced compensation is received, then we'll make it taxable. Cost of acquisition, cost of improvement is zero over there in case of enhanced compensation, but legal expenses, etc., can be taken as expenses on transfer. So whenever enhanced compensation is received, then it will again become taxable. Whenever the compensation is reduced, they will not ask you, but if the compensation is reduced, then whatever is the original capital gain, that will be recomputed. They will not ask you. They can only ask you about compulsory acquisition and enhanced compensation. So whenever this enhanced compensation is received, it will become your capital gain. Long term or short term, it depends on the original capital gain. What was my original capital gain? Got it? Interest on delayed compensation, that is important. Whenever you receive interest on delayed compensation, that is your IFOS income. Simply give a flat deduction of 50%. Simply give a flat deduction of 50%. Right? Guys, this is also important. If a rural agriculture land is compulsory acquired, then there is no question of exemption because it is altogether not a capital asset. Rural agriculture land is not a capital asset, no capital gain. But urban agriculture land is a capital asset. Whenever urban agriculture land is sold, then capital gain will arise. But in case urban agriculture land is compulsory acquired, in case urban agriculture land is compulsory acquired, in that case, it is exempt. If you are selling your urban agriculture land voluntarily, taxable. Urban agriculture land is compulsory acquired, then it is exempt under section 10. Got it? Okay, 46, liquidation is not important, but this one is important. Buyback. In fact, I have told you with the chapter of IFOS. Let me quickly recap this also. See, whenever there is a buyback of securities, what is buyback? The company who has issued this type of securities, they are purchasing it from you. So let's say you have purchased, for example, Amrita has purchased some shares from a company, let's say Infosys. So Amrita has purchased some shares of Infosys. Now, let's say Amrita has purchased 100 shares of Infosys at a rate of rupees, for example, 300 each. So this is Amrita's asset. Amrita has purchased 100 shares at a rate of 300 each. And whenever Amrita will sell it, it will become a capital gain. Whenever she will sell it, it will become a capital gain. Let's say she is selling to the company itself. The company is buying back this. The company is buying back this particular shares. Let's say the buyback price is rupees 500. Let's say the buyback price is rupees 500. So this is the same thing. If Amrita would have sold to somebody else, it would be a capital gain. If we are selling it to the company itself, that is called buyback. So there would be a capital gain in the hands of Amrita, right? This should be a capital gain. But we know that in case of buyback of securities, there should be a capital gain. But actually, they made actually few years back, they said that if this buyback is for equity shares, if this buyback is for equity shares, then the capital gain will not arise in the hands of Amrita, let's say not in the hands of shareholder, but company has to pay tax. The company has to pay tax on this, right? This is not a this year amendment. This is some few years back amendment was it that company has to pay tax at a rate of 20% or something. So this I have explained it in your classes, but right now I'm just giving you an overview. This is not important, so I'm not explaining this. The second point, which I'll be telling you after this, that is important. I'll be telling you that what is an amendment over here. So in case of buyback of securities, if it is equity shares, although there is a capital gain should be in the hands of shareholder, but we are not taxing it in the hands of shareholder. It should be taxable in the hands of company. This will not come. Other securities, if you are buying back other securities other than shares, other than equity shares, it is same. There is no problem over here. It is taxable in the hands of security holder. So let's say it is debentures. If it is debentures, let's say if this would not have been shares, this would have been debentures. In that case, Amrita would be taxable. So this was a normal thing. This was something which was different earlier. So for case of other securities, it is taxable in the hands of security holder. Guys, this will not come in examination. And tomorrow, this will also not come in examination. But in this section, this is section 46A. No need to remember the section number. But what can come in your examination tomorrow is the amendment. This amendment happened on or after 1/10/2024. So if buyback of shares is happening on or after 1st October 24, which is important. So whatever I have told you, I've just given you the background, and I'm also telling you that that is not important. If this section comes tomorrow, then this is the only thing which is important for you. If this buyback is happening on or after 1/10/2024, let's say, again, I'm taking an example, same example. There is a shareholder, Amrita. She has 100 shares. She has purchased it for 300 rupees. Each share she has purchased it for 300 rupees. Let's say she has purchased this Infosys shares few years back or few months back. And now company is buying back at a rate of 500 each. And let's say this is happening on 1st October 2024 or any date after this. If it is happening on this date, this can come in your examination. How much is the company is paying? 500 for each share. 500 into 100. So first of all, in this case, in the hands of Amrita, in the hands of shareholder, if it is happening on or after 1st October 2024, two things will happen. In the hands of shareholder, one is IFOS income, other is capital gain income. One is IFOS income, other is capital gain income. First, IFOS income would be deemed dividend. Deemed dividend, if you remember, you can remember this section 222F. This is deemed dividend under section 222F. Whatever is the amount you are receiving, it will 100% become your IFOS income. So today, 500 rupees she is getting on the buyback of shares, 100 shares, 500 into 100, 50,000 will become her IFOS income, deemed dividend under section 222F. Till tomorrow, if you don't remember this section number, it is fine. But please don't forget this provision. Please make her IFOS income of 50,000 rupees. Understood? And also compute the capital gain. How capital gain would be computed? Full value of consideration will be taken as nil. Sir, she has received 500. 500, please make it IFOS income. Here we have made it. So full value of consideration will be taken as nil. Cost of acquisition was, let's say, 300 per share, 30,000. It will become 30,000 will become capital loss. It will become capital loss. Everybody understood it or not? This I've discussed it in your IFRS chapter also. Again, I'm discussing it today. So whenever this buyback is of shares, specifically of shares, I'm not talking about any other securities. For any other securities, simple capital gain will arise. But for shares, today, if it is happening on or after 1st October 24, which is very, very important, there are high chances that this amendment can come tomorrow. So shareholder has to pay IFO, takes on IFOS income, whatever that he is receiving, he or she is receiving, please make the dividend income, deemed dividend income under section 222F, and there would be a capital loss. There would be a capital loss of whatever is the amount, full value of consideration nil, cost of acquisition, whatever is the cost of acquisition, this is the capital loss. Got it? Little bit important. Section 50 is same as 32. 50B slum sale. Please do remember that for a slum sale, section 50B is for slum sale. For slum sale, it how you have to compute it. It is a lump sum consideration. Full value of consideration. Full value of consideration would be the consideration price. Here you have to actually see whatever is the consideration price or the fair market value of the asset, whichever is higher. You have to take the fair market value or the consideration price, whichever is higher. Cost of acquisition, cost of improvement, you don't have to take. You have to take the net worth of the undertaking. You have to take the net worth of the undertaking. Indexation is not allowed over here. Whether it is pre-budget, whether it is post-budget, doesn't matter. Indexation is not allowed. Net worth you have to take minus expenses on transfer. minus expenses on transfer. So this would be your capital gain. How you have to compute your net worth? What is how net worth is computed? Take your total assets. Take your total assets, and whenever you will be taking your total asset, if there is any revaluation which is happening on your total asset, ignore that revaluation effect. Nullify that revaluation effect. Let's say your land is revalued by 2 lakh, 3 lakh, 4 lakh. So please go back to the original price. So just nullify that revaluation effect. So while taking your total assets, any revaluation effect shall be neutralized. Second thing, if there is any asset, any depreciable asset where depreciation is not charged properly, if you remember, we have done some questions on in the class. So if on any asset depreciation is not charged properly, please charge depreciation also, charge depreciation, and then take the value. So if they are saying that there is any plant and machinery, there is any patents, there is any other assets where we have actually have shown it at their 2 years, 3 years, 4 years back value, we have not given the depreciation effect. So please first give the depreciation effect, then take the value. So if any revaluation has happened, any depreciation is not properly taken, please take after the depreciation effect. And if there is any section 35 asset or 35 AD asset where you have to take the value as nil, please take the value as nil only. Add all the assets minus the liabilities, minus outside liabilities, and only the outside liability of that unit which is being transferred. Let's say in your question, there are two units, unit 1 and unit 2, and unit 1 is getting transferred. So please subtract the outside liability of unit 1 only, whichever unit is getting transferred. So this is how you will get your net worth. Again, I'm repeating, slum sale. It is very, very easy topic and very important also. But I'm assuming that this time they will not ask you, because last time they've asked the question on slum sale. But again, in case they ask it again, full value of consideration is actual selling price or fair market value of the asset, whichever is higher, minus net worth, total assets minus outside liabilities. While taking the total assets, any revaluation effect should be ignored. Any depreciation which is not done properly, you have to charge it properly, correct? And minus outside liabilities. Expenses on transfer you have to minus. This would be the capital gain. Long term or short term depends if the undertaking is more than 3 years. Here it is 3 years only. If the undertaking is more than 3 years, it would be long term. If it is not more than 3 years, it would be short term. Got it? This is 50B. Section 50C. Section 50C is very, very important. It is only for land and building, not for any other asset. It is only for land and building. If your stamp duty value is more than 110% of the selling price, if your stamp duty value is more than 110% of the selling price, then your stamp duty value will become your full value of consideration. If it is exactly 110% or less than 110%, then your selling price will become full value of consideration. But if it is more than 110%, then stamp duty value will become your full value of consideration. Got it? And if the assessee is actually fighting on this stamp duty value, he says that please sir appoint a valuation officer, then valuation officer would be appointed and he will bring his own value. He will bring his value. If the valuation officer value is even more than his SDV, we'll say no sir, we don't need this valuation officer, because he is coming with more than SDV value, then we will not take his value. But if he is coming at lesser value than SDV, then we can take that value. Obviously this value should not be less than the actual selling price. So if it is less than the stamp duty value, then we can take that value also. Got it? One more important point in 50C is that this stamp duty value generally we take of the date of registration. Of the date of registration, we take the stamp duty value. But if there is a prior date agreement, and also with agreement, there is some consideration which is received, through banking mode. It is important. See, if some consideration is received through cash mode, then we will not take it. But if some consideration is received through banking mode and there is a prior date agreement, then we will take the stamp duty value of the agreement date. Then registration date STB will not be taken. Understood? This was easy, and many times we have done this also. So this is real estate transaction. If your stamp duty value is more than 110%, stamp duty value is more than 110% of the actual selling price. Got it? So valuation officer value can be taken. Second is prior date agreement can also be taken. 50 CA is a very, very small section. It is for unlisted shares. So whenever you sell your unlisted shares, see, for listed shares, it is 1 year holding period. For all other things, now it is 2 years. So if it is unlisted shares, you are selling it and the selling price is less than the fair market value. So if fair market value is more than the selling price, please take the fair market value only as the cost of, as the full value of consideration. 50D is not that important. 51 is advance money forfeited. Guys, only this is important, that any advance money forfeited on or after 2014, any advance money which is forfeited today, it will become your IFOS income. So whenever we forfeit any advance money, what is advance money? Let's say there is some transaction which is happening, but somehow this transaction could not be materialized and we have forfeited his money. We were selling our house. He has given us 5 lakh rupees, but we have forfeited it. So whenever we forfeit this amount, and if this forfeiture is happening on or after 1st April 2014, and generally you will get that forfeitures happened this year or last year, and so 2014, it's been more than 10 years now. So if any forfeiture is happening on or after 1/4/2014, please make it your IFOS income in the year of forfeiture itself. So let's say in this year, the assessee has forfeited something, it will become your IFOS income. But if this forfeiture has happened before 1/4/2014, if this forfeiture has happened before that, then there was no such law in IFOS. In IFOS, there was no such law. So in that case, it was not taxable there whenever it was forfeited. So let's say the assessee has, for example, there is Mr. A. He has purchased land for rupees 20 lakh. He has purchased land for rupees 20 lakh, and he was trying to sell it in the year, let's say in previous year 2011 and 12. He was trying to sell it and he has received rupees 4 lakh as the advance money from the prospective buyer. We have received 4 lakh rupees as the advance money, but somehow this buyer has not bought this land.
Cash ಇರೋದು book ಕೊಟ್ಟಿದಾರಲ್ಲ
forfeiture and this amount is forfeited. So this amount is forfeited. Let's say, so this amount is forfeited. See, this forfeitures happened before 2014. So what we will do in this year, we will not do anything. We will not do anything. See, if this is happening on or after 1st April 2014, we'll simply make it taxable as IFRS in the year of forfeiture. But if this has happened before that, then we will not do anything. So what we will do, we will wait till this asset is actually sold. So let's say now we are selling it. We are selling it in the previous year, 2024-25. For example, full value of consideration is 90 lakh. We are selling it for 90 lakh minus cost of acquisition. What would be the cost of acquisition? 20 lakh minus 4 lakh. Why 4 lakh? Because earlier, so we will make your cost as 16, because earlier there was no law of IFOS in IFOS, because that IFOS law came in 2014. So anything which is forfeited on or after 1/4/2014, will make it forfeiture income in that year itself. But if it is before 2014, then you don't have to do anything in that year of forfeiture. But whenever you will sell it, it will be reduced from your cost. Your cost will become 16 lakh. So 90 minus 16 would be your capital gain income. Obviously, it is a long-term capital gain. Understood? So if this forfeiture is happening after 2014, then simply make your IFOS income and no requirement to reduce it. This reduction will only be for that forfeiture. This reduction would only be that forfeiture which pertains to before 2014 date. Understood? So this was section 51. 52 is not important. 54 for shares and securities, I'll come later. But please understand sections, exemptions, which are very, very important. Section 54. If you have sold a residential house property and if you are purchasing a residential house property. Correct, Sondram. If we have actually this forfeiture is after 2014, so simply make it IFOS income and then no other requirement. There is no other requirement to reduce it from the cost. So the reduction from the cost is only for related to that forfeiture which has happened before 2014, 1st April 2014. Got it? So any forfeiture which has happened after 2014, so simply ignore that in the computation of capital gain. only in the year of forfeiture, please make it taxable. Okay. Next is section 54. Section 54, 54B, 54EC, 54F. There is one more section 54D, but that is not that important. But yes, these sections are a little bit important. 54 is available to individual or HUF if you have sold a residential house property. You have sold a residential house property and you are purchasing a residential house property. Either you are purchasing it or you are constructing it. So you can get a exemption over it. So your time period should be, it should be purchased 1 year before or 2 years after. 1 year before or 2 years after. In case of construction, it is within 3 years from the date of transfer. So you have this much time period to purchase or construct. Since you have this much time period, so it might be possible that up to the due date of ROI, you are not able to purchase it or construct it. So you can invest in capital gain scheme also. So whatever you will invest in capital gain scheme up to the due date of ROI, you will get the exemption. So how much is the exemption you can get? Gross LTCG, amount invested, gross LTCG, or rupees 10 crore. Amount invested, gross LTCG, or rupees 10 crore, whichever is lower. A, B, C. So let's say, for example, there is an assessee. These 54, 54B, 54EC, 54F. If capital gain question comes separately, then out of these four, you will get any one of the exemption also in the exams. So let's say full value of consideration. The assessee has sold his residential house. Let's say the assessee has sold his residential house. Full value of consideration, let's say it is 100 lakh. His cost of acquisition is, let's say, 40 lakh. And there is a capital. I'm ignoring improvement. I'm ignoring expense on transfer. So his capital gain, let's say long-term capital gain is coming as 60 lakh. And he has sold this residential house and he's purchasing another residential house, or he is investing in capital gain scheme up to the due date of ROI. Then we will call it gross LTCG less exemption under section 54. How much is the exemption? A, B, C. A is actual gross LTCG 60 lakh or rupees amount invested. Let's say we have purchased our new residential house for rupees 45 lakh, or we have invested in capital gain scheme for 45 lakh or 10 crore, whichever is lower. So we will get 45 lakh, whichever is least, as the exemption, and 15 lakh would be the long-term capital gain. So this is what mostly examiner gives you such type of question. They can also combine section 50C over here. So if you have sold it for 100 lakh, so you have to compare it with the stamp duty value also. They might give you that portion also. But generally this type of question is being asked by the examiner. Second, they will not ask you that whenever the exemption is withdrawn, what will happen in that case. Generally, they don't ask you this. They will give you a simple question that this is what the gross LTCG is and how much exemption you will take. And here, please try to write the section number particularly. If you don't remember the section number, please, you remember the provision. If you don't remember the section number, don't quote it. But if you are quoting it, you should be very, very specific. Then 54B. 54B is for agriculture land. If the assessee has sold his urban agriculture, see, if the assessee has sold his rural agriculture land, then there is no problem. There is no capital gain. But if the assessee has sold his urban agriculture land, then there would be a capital gain which will arise. How much? Same thing. The exemption would be that he has to purchase agriculture land. This new agriculture land can be rural. It can be urban also. 10 crore limit is not there. Gross capital gain or amount invested, whichever is lower, you will get this exemption. So this is easy. 54B. 54EC is very, very important. 54EC is very, very important. In 54EC, it is whenever the assessee has sold his land or building, whenever the assessee has sold his land and building, and they are supposed to invest in bonds of NHAI, or RECL. Only the asset transferred should be land or building or both, and you have to invest in NHI or RECL bond for, and this maturity of these bonds should be 5 years. What is the time limit to invest? Within 6 months. That is within 6 months. If you are investing within 6 months, then only you will get this exemption. So within 6 months you should invest. So whatever the amount you invest, or gross LTCG, or maximum 50 lakh. See, in 54, in section 54, the limit is 10 crore. Here, the limit is 50 lakh. You cannot get more than 50 lakh rupees exemption in 54 EC. Whichever is lower, that would be your exemption. So 54 EC exemption you can get. 54F, it is if you are selling any long-term asset other than residential house. This is again an important exemption. This is also an important exemption. If you are selling your any asset, any long-term asset other than residential house, even if you are selling land, you can get 54F. So if you are selling any long-term asset, then you can get 54F. How much you can get it? How much you can get it? If here the formula is, it's a formula-based exemption. Let's say the assessee has sold his jewelry, or the assessee has sold shares, or the assessee has sold land, not residential house. So let's say the assessee has sold jewelry. Full value of consideration is, let's say, 70 lakh, for example. Cost of acquisition is, let's say, 20 lakh. So 50 minus expenses on transfer is, let's say, 1 lakh. So 49 lakh is the gross LTCG, for example. You can sell any asset, you can transfer any asset other than residential house. This is the gross LTCG. And now the assessee has invested in residential house. Either he has invested in residential house or he has invested in capital gain scheme to buy the residential house or to construct the residential house. So in this case, exemption under section 54F would be, it's a formula based exemption. We will say that how much money do you have right now? That is called net consideration. So net consideration is full value of consideration minus expenses on transfer, 69 lakh. Out of 69 lakh, how much you are investing? Let's say the assessee has invested 50 lakh out of it. So 50 lakh amount invested out of net consideration into capital gain into 49 lakh. So this is an important exemption under section 54F. If the assessee is selling any asset other than residential house, even land, 54F is allowed only for individual or HUF. And he or she has invested in residential house, amount invested upon net consideration into capital gain. This is the exemption which you can get in 54F. Got it? 54F is little bit, all these sections are a bit important in capital gain. 54D, 54G, GA, GB is got CA intermediate course. 54D is not that important, but sometimes examiner asks you about this 54D also. So about 54D, the eligible assessee can be any assessee. The eligible assessee can be any assessee, but he should be actually doing a business of, manufacturing. He's into a manufacturing business, and his land or building which is related to factory, his factory land or factory building is compulsory acquired. Only if it is very, very rare section, only if his factory land or factory building is compulsory acquired, then he can get this exemption. And he has to purchase his land or building only for industrial purpose or manufacturing purpose only. So whatever is the capital gain which he's getting, and if he's investing in new land and building, so whichever is lower, you will get this exemption. 54D, not so important. Okay. One more thing before we wrap up capital gain. Guys, for bonus shares, the cost of acquisition is generally nil. The cost of acquisition is nil because bonus shares are given you free of cost. So whenever you are selling it, full value of consideration minus cost of acquisition is nil. But if this bonus shares is allotted to you before 1/4/2001, then you will have to take the fair market value. Please take the fair market. Don't make a mistake over here. Please take a fair market value as on 1/4/2001 also. Got it? For bonus shares. For right shares, right shares are not given you free of cost. You have to pay something for that. So whatever you have paid for it, it becomes your cost of acquisition. But if you don't take this right shares, but you renounce it to somebody else, so in that case also capital gain will arise. What capital gain it is? It is on renunciation. You are transferring your right. So whatever you are, for how much money you are selling your right, that will become your full value of consideration minus cost of acquisition is 0. Why 0? Because this is the right. You are not transferring shares. You are transferring the right. And this right is the letter which you have received. And this letter was of 0 value. So this will again become your cost. And the person who purchases the shares, to whom your right is renounced. Let's say I'm the original shareholder, but I'm not taking it. I have renounced it in somebody's name. So his cost will become whatever he paid to the company and whatever he paid to the original shareholder. His cost will become the combination of these two. Whatever he paid to the company, whatever he paid to the original shareholder. Right? Next is, whenever you sell your equity shares or equity oriented units, mainly equity shares, whenever you sell your equity shares on stock exchange it is written, or in your push examination STT is written. So whenever you sell your stock exchange shares on stock exchange or STT, if it is short term, that is the period of holding is up to 1 year. If it is short term, then it is known as 111A. Brokerage is allowed, but STT is not allowed. STT is not an allowable expense in case of capital gain. STT is allowed only for PGBP, but STT is not allowed in capital gain. Got it? So 111A is taxable, and now you know that 111A tax is 20% if it is post budget, but if it is pre budget, it is 15% tax rate. Got it? Second thing is that if it is long term equity shares, so if you have actually selling your equity shares, this is an important point. This is the last point in capital gain. This is important. If you are selling equity shares which is long term, so whatever is your selling price, full value of consideration would be the selling price. So let's say if I am selling my HDFC bank share today, and whatever is the full value of consideration, let's say I'm selling it for 1900, so 1900 is the full value of consideration. What would be the cost of acquisition? What would be the cost of acquisition? See, now it depends that when have you acquired it. So if you have acquired it, this is an important date. If you have acquired it on or after 1st February 2018, if you remember, I've told you Mr. Arun Jaitley has made an amendment in 2018. So if you have acquired it on or after 1st February 2018, then your actual cost will become your cost. Then there is no problem. Your actual cost will become the cost. Correct? But examiner generally asks you this: if you have acquired it before this date, that is up to 31st January 2018, this is an important date when this amendment came. Actually, I'm talking about section 112A, long-term equity shares or equity-oriented units. So if you have acquired it before 31st January 2018, so your cost of acquisition would be, actual cost, or B, your fair market value. Your fair market value as on 31st January 2018, whichever is higher. I'm again repeating, if these shares were acquired before that budget, Mr. Arun Jaitley's budget, if it is acquired after that, then there is no problem. Your actual cost will become your cost. But if it is acquired before that, then your cost will become your actual cost or fair market value as on 31st January 18. And also on 31st January 18, generally in your exam, it will give you the market value as on 31st January 18. Sometimes they will give you multiple values of as on 31st January 18. They will give you lowest price also, they will give you average price also, they will give you highest price also. So you have to take the highest price. Highest price is what you have to take. But please remember, when you take the B point, fair market value is on 31st January 18, or you have to also say actual selling price, whichever is lower, and this lower should be compared with this, whichever is higher. So your cost cannot be more than the actual selling price. Your deemed cost cannot be more than the actual selling price. So if you remember, A point is actual selling price, B point has 2 points. Fair market value as on 31st January 18, or actual selling price, whichever is lower, and compare it with your actual cost, whichever is higher. That would be your cost of acquisition. Understood, guys? So this is important, and this is 112A. 112A is taxable. 112A is taxable at a rate of 12.5% now. Before budget, it was 10%. So if it is before budget, then please apply 10% rate. If it is after budget, please apply 12.5% rate. But one thing is common, 1,25,000 is the exemption which you need to provide. Got it? So this was about capital gain. It's already 5:30. IFOS. Guys, what I need to do is, if you want to continue it further, I would be taking a break over here because I'm speaking from 10 a.m. So in that case, at least because IFOS will not take much time. So now, IFOS will take 15 minutes. Clubbing and set off again will take the next 15 minutes. Deduction TDS. My calculation says that 1 hour plus 10, 15, 30. Guys, I have to take 2 hours class more. If I have to complete the entire syllabus, I have to take 2 hours class more. So what I'm doing it, I'm pausing it right here. So should we start at 7:30 after 2 hours? 7:30 p.m. to 9:30 p.m. Or should we start from 8? I think from 8 o'clock it would be good. 8. Okay. Do you want me to start at 9? I can start also from 9. I believe 8 is good to go. 8 or 9? 8 is good to go. Okay, okay. Most of the students are telling me 8. So I have to take 2 hours more class. So I'll take today from 8 p.m. till 10 p.m. Right? So let us wait for another 2.5 hours and then we'll take a break for this month. You can read something, you can take a rest for half an hour or so. If you want to revise it, you can revise this. You would like to revise GST, then you can revise GST. And then again, we'll meet at 8 p.m. same link. Okay, take care till then. Rest a little, revise a little. This is only one paper which is left for the first group. Please keep on studying. So we'll meet at 8 o'clock. Bye-bye.